getting knocked back. But good fight coming in from Jadeja as well as Washington. Feeling good this morning. Hopefully the Bulls get some kind of inspiration as well and fight back, because as of now things look a little bit jittery.
Yeah, absolutely. And they've been a little blah in that sense, right? I mean, global markets have been doing well, but here things have not really looked all that exciting. Let's just start from the beginning, right, in terms of what you need to know as we begin a new session. I'll start with India first, and we'll get down to the other stuff. So government sources tell CNBC TV18 that all options remain open in the ongoing India-US trade deal. Now, the reason I'm putting this right up front is because so far, what we know and what was kind of sort of what we were picking up is that a deal, an agreement before the 1st of August is unlikely. The US team will be in India post the 1st of August, and then there'll be more discussions, etc., and it'll be taken forward. So maybe by September, October, November, later in the year. But this is new information, which we picked up, all sources, of course, but over the weekend, that interim deal before the 1st of August is not ruled out, even as the larger bilateral agreement is negotiated. It's continued to be negotiated. Remember, I would kind of sort of think that, yes, I mean, interim agreement more likely than not before the 1st of August, because, I mean, think about it. There is the base tariff of 10%, and then, of course, the 26% tariff, which was handed out in April. So cumulatively, you're talking about a 36% kind of number. And nobody knows what's going to happen on the 1st of August, but I mean, is that the number we are looking at? I mean, certainly that is something that we'll try and avoid. So perhaps an interim agreement before the 1st of August, and then I guess talks continue as sources tell us about the bilateral overall larger agreement. Now, this is, of course, in the works, right? Now, the new thing which really sort of, took shape was the US-EU trade deal. And this came through on Sunday. And it was announced, I mean, done and sealed. So 15% across the board tariffs on European exports into the US market, including automobiles, apparently. And this is important. So Europe pays 15% for everything it sends into the US, but vice versa, there isn't very much. I'm seeing a lot of commentary, etc., which says this is bad for EU, they're getting a raw deal, etc., etc. But think about it. This is not very much different from the 10% which was announced early on, which markets were working with. And then if you had added sectoral tariffs on things like autos, pharma, it would have gotten up to about 12, 13%. You're getting a 15% all-inclusive deal for EU. So, I mean, it's all relative. It's not absolute. So in that sense, I wouldn't say it is too bad at all. I mean, of course, EU has agreed that they're going to buy energy, a lot of US energy, a lot of US gas and oil. They want to anyway sort of wind down their reliance on Russian energy. So there's some big number which has been sort of put out. There's also talk of military equipment purchases from the US, which in any case the EU would have had to do if they want to bolster their defenses and contribute more into the NATO. So that is one. That is US and EU, and that's a large agreement. With regards to China, there are reports. The South China Morning Post has said that China and US will pause tariffs for another 90 days. So this is what came through. And the US Treasury Secretary Scott Bessent is meeting his Chinese counterparts over today and tomorrow for talks to take this forward. And we'll, of course, see it in Stockholm. So we'll see what comes out of it by the end of tomorrow when these things happen. Busy US week ahead, FOMC. The Fed decision is on Wednesday. I mean, the consensus is for no change. Lots of US macro data ahead. I mean, ADP, PCE, GDP, NFP. So, it's really packed. Leading up, of course, to a crescendo with the US jobs data, monthly jobs data. Numbers continue to come in. 33% of the S&P in the US is reported earnings. Another 37% will report over the next 5 days. And this includes tech-heavy names like Meta, Microsoft, Apple, Amazon. And by the way, US earnings so far, what we have gotten, about 60% of companies have beaten earnings per share expectations. So it's a pretty good earnings season in the US so far. And of course, on the back of it, US equities have continued to make newer highs. I mean, the S&P is, by the way, has made 14 closing all-time highs this year. So it's an absolutely phenomenal run that the US is seeing, even as markets here are not doing all that well. And yes, last week was a case in point. Never once did it look like the market is going to sort of break out. I think one day, there was Wednesday, where there was a bit of a flurry of excitement that quickly fizzled out. And the market, of course, ended lower. So I'll just end with levels here. So for the Nifty, on Friday, the Nifty closed below the previous low, the prior low of 24,882. So the next, on daily charts, the next support comes in at 24,773. So we'll see if that comes into reckoning, but that's about 100 points away. The Nifty Bank, mind you, managed a positive weekly close. So supports here, 56,395, which is the 40-day exponential moving average. The next support is 56,204. Resistance here comes in at about 57,316. Very, very near-term levels is what we're looking at. GIFT Nifty is indicating, I think, a flattish kind of start as we begin this trading session, about 8.5 odd points lower. Surabhi.
Okay, well, we've got plenty of trade talk and plenty of earnings to go over. It promises to be a very, very busy Monday. US futures actually are up between about 0.3% to 0.5%, depending on which index you're looking at, because of the optimism around the deal with the EU, which has finally come through. Now, Asian markets, they're trading mixed this morning. There's some profit taking in Japan, because remember, that was the market of the week last time around after the Japanese trade deal. So there's some profit taking in Japan. But the Chinese markets are doing very well, both Hong Kong and mainland China, because the markets believe that they're perhaps next in line. By the way, not just the trade, tariff level itself, China's purchase of oil apparently is also going to be discussed at that meeting, which kicks off in Stockholm today, which Treasury, which from the US side, Mr. Besant is heading, and the Chinese are present as well, of course. The dollar has been soft all through last week, and it continues to be fairly soft this morning as well. Last week, the dollar index fell about just under 1%. This morning, again, we're getting very flattish cues there. It's trying to find some stability. Now I want to talk about the cues that we have here, and it's earnings. And I'm sorry to say this, but the banking earnings at least are not inspiring too much confidence. Kotak Mahindra Bank. Now, what is common across the board is asset quality issues, some rise in credit costs and margin compression. That's a common thread across most weekend banking earnings. So Kotak Mahindra Bank, provisions up, credit costs up quite sharply, especially quarter on quarter, and the margin has declined 32 basis points. The market was working with just 20 basis points of a NIM compression, so not looking that great. Look at Bank of Baroda. The net interest income itself is down, both sequentially as well as year on year. The rise in provisions, they've doubled year on year. And even sequentially, they're up almost 30%. So again, that's a concern. And again, slippage is slightly higher. So asset quality woes. Look at SBI Card. The rise or the credit cost itself is at a 16-quarter high. SBI Card was, guiding for a gradual decline in credit cost just a couple of quarters back. This quarter has been a bit of a negative surprise over there. You have Shriram Finance, however, and we'll be talking to this management as we go forward. And at least here, there are no complaints. The numbers looking very, very, solid. In fact, improvement in asset quality, fall in credit costs, and the AUM growth looks solid at, almost 17% growth coming in. So at least that's good. However, while we're dealing with banking woes on one side, there is IT, and there's no good news coming in on IT as well. TCS, look at what it said over the weekend. It will be reducing its global workforce by 2%, and this could be impacting mid to senior level positions quite a bit. So let's see. And they're, of course, attributing it to structural changes, AI, etc. But this becomes an important talking point. Basically, expecting support from tech, may not really work through. That's the short point. Nifty already at a 1-month low. And we've had 4 consecutive days of weekly declines, including the last week that just closed out. The index, of course, has fallen, below a lot of moving averages, including the exponential moving average, the 50-day. The FPI selling, now again, here on a daily basis where it's negating, DII buying is being negated by FPI selling. The net sell figure is actually not looking too big for July. But you have to, factor in that they're coming in through perhaps the block trade transactions. But still, there's a net sell number of 6,500 crores. On Friday, we're talking about FPI selling of almost 2,000 crores, domestic buying of about 2,140 odd crores. So FPI selling continues to be a worry. Finally, earnings, I named quite a few of the banking ones. In addition, IndusInd Bank today comes out with numbers. The company CHRO resigned over the weekend. Watch for this one. And there's BEL from the Nifty as well. So busy Monday coming up. Nigel.
Well, that's right. The Nifty is seeing a bit of subdued action right now. And in fact, this correction that we have seen, or this mild pullback we've seen, is on lack of volumes as well. So we're not falling on very, very large volumes. What the market is lacking is a positive trigger. As you said, earnings have been pretty subdued. Whether you look at Kotak Mahindra Bank, Shriram Finance, Bajaj Finance, throw in there Zen Technologies as well. Earnings that have been reported till now has been a little bit subdued. We're waiting for clarity with regard to the United States-India trade deal. That's not really come about. So that's an uncertain event. Once that comes about, whatever it is, that uncertainty will be behind us. And tech, we've been talking about this. Maybe, in fact, the street was more focused on buybacks, bonus, etc. But the innovation, the focus on innovation seems to have lacked a little bit. And now this employee cut will weigh on the tech space. So we're lacking a positive trigger, which is which are the reasons why, in fact, we have seen that the markets have been subdued. Moving on then, the Nifty as well as looking tactically a little bit jittery. Because as we were saying earlier, well, we ended lower for the fourth straight week. And now we are, holding in that vicinity below the 20 DMA. So the structure seems to be broken a little bit. And we need to bounce off somewhere over here. Otherwise, we're staring at around 24,000, which incidentally is a 200 DMA. What about the FI action? Well, that as well has been a little bit subdued. They have been adding shots as well. But the big cue this week is going to be the US Federal Reserve. Their rate action is in the next few days. And that could be a global trigger that we are going to be waiting by for. Technical factors, though, are gradually sliding towards the oversold levels. And, that could be a factor that the bulls will track closely. The Nifty RSI currently come down to around 40. A couple of months ago, it had gone to around 65. So that's cooled off. But at around 30, that's when you say that it's in an oversold territory. So keep an eye out on that. FI net shots, highest since March. And the Nifty PCR, well, that's come down to around 0.7. Let's dwell a little bit onto the last two. In Friday's trading session, we ended lower. The FIs went ahead, they added short positions, more than 14,000 contracts were added, and they remain net short with 86% of their positioning on the short side. The PCR as well, that's come down to around 0.7. We started the week last week, in fact, around 1.1. And that's because call writers are now feeling very, 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 confident. 24,900, 25,000 call. Both of them saw a good amount of open interest build up. While on the downside, this 24,850 put, well, that saw some build up. So which brings us to the levels. Now on the upside, since you're going by the writing that you're seeing at around the 25,000 odd mark, this 25,000 zone will be a bit of an, an important mark that we'll be looking at. So we'll have to keep an eye out on that. That's where the resistance comes in at. And in fact, the 200 AMA is going to be the important mark as well. This number is actually around 24,725. That's the important mark. You don't want to breach on the downside, 24,750. Moving to the Nifty Bank, well, the chart should come up with you with the 20 and the 50 DMA. We're still holding about the 50 DMA. You don't want this to get breached on the downside. The stock that I'm looking at, because of the deal that the United States and Europe have tied in, Tata Motors, they have a plant in Slovakia. The Discovery as well as the Defender are sold out of there. And because of that, because of this trade agreement that has been signed, I think Tata Motors will be in focus. Earlier, the US, UK signed a deal. Now Europe as well has been included. So that could be one of the stocks we'll track during the course of the day.
Okay, all right, got it. Nigel, thanks very much for that. So a lot of stocks and, of course, cues on our radar. Let's tell you what's lined up on the show today. And it's a packed next 2.5 hours coming up. So here are the interactions. At 8:35, we'll be speaking with the management of E-Clerx, talk about the company's Q1 performance and, of course, the outlook for the rest of this year. At 9 a.m., we discuss all the weekend banking numbers with Sweta Daptardar of Elara Securities, talk about how she's reading the trends that came through. Pankaj Murarka of Renaissance Investment Managers is our market master of the day. He joins in at 9:20. At 9:30, we get chatting with the management of Laurus Laboratories. They'll talk about the Q1 performance. Remember, the stock had surged on Friday after the numbers came through. Margins better than expected. We'll get some more details with Mr. Satyanarayan Chava as we go forward. After that, we discuss the numbers at Shriram Finance. Mr. Umesh Revankar joining in to talk about what seems like a pretty solid quarter. And we'll get that outlook for the rest of the year. At 9:50, Sushil Kumar Modi of Macroeconomic Developers joins in to discuss their performance in the first quarter. Towards the end of the show, Lata gets chatting with Mr. V. Vaidyanathan of IDFC First Bank to talk about the bank's Q1 performance.
Okay, well, it's a packed lineup here coming up. Taimur Beg is now joining us, Managing Director and Chief Economist at DBS Group Research. Taimur, good morning. Great to have you with us here on the program. So, interim deal not ruled out, Taimur. What happens on the 1st of August in the absence of an interim deal, India-US?
I think there will be some softly sort of worded statement about how the end game is just around the corner, as it is the case with most Trump-related negotiations. But there'll be some parameters. As you can see, the really tough one was the one with EU. And at the end of the day, they did get a few parameters out, the 15% tariff on most. That's an important one because there's still going to be additional tariff on steel and other things. So I don't think it's going to be that much different. Mind you, the big thing in my view on India is A, market access for US companies, and B, the pharma aspect, which is under a different sort of discussions, that it will not be part of the core deals that all these countries are signing up with the US. So I think 1st of August will not end uncertainty. There will be some clarity, some, like I said, softly worded statement on some initial parameters. I think Trump likes to call it the concept of a deal. I think that's what we are heading into, not final word at all.
Taimur, hi. Great to have you on the show. So, it's everyone's got the deal. India's still waiting. But what's the sense? And August 1 is now 4 days away. So
right.
do you think, do you think that this will eventually play out in India's favor?
So I live in Singapore. We're also waiting. We don't have a letter, if you will, as far as the US is concerned. So India is not the only one, but you're right. From Japan to the EU to the UK, a bunch of countries have now letters associated with the 15% baseline and maybe something extra, for example, in the case of Vietnam. So I think, where would India be? I think India would probably get some sort of an indication that it would be on the more favored spectrum at the end of the spectrum. So like Indonesia has 19%. I'm looking at India to be at the most 19, if not lower. I don't think Indian negotiators are going to just roll over and agree with everything that the US asks. And I think the Americans are also realizing that they are dealing with a fairly capable group of trade negotiators, and they're just not going to listen to everything that the Americans say. I think the US and India interests converge, even as hard-nosed as Trump is. He recognizes that. And so I am moderately optimistic. But again, I remain focused on the sectoral aspects, on semiconductors, on pharma, on electronics, because these things affect India's present and future. India wants to be a big consequential exporter of electronics to the US and the rest of the world. But if we're going to start on day one with a 15% tariff, if not higher, on electronics under the separate sectoral review, what does it mean for that outlook? Pharma, major exports out of India into the US, that is under a separate review. So for me, even on the 1st of August, if there are basic contours of a deal announced, I will remain fixated on the sectoral stuff more than anything else, because I think those are the ones that are going to be very, very consequential for Indian large industrial houses.
All right. Hi, Taimur. Good to see you. Ben, the other big event this week we're going to be looking forward to is the Fed. There is some optimism, maybe a surprise rate cut. That's in minority right now. But what do you view in terms of Fed rate action? And what is the key highlight you'll be looking forward to in this policy meet?
Yeah, unfortunately, so much politics around this whole Powell-Trump drama that we are sort of ignoring the important stuff of, where is the U.S. economy heading? What is the underlying inflation pressure? And does it make sense for the Fed to start giving some dovish signal? So a couple of things. I think the starting point for the Fed cutting rates last year was probably premature in hindsight. They probably should have waited a little longer, because then cutting then and then not cutting now puts them in that whole political dilemma, right? That they cut during Biden, they're not cutting during Trump. Yeah, what is Powell up to? And I think that really, really vexes Trump. But in terms of the direction of the U.S. economy, top line growth numbers are okay. We're going to get a decent third quarter GDP data. We're going to get good 3 quarters of 2025 in good growth territory. But that is the top line number. When we look at beneath the surface on the labor market particularly, but also corporate guidance with respect to tariff, I think some disturbance is around the corner. The recent employment data has been basically juiced up by state level public sector hiring. That is not a sign of a very sound economy. Private sector hiring has been waning in the US. Similarly, on the corporate guidance side, we heard from GM, and as these tariff numbers get solidified, we'll hear from more companies that what would they do with their tariff? Would they report a very large hit to their bottom line? Or would they try to spread it, squeeze the suppliers if they can, and pass on some prices if they can, and in the middle take some hit on their balance sheet? That sort of stuff, again, should worry the Fed about corporate profitability, about the dynamism of the economy. So I think they will starting this week, shifting the tone of the discussion away from inflation to the labor market, because that is part of the dual mandate. And perhaps around that, they can start justifying a glide path toward lower interest rates in the second half of this year. Not this week, but down the road, maybe the following meeting, and then again the following meeting after that.
Taimur, we leave it there. Thank you very much for joining us. Quick but good conversation as always. Appreciate it. We'll take a break. We are back with lots of stock-specific action that we want to get to you in just a bit with our top 10 segment. We're looking at CDSL Premier Energies that are on our radar on the back of positive news flow Well, just two. On the other side, TCS, Kotak Bank, SBI Cards, Balkrishna Industries, SAIL, Tata Chemicals, perhaps likely to open in the red. There are some names, Bank of Baroda, IDFC First Bank, which may open slightly mixed. Stay tuned. Coming up.
Welcome back. The global picture is fine, and it has been. The issue is with what we are doing in our earnings. But for what it's worth, let's pull up the implied open as well, because the Japanese markets are cooling off, profit-taking. The Chinese markets are soaring on hopes of a trade deal. We are absolutely flat on the implied open, just about 10 points lower. Okay, time to talk stocks, and there are many, many weekend earnings and news stories to go over. So, guys, morning to all of you. Let's get started with the CNBC TV18 list of top stocks to watch this Monday morning. Gaurav has had a busy weekend. Gaurav, let's start with Kotak Mahindra Bank. Not that great.
Well, yes, as you highlighted, Kotak Mahindra Bank, not good results. And let me come straight to the point. What happened in this quarter? First is that net interest margins, now they have declined almost by 32 basis points, whereas Street was expecting around 20 basis point fall. Management said that this is because of the shift from unsecured mix and also because of the rate cuts. But at the same time, they have also highlighted that in Q2, we will see further cut in the net interest margins. Other than that, credit cost was also something which was disappointing. That has increased almost by 30 basis points. Now, the Street was not anticipating any kind of increase. they were anticipating it to remain more like a flattish number and if increase or almost around 5 to 10 basis points. This is specifically because of the MFI book, and at the same time they have also highlighted that retail CV is also seeing some kind of stress, and they have called that in H2 we will see credit cost actually coming down, but definitely that is something which will not be taken in a positive way. Another hiccup is that loan book growth was at around 14% on a year-on-year basis. It was actually a good number, but this was specifically driven by corporate banking that increased almost by 11% on a sequential basis, whereas the consumer banking segment that has increased only by 3% on a sequential basis. So that is also another thing which will not be taken in a positive way, and that is the reason why we think that we will see some negative reaction in the stock price today.
All right, thanks a lot for that, Gaurav. Well, in fact, we'll have Shweta Villara Securities who will be joining in at 9 a.m. to talk about Kotak's earnings in detail. Well, let's hop across to Sudarshan. He's here to tell us about Balkrishna Industries. Morning, Sud.
Good morning, Nigel. So it was largely a muted set of earnings that Balkrishna Industries, one of the big tire makers, has reported for Q1 of FY26. But beyond the earnings, what I'll be waiting for is the commentary. Like today, a company has earnings call at 11 a.m. And also there might be something positives that flowing in because of the US and EU trade deal that has been announced over the weekend. But first, talking about the earnings, EBITDA was down 8%. It was below the estimate of around 690 crore. It has come in to pay 660 crore. Margin 2 has fallen by almost 200 basis points, 23.7%. Even revenue was up 1%, but it was largely in line with estimate. Volumes have fallen 3%, but at the same time, realization has increased by 4%. The reason EBITDA has fallen because of the adverse mix, and the reason because gross margin has seen a dip. It has come in at 51.5% versus 53.1% because raw material costs have increased by almost 160 basis points. Also, mix has been adverse because of that. Share of replacement has come down marginally to 73%. At the same time, domestic side of business has seen an increase in the contribution to around 35% versus 29%. So I'm going with mild red, but keep an eye that management commentary will be at 11 a.m. and also we'll have to track about the US and EU trade deal impact.
Okay, all right, sir. Thanks a lot for that. Well, I'm going to be looking at SAIL in today's trading session, and the numbers were disappointing. In fact, when I was doing the F&O corner, I was mentioning that there's a lot of short build-up. Open interest was surging, the stock was going in low, so some part of the street was actually positioned for this weak set of numbers, but they are weak. Volumes are more or less in line, just a 1% miss out there. The problem in the past quarter was realization growth was weaker than expected on a sequential basis, and cost actually moved up, which is surprising because the coking coal cost actually had cooled off, and most of the peers like JSW Steel had guided that, coking coal cost, raw material cost will move down. So that goes down as a bit of a disappointment. But just take a look at that. The sales volume growth is closer on 13%, and other expenditure as well is up closer on 13%. So though the volumes went up, lack of any kind of operating leverage, positive operating leverage is what we saw, which is disappointing. And the EBITDA per ton as well on a sequential basis actually did come down. Remember, there is a small element of railway price revision, which was around 170 crores in this quarter. All in all, these numbers go down as disappointing. The good part, though, is net debt has come down yet again by close to around 1,000 crores. So that's the lone positive, because otherwise Q2 as well will be soft, going by pricing as well as activity that is seen in the monsoon season. So red on that one. But Vama standing by to tell us about CDSL. Morning, Vamakshi.
Good morning, Nigel. CDSL has reported a good set of numbers this time around. On a quarter-on-quarter basis, the revenue has seen an uptick of over 15%, but the total operating expenses are growing at a much slower pace of around 11.6%. This has resulted in the EBITDA margin expanding by almost 170 basis points, and the EBITDA resultantly is surging higher by almost 19%. But when we look at the net profit, it is up only 2.1% quarter-on-quarter, and that is because the effective tax rate this time around was much higher as compared to Q4 of FY25. Keep in mind that these set of numbers comes after a disappointing Q4 that the company had reported. Apart from that, when we look at the segment-wise performance, what drove the revenue growth this time around was the depository activity, which was up almost 22%. What did not do well is data entry and storage. That segment saw a downtick of almost 13%, and the repository also saw good growth of almost 23.19%. Margins, depository activity margin expanded by 444 basis points. We saw some contraction in margins for data entry and storage, and the repository continues to report a loss. But overall, it looks like a good set of numbers for CDSL.
All right. Thanks very much, Vamakshi, for that. Well, Premier Energies is the next one we want to focus on. Vivek is here with details on this one. Vivek, morning.
Well, that's right. Premier Energy is again a good set of numbers from this particular solar cell manufacturer. Revenues higher by 10% on a year-on-year basis. EBITDA is up 53%. Significant operating leverage being seen over here. Margins expanding by almost 1,000 basis points, 30.2 versus 21.6%, and profitability higher by 54%. Company has also unveiled its FY28 targets. There's a slight tweak. So wafers and ingots, they're seeing capacity of close to 10 gigawatt. Cells also, they are seeing a capacity of 10 gigawatt by FY28. Order book remains very strong, over 8,600 crore order book, and 100% of the order book is domestic at the current point of time. In terms of the revenue mix, cells contribute 23%, modules 75%, others 2%. So overall, a good set of numbers from Premier Energies. Expect some green on the stock at opening.
Okay, all right, Vivek, got it. So Premier Energy is on the green side, perhaps. Let's go across to Sonal and figure out how Tata Chemical has been. Sonal, what's the first quarter report card looking like?
Well, for the numbers, they were decent. In fact, it was a growth on a YOY basis when it comes to their EBITDA. So revenue is down 2%, EBITDA was up around 13%, margins expanded by 200 basis points, and profits were up 66% as well. The profit component, it was also aided by a component of income tax refund and interest to the tune of 75 crore rupees. While the numbers looked decent, the commentary did not. In fact, the management said that revenues declined because of pressure on realizations across geographies, and they saw pricing pressure as well. Sales volumes were down 1% on a YOY basis. They said demand and supply balance continues to be very soft. Soda ash markets continue to be oversupplied, and that will continue to impact pricing. In fact, in quarter one itself, pricing was quite muted, and they expect demand to be flat going forward as well. And that's why, on the basis of commentary, going with the red on Tata Chemicals.
Okay, all right. So commentary not that great for Tata Chemicals. Got it. Sonal, thank you for that. Back to Gaurav. Like we said, he's had a busy weekend. So there's Bank of Baroda, IDFC First. There's also SBI card. Any good news anywhere, Gaurav?
Well, when we talk about Bank of Baroda, there is positive news, but at the same time, there is negative news as well. So first, let's talk about the positive one. Net interest margins declined only by 7 basis points. It was actually higher than what the street is expecting. But on the other hand, when we look at the credit costs, we have seen a spike of around 11 basis points on a sequential basis. Now, bank has attributed this spike to the overseas loan book. And at the same time, they also said that the legacy personal loan book is also something which is causing this trouble. But as a result, profit increased only by 2% on a year-on-year basis. So definitely, there was some kind of positive and negative here. Second, let's talk about IDFC First Bank. When we look at the loan book growth, that remained very strong at around 21%. But here as well, we saw net interest margins declining almost by 24 basis points on a sequential basis, which was a bit higher than the street's expectations. As per management, they said that net interest income will increase from second half of the year. And at the same time, when we look at credit costs, now they have seen a surge of around 26 basis points. Remember, this credit cost surge is coming up from the non-MFI segment. Now, they have highlighted that the MFI segment is actually easing in terms of credit cost, but the non-MFI is something which is causing the pressure here. Lastly, let's also talk about SBI cards. Now, when we look at the numbers here, now credit cost has gone up almost to 16 quarter high to around 9.6%. In fact, management is saying that the credit cost will remain elevated to 9 to 9.6%, and they have attributed this to the change in the assumption of ECL model. But at the same time, the growth number that has also been revised downwards from 12 to 14% to 10 to 12%. So definitely a negative commentary, as well as numbers were also weak for SBI cards here.
All right, thanks a lot for that, Gaurav. Quick recap then of all the top stocks we covered. The ones with positive news flow, CDSL and Premier Energies, while the ones with negative news flow, TCS, Kotak Mahindra Bank, SBI Cards, Balkrishna Industries, SAIL and Tata Chemicals, while you have Bank of Baroda and IDFC First that may open mixed. Take a short break, come back, we'll get into further detail on all these names. Some fundamental analysis lined up with Prakash Diwan. Also, the management of E-Clerx will be joining in to detail their quarter one numbers. Welcome back. Hope you're having a good Monday morning. Well, as promised, Prakash Sivan, market expert, joins us on the show. Hi, Prakash. Hope you had a rocking weekend. Well, but the earnings weren't so rocking. Let's talk about the big boy from the banking pack, Kotak Mahindra Bank. Out there were two disappointments. One was on the credit cost, which was higher than expected, and the other point was on the NIMs. The contraction was higher than expected. Obviously, it recovers in the coming quarters. But what's your view on the stock?
Good morning, Nigel. So I think, the numbers from Kotak are actually ambivalent. I mean, it depends on how you look at it, what lens do you use. The NIM compression, of course, has been explained very clearly because of the shift largely from unsecured to secured loans, which is good. And then if you actually see the pre-provisioning operating profits is actually very good. So what's happened is they've probably been a bit overcautious again, kept some money aside, provisioning is slightly higher. And they've talked about that, stress in the CV portfolio, which they'll address. So I think it's, while there is disappointment, it probably is very well set to kind of take, benefit of the credit expansion that could probably happen in the next few quarters. Maybe not this current quarter ending September, but beyond that as the festive season kicks off. So I think I would believe the numbers aren't so bad. And what do you do with the stock? If you have a slightly longer term orientation, I think an opportunity to buy could emerge on dips basis sentiment, which probably is going to be weak today. So it's definitely stronger than before in terms of what it gives you on the risk reward. I'm not saying the numbers are strong, but the risk reward is probably much more, in favor of the reward at this point in time.
Right. Prakash, good morning. The next one, of course, is, relevant from a stock point of view also, but it's such a, almost an emotive kind of discussion, right? IT and TCS in terms of what they announced in terms of the, cut to the workforce, global workforce spread out over the next 1 year or so.
Right.
Rima is joining us. Nimesh is here. Of course, Surabhi, Nigel and Prakash, of course, are with us as well. Let's just get the news first out of the way. By the way, we discussed this on Editor's Playbook on last week. I mean, you can go to CNBC TV18 Access and, we spoke about it for about 35, 40 minutes before all this happened. So, in a way, was very, very timely to have that discussion. So, lots of perspective there if you want to check it out. But Rima, take us through this one in terms of how the street is viewing this.
Well, let's just start with the news, right? And the big numbers. So India's largest IT company, TCS, the bellwether for the tech industry, is cutting their headcount by nearly 2%. Now, on an employee headcount base of 6 lakh plus, we're talking about 12,000 jobs. Who will be affected? Mid to senior level, and this will play out over FY26. Now, the company in their press release says that this is about making TCS future ready. But in an interview to Money Control, Kriti Vasan, the CEO, said that it's not about AI and it's not about hiring less. The key problem is a demand skill set mismatch. Right? Over some time now, TCS has been reskilling and upskilling their employees and trying to redeploy them. But in some cases, this redeployment was not possible, and those people have been given the pink slip. So the basic problem is a skill set mismatch in the current AI automation age. But you can't forget that demand has been slowing down. Things are uncertain. Margins have been under pressure. The company itself has been fairly cautious. Remember, they deferred the wage hike, and it's rare coming from TCS. Global giants have been cutting down their workforce. So this year itself, Microsoft has had 2 rounds of, axing. 15,000 employees have been let go. There were reports that IBM, about 8,000 employees have been let go as AI has taken over the HR function. It's happening globally, but it's never happened in India. And it's never happened with, say a company like a Tata Group company like TCS. So which is why it sent a little bit of shockwaves. From a market point of view, the analysts I spoke to, they kind of said that, they've done the hard thing. So, there will be some margin savings, but this is more of a human story and not so much of a number story to, what happens to their wage bill and hikes, etc.
Yeah, absolutely. I mean, so the math will obviously go in favor of margins. You just save that much on salary costs. But the bigger question for the market is whether this, heralds a new pivot, a new way of thinking or not. Nimesh is joining in. Nimesh, we were discussing exactly this last week, right? And maybe we don't have the answers. In that press release, if they'd mentioned a massive, some big move on R&D, on AI or an acquisition, I would have been maybe happier. But that's missing. Your thoughts?
Well, Selby, we discussed this, right? And one of my thought was that maybe, and we've seen in the past as well, whenever Indian companies are pushed to the wall, they react. Maybe this is the first reaction from the biggest IT company, which is TCS, cutting down 2% workforce. So again, it's not about AI or just cutting down the workforce. I think it's more about growth and priorities to be set. And I discussed this, right? If it's not a 1 quarter or 2 quarter phenomenon. If you just look at last 10 years of data for these large cap IT names, all the 4-5 large IT companies have reported just single digit top line growth and bottom line growth. So clearly there is a bit of a mismatch. Of course, all these stocks haven't got derated only because of the cash that they have and the dividends as they pay. So I guess this is the first step by TCS. Again, the priorities has to be set, and maybe more has to be invested in the future businesses. So again, I think it's a first sign of one of the companies pushed to the wall and reacting by cutting the workforce. So that's my first bet on TCS cutting down the workforce.
Okay, this is as so many angles to this one, but as that data points out, we've been in slow phase for a while, right? Slow growth phase for a while. And hopefully, as Nimesh said, back against the wall, things will change, and we'll talk more about this one. But these are large organizations, 6 lakh people, over 6 lakh people, right? You got to
Indian top 4 IT companies hire more than 1.4 million, right? Yeah. Out of which, of course, 60 lakh is coming in from TCS itself, but large organization.
Yeah. And so that is one kind of view out there, that difficult to pivot large. I mean, it's like a 36, 40-wheel trailer truck. It's difficult to move it around. But there are ways to do it, and I think we've discussed that. As I said, we did a full 30-40-minute episode on the editor's playbook. You can find it online on CNBC TV18 Access. And of course, here on television, we will continue this topic through the course of the day. Prakash, any thoughts here on TCS per se as a stock for our viewers this morning?
I think, Prashant, this was kind of inevitable. We could see it coming. Large cap IT has been sluggish in terms of most metrics, particularly growth. Now in hindsight, of course, we can surmise a lot of things out of this, saying the cash should have been used for some smart acquisitions, promising futuristic acquisitions in AI and robotics and all. And mind you, there's lots that's available in Europe, particularly. Ask any investment banker, and there is a significant deal pipeline, although a bit smaller for some of these large companies to dabble in. But they'll have to rework the strategy, and maybe if it's not AI, it's about a mismatch, a skill set mismatch. Keeping a bench like this is going to get redundant, So this is going to happen to other companies also. So the signal is some of the other largest companies will also have to rethink on their strategy in terms of the bench. But TCS, I think it's most of it is priced in. There's been disappointment on a lot of counts in the last month or so, including the numbers. So I don't think there's too much of a reaction, except for a sentimental dip which you could get in the markets.
Yeah, let's see. Prashant, on the point that it should be largely viewed positive by the market, but there are the outliers as well. For instance, I was looking at what Jefferies is saying. They're saying in the near term, this cut could lead to execution slippages and higher long-term attrition as well. So, we'll see how this plays out. But yeah, mathematically speaking, you just save on salaries. And that to that extent, obviously, it's
based on this, the point is, should you trade TCS based on the news flow? My answer is no. I mean, it just sparks a larger debate, which is what we're having in terms of, and that debate that we had on
about what is the future sort of direction.
Yeah, based on this, I mean, if you really are focused on taking a trade, I mean, that's like a bit of a forced thing.
Absolutely. In fact, let's take that forward with the management of E-Clerx. E-Clerx, of course, we have to talk about the company's first quarter numbers, and one of the few companies that have reported at least growth in Q1. We have Mr. Srinivasan Nadadhar, Chief Financial Officer at E-Clerx, joining in. Srinivasan, great to have you on. I mean, before we get to your numbers and the performance, which has actually been fairly okay, just your comment on, it's a big move by the industry titan, right? So does it herald more such rethink when it comes to workforce utilization and optimization? What is your approach, and how would you interpret this development at TCS?
So I think looking at Mr. Krithivasan's comments, it seems that it is not AI related, and that is how I would interpret it as well. Because if had it been AI related, you would have seen more jobs being cut at the lower end of the org structure. So it probably is just a bit of being more efficient and optimizing the organization. And to that end, I think it is a good move for TCS.
What is your thought on this? We'll come to the numbers in just a bit, but let's talk just how you're looking at employees, wages, salary, and what that is doing to your HR structure. As I'm sure you're also looking at better ways of infusing AI in all the services that you're delivering, and maybe your own workflow as well.
Yeah, so we are much smaller than TCS, and we've always been a little more as focused on margin, if not more than most other companies. But having said that, we do constantly look at what the employee mix is and what they are doing and how it is possible to optimize. So this is something that is more continuous for us. Our scale is, of course, much smaller.
All right. Yeah.
Yeah.
You'll complete that point.
Yeah. So I was just saying that both internally and externally, we look at where we can deploy AI. And externally, we are trying to infuse it in our productized services. That's for making sure that clients get a productivity benefit. And internally, we are trying to implement it, and it becomes more of a testing ground to see what is possible through AI.
Indeed. Hi, Srinivasan. Good to see you, Ben. If I look at the trajectory, your employee count actually has hit the highest in the last few years. So you have clearly, recruited quite a few. Let's get to a couple of numbers then. Your new deals, I think, that you have signed. New deal ACV, that slipped to around $32 million. In the previous quarter, it was more than $40 million. Some softness, and will this number recover in the time to come? So I wanted an outlook on terms of a quarterly run rate, what we should look at. And the second point is on the margins, more or less steady at around 19.5%. You've mentioned in the past that you gradually like to scale up this number. In the near term, what is it looking like?
Okay, so second question first. So usually Q1 is the lowest for us in terms of margins because of the wage hikes effective April 1. So everything else being equal, we should see this number go up from Q2 to Q4. Whether there will be more broad-based expansion in the overall margin profile, I think it's not fair to comment at this stage because we may prefer to reinvest in the business rather than expand margins. So we'll see how that plays out. And to your question on deal ACV, there always tends to be volatility in those numbers. So some quarters, maybe there is some large deals. Other quarters, maybe that pipeline needs to build up. Overall, on a year-on-year basis, I think the number has gone up. So we are pretty happy with that. We also see that the pipeline continues to be as strong. So as much as we are converting into sales, I think more pipeline is getting replenished. And we think that overall for the full year, the ACV should be better than the full year FY25 ACV of about, 140 million or so.
Okay, all right. Just to push you a little bit for the number on margins, as you said, you'll have to take a call whether to reinvest or, focus on improved margins. What is the targeted number? In the past, I think you've indicated you want to gradually go towards the mid-20s. You can correct me on that. But in the near term, what should it be? For this year, last year, if I look at it, in Q2, your margins recovered to 22%. So from here on, what is it likely to look at? And also in terms of growth, the top 10 clients, actually, the growth has been a little bit subdued. While out of the top 10 clients, the growth has been much better. How do you see this panning out?
So again, second question first. So we are actually pretty pleased with the growth in the emerging clients or the non-top 10 clients because that's been one of the focus areas for us. Okay. And as you are aware, top 10 concentration for us is about 63%. And stated objective of our firm is to get that down. And in the prior 3 quarters, I think top 10 grew much faster. Not a bad thing, but ideally not. We would like our non-top 10 to also grow. And we are happy that that's been achieved in this quarter. On your first question, we look at EBITDA and not EBIT. And on EBITDA terms, we want to be in a range of 24 to 28, and this EBITDA includes other income. Today, we are at about 24.8, that was Q1. And as I mentioned, this probably will go up from Q2 to Q4 as the impact of wage hikes subsides. Last year, we were right in the middle of the range, about 26%. So we'll see where we end up.
And Srinivasan, very quickly, some sense of top line growth. I mean, this quarter has not been bad at all. Constant currency, you've grown more than 3%. For the rest of the year, looking at your deal pipeline, your conversations, give us some indication, maybe some kind of a rough range if possible.
We don't give guidance, so range is not possible, but we can comment about the near terms. And near term, we do see enough pipeline and conversion to state that there will be sequential growth in Q2. Beyond that, it's hard to comment.
Okay, all right. We'll leave it there. Thank you very much for joining us. Good speaking with you. It's a pleasure. We'll take a quick break here. We are back. There's about 9 minutes to go for the pre-open session. Sudarshan and Mitesh are with us with what they'd want you to do in terms of trades coming up. Okay, welcome back. Sudarshan and Mitesh are with us with what they want you to do in terms of trade this morning. 5 minutes to the pre-open. Sudarshan, you go first. How are you thinking about the setup?
Yeah, good morning. Well, last week, my view was that we will drift towards 24,500. That view continues to persist. Now, after a big decline, it is possible that the Nifty may see some kind of a relief rally. It's very difficult to anticipate that, when and how that will happen. But the broader view is that we should slowly come down to the first support levels of 24,500. So there is really no trade in the Nifty, Midcap and the bank index in any of the three. Because first, we could be choppy, and secondly, we could be drifting down. Focus on stocks.
Mitesh, same index view first?
Yeah. We have been calling for levels, possibly, on the lower side once we kind of drifted below 24,900. And the idea was that we might actually decline to about 24,550, 600 to begin with, maybe even 100 points lower, because that's where the cluster of supports kind of kicking on the medium-term charts. So I would still be wanting to take sell positions on bounce backs. Now this market, in the short term could be sell on rallies. The levels on the upside would be closer to about 24,950, 970 zones. If you get there on the spot, take a 70, 80 point kind of a stop and take bearish position, which could be buying into put options or selling futures. Similarly, on the Bank Nifty, the first level is close to about 56,000 and 200 odd. But in case we start breaking below that, good chance that we are looking at 58, 800, 850 zones.
Okay, sell on rallies in the short term, that's the view. We'll take a break here, have to do that. We'll come back into stocks with both Mitesh and Sudarshan. Stay with us.
Welcome back. So 15 minutes to go before the trade kicks off, and it's slightly subdued as far as the implied open is concerned. Let's quickly get to the stock calls as well. You've just heard the advice on the indices from both our technical experts. Good morning, Mitesh and Sudarshan. Let's talk about stocks. Sudarshan is saying stay away from the indices. So Sudarshan, stocks then?
Well, there are always some stocks that can do something. So IDFC Life is a buying opportunity with a stop under 745. Sun Pharma is a buy with a stop under 1665. I also have Indian Bank, and there are some movements going on in PSU banks, can't say why. But Indian Bank is a buy with a stop under 625. And finally, an intraday short is Procter & Gamble, PGEL. Sell it with a stop above 817. It's always intraday if you are shorting.
Mitesh, what about you?
I have a mix of buys and sells. On the buying side is Max Health with a stop at 1260 for targets of 1320. Cipla, I think that's a buy as well. Big breakout on Friday. So keep a stop below 1514, look for a first target of 1570. And on bounces, sell into CAMS around 40.50. I think it's just close to about 15-20 points lower from there. So around 40.50, sell CAMS with a stop above 4100 for targets below 39.50, and BSE, that's a sell around 24.70 with a stop at 25.11 for targets of 23.85 or thereabouts.
Okay. Got that. So those are specific trades from both Sudarshan and Mitesh. Mitesh, just a quick view on Eternal. Eternal was the big winner last week, ended 21% higher. I mean, by far, right? That was the big one. Reliance on the other side, I mean, lost about, slowly, it was a drift down, ended about 6% in the red. And I want a quick view on IEX as well. Despite Friday's big bounce, stock was down 28%. So in that order, Eternal, Reliance and IEX.
So Eternal, disclaimer, Prashant, I have it in my personal portfolio. So there's vested interest. I think the chart pattern is very good. It's completed what we call a rounding formation. The highest weekly closing, which the stock had prior to last week, was around 303 way back in December 24. Went down to about levels of 200 and now has completed a full rounding formation, closing above this 303 level. So as long as you're above this 303, 295 zone on a weekly basis, good chance that the stock is heading towards 350 plus in the next few months, maybe even a smaller time frame. So very positive over there. Reliance, if I come to it, I think, the stock has done a good part of correction. It's trading near the first support levels of around 1380. It could bounce back to around 1440, 1450. My idea would be to take some profit, get out of these positions if you have on the long side, because the medium-term structure is slightly turned weak. So around 1440, 1450 is an exit, and we might actually see this correction play out all the way to about levels of 1310. And the third stock I forgot, sorry.
IEX.
IEX, correct, yeah. Again, a very negative setup on the medium-term charts. That breakout was huge, though I think on Friday there was a pullback. But, around 150, 155 zones, you will see strong supply. And with that big gap there, I think the push is clearly on the downside. The stock could retest the lows of 130, maybe head towards 120, which is where the stock had bottomed out in July of 23. So I think I'm looking at a strong chance of stock heading towards 120 with the supply coming in around 150, 155.
All right, Mitesh, thanks very much. Sudarshan, thank you very much for joining us with those trades. We'll speak again with more trades at about 9:10 or so. Now, US and European Union have, of course, reached a trade deal. We started with that this morning. Tariffs of 15% on all EU goods imported into the US. Sudarshan is joining us to talk about, he's been running us through the implications for various sectors because of the India-UK FTA. We did that late last week. So tell us more.
Good morning, Prashant. So over the weekend, we have heard from US President Donald Trump as well as European Union President about both the US and EU have reached to an agreement for the trade deal, and that would be a relief to almost $50 billion exports of cars that EU does to the US. And now the tariff rate would be 15% for EU exports. That would be lower than 20% that Trump had initially proposed. And it would be lower than his threats of trade tariff in the range of 25 to 30%. But do remember that ahead of April 2025 for EU exports, that basically car exports, tariff used to be 2.5%. So this 15% would be higher than that, but still it's a relief because it's lower than what all Trump used to talk about the tariff. Now, why is it positive for majorly two companies, Tata Motors and Samvardhana Motherson? So first, US accounts for almost 30% of total JLR's global volume, and JLR accounts for 70% of Tata Motors' revenue and almost 80% of its profit. Now, biggest Land Rover plant for JLR is in Slovakia. That comes under Europe, and two major products, basically two high-volume SUV models that Slovakia manufactures are Discovery and Defender. So now these are high-value products and basically high ASP products, so it would be a relief. And JLR, because of this tariff, had reduced its EBIT margin guidance for FY26 to 5 to 7% versus its earlier target of 10%. So we'll have to see after this certainty, at least for now related to tariff, if JLR again increases its guidance. Now, second stock is Samvardhana Motherson. It would be indirectly benefiting because it's one of the leading auto component manufacturers to global automobiles, especially in Europe, and those companies export to US. So for Samvardhana Motherson, 40% of the US revenue that company gets is tied to EU exposure. Now 15% tariff cap versus earlier higher levels at least reduces potential margin expansion. So as per the JP Morgan estimate, JP Morgan had expected 5 to 10% EPS hit if tariff of 20% or more than that had sustained for EU. So basically, because of these factors, it would be majorly positive for both these stocks.
Absolutely, and thanks for putting that on the radar, Sud. That's pretty important, considering Tata Motors has been competing with IndusInd Bank to take the top honors of the worst performing stocks on the Nifty in the last 1 year. IndusInd is right on top with a 40% decline. Tata Motors is next with about a 38% decline. Actually, speaking of declines, before we talk to Prakash about these stocks, Kotak Mahindra Bank 5% lower and TCS 1% lower. These are major reactions that are playing out on the earnings front. Shriram Finance, I'm yet to see a pre-open number. Maybe we can flash Shriram Finance as well, which is relatively much better than the banking numbers that we've seen. But Kotak has had a bad quarter, margin pressure, credit cost issues, etc. More on the banks in just a bit, but let's complete the point on autos. Prakash, hi, morning. Like I said, Tata Motors has been struggling for a year. Now that there is good news finally on global tariffs and what should explain the interlinkages for their top models, JLR models, any point in being a buyer with this kind of a decline?
So, Surbhi, I think Tata Motors, you rightly said, you need to look at it as a global player. There's no more much of, what they do in EVs and CVs and all here. And from that perspective, one of the biggest bugbears for them is also China. So if JLR sales, elsewhere in Europe and all take off and things start looking up, you also need to make sure that the Chinese competition doesn't kind of impact them at some point in time. Right. So it's happened in the US, but because of the tariff uncertainty, there's no clarity in terms of where they'll probably land up in terms of market share and all. So, if you're okay with digesting the ups and downs, the volatility in the underlying business, it definitely is a great story. Other thing that's going to happen is as they kind of get to leverage, enjoy the debt-free or nearly debt-free status, things could look very different than what they've done for the last few years. And that balance sheet kind of will start helping them grow in certain pockets much faster. So yeah, it's a good story, but very long-term in terms of orientation is what you need.
Okay, all right. Thanks a lot, Prakash, for joining and giving us all those views. Good day ahead and chat up with you during the course of the week. Well, let's get back to Sudarshan, who's here to give us his 9-10 call. Sudarshan?
Well, I think the best trade is to go short in PGEL and keep a stop loss, which I have already specified, but keep it intraday.
Okay, all right. So we'll keep an eye out on that. That's PGEL, right?
That's right.
PG Electroplus.
Yes.
Got it. All right. I think we should get the other stock up for our viewers on the screen. Mitesh joins in to give us his 9-10 call. Mitesh?
So, I'll go with a sell on CAMS for targets of around 39.50. It might open a bit gap down, so you might want to sell it once there's some kind of a pullback.
Okay. All right. Got that, gentlemen. Thanks very much. By the way, we have enough casualties to deal with. Look at SBI card in pre-open, 6% higher. Gaurav pointed this out, that instead of falling, as the management was guiding that their credit costs were supposed to taper off, suddenly they've risen. They've risen to a multi-quarter high. Market doesn't like any concept of asset quality issues. Flip this with Kotak Mahindra Bank. Kotak Mahindra Bank is down still 5%. And the others as well, Bank of Baroda as well, because there are lots of ifs and buts in all the numbers. Even if loan growth is good, there's an if coming in terms of either margins or asset quality. That's the problem with the weekend bank numbers. Let's discuss this and more with Shweta Daptardar, Vice President NBFCs at Elara Securities. Shweta, we'll talk about NBFCs and Shriram in just a bit. But just first, a word on the banks, because now Kotak has come out of the blue as well. This rise in credit costs and, the sharper, margin compression as well. Your thoughts?
Yes, Surabhi, morning. So it's been a little tough week for the entire BFSI space. So yes, Kotak Mahindra Bank uncharacteristically has put out a very soft quarter. Largely, the slippages have emerged from the MFI and CV side. But if you, it's a compounding story. It's a long-term story. Is what we believe. They are still, the balance sheet is still capable to absorb the overall softness that we saw and still put up 2% ROA. So we have an accumulate rating, but yes, industry-wide, certain pockets, the stress signals are definitely pretty pronounced.
Okay, so your rating is accumulate on Kotak Mahindra. Very quickly, SBI card, that's the other big disappointment, right? We thought things are improving and everybody was saying how unsecured stress is now ending. Well, not showing up in the numbers.
Yes, definitely. So SBI card was a disappointment. And we also have to come to the terms to the fact that it's not just the credit quality or credit risk led challenges, but this time around we saw the shift is now towards business augmentation impediments. So while management has revised downwards, the guidance also on new cards addition. So apparently the quarterly run rate was 1.1 billion. Now it's down to 0.9 million. Juxtapose that with also the loan receivables growth, which used to be around 12 to 14%, that is down to 10 to 12%. And as you rightly pointed out, the elevated credit cost, which is 60 bips higher just in a span of 3 months. So yes, definitely this the signals are poor, but we also have to understand that this is also the part of customer cohort of 2023-2024 portfolio, wherein the concerns are still lingering and that is impacting the asset quality. Also, the new portfolio formation, which is aligning with the desirable behavior, that is still not a significant portion of the overall loans. So definitely that positive impact will come with a lag. So in the interims, yes, the stock will remain under pressure.
And Shweta, very quickly, Shriram Finance, let's talk about some good as well, because at least there, I think their credit cost issues are controlled. But this whole margin compression, I know that it's something to do with the excess liquidity that they're holding. The management is saying margins will normalize. It will come back to 8.5%. Would you go with that? Would you believe that?
Yes, definitely we believe that, and it's see, margin pressures partially has also been the result of the higher liquidity on the balance sheet, which is carrying, which is leading to negative carry, and therefore that is leading to the softer margins. But there is another aspect to it. See, larger part of uh, uh, book of Shriram Finance is vehicle finance book, which is fixed rate book. So it's not agile enough and does not react positively to the rate cut scenario. But yes, definitely, second half augurs well. They have been focusing on the lending side on smaller tenure portfolios such as gold loans, SMEs. So accordingly, the liability side will also turn sooner or later nimble enough to show some margin improvement. So yes, second half will be definitely better than first half. But the margins is definitely not a concern. In fact, Sriram commentary has also been steady and stable amidst a lot of negative noise. But we do believe there are certain pockets showing pressures on MSME finance in entry level CV segment and of course credit card space.
All right. Shweta, thank you very much. Good speaking with you. Appreciate your time here and those insights as far as some these financials are concerned. 50 lower on the Nifty and about 160 down on the Sensex. That is the end of the pre-open session. And in just a couple of seconds, we'll have the actual market open rates coming up. We'll spend under a minute on the indices, and then we'll get to stocks very, very quickly. So it's down 0.25%, 24,785 on the Nifty. You've got the Nifty Bank, which is down about 0.4. Bank Nifty on your screen. The mid-cap index is down 0.25, and the small-cap index will come up on your screen as well, right out of the gate. So it's down 0.33%, 24,760 on the Nifty. Nifty heat map gives you a quick sense of how we are starting, and then we'll get into individual names. There you go. It's largely, actually, it's kind of split, right? Many stocks are still opening up, but I can spot some more red than green, at least right to the word go. Surabhi.
Okay, remember Tata Motors? Sudarshan was just telling us about how things could get so much better, or at least easier, if not better, for JLR, because some of their main plants are located in Europe. And now with this 15% tariff being settled, Look at the stock fly. And again, its positioning, what we were just discussing, it's the worst performing, or well, the second worst performing stock on the index in the last 1 year. And now there's a trade going on, 700 on Tata Motors. Cipla, there was some positive brokerage notes after the earnings over the weekend, so that stock's holding higher. There's ICICI Bank, there's Aisha, but the overall picture is negative. The Nifty is down 100 points almost. And the casualty comes in from both BFSI as well as IT. So the market is not reading TCS's job cut as positive. Yes, mathematically you can add up and say that it saves X amount of cost, but is it a bigger indication of the pressures that lie ahead? Look at what's happening to IT stocks. TCS is down 1.5%, Wipro is down 3%, Infosys is down 1.2%. HCL Tech also lower. So all of IT has been slammed because this market is seeing this as an indication of the environment that the companies are in. Kotak Mahindra Bank is the other big casualty. We've been saying this since morning that, it's been a real negative surprise from Kotak on most fronts, margins, credit cost, asset quality, and the market wasn't prepared for it. 5% lower on Kotak Mahindra Bank. So those are your two hits. Bajaj Finance also on the lower side, Axis Bank on the lower side. IndusInd Bank is reporting numbers today. It's down 1%. So the twin engines are not firing, neither BFSI nor IT. Let me check Shriram Finance. Stock is flat to slightly positive because of all the BFSI earnings over the weekend, the best in class has actually been Shriram Finance. So you're seeing some specks of green on it. But otherwise, it's a tough opening. 100 points lower now on the Nifty, Nigel.
Well, that's right. A few stocks, though, are outperforming from the broader markets. Just to pull up a few of them, Orient Cement, the EBITDA per ton came in at its highest that we've seen in 16 quarters. They've returned to growing ways. The Ambuja parentage clearly is playing out there. However, a couple of costs, like other expenditure and employee costs, are down by around 17 to around 18% on a sequential basis. And the street continues to fear what happened with Sanghi. Will it happen with Orient as well? Because there's a valuation comfort, but ultimately it could get folded up into Ambuja Cement. So that's why that stock is not running away. Otherwise, the stock would have been much higher in reaction to these numbers. The street is taking into account what could happen going ahead. The other couple of stocks that I'm looking at, SAIL. That one's lower. The numbers were disappointing. In a quarter that we should have seen some kind of growth on the EBITDA front. Actually, that's not come up to expectations. But the stock is down only 2.5% because, as we mentioned on Friday, the street was sniffing that the numbers are going to be weak. So that's why that one, in fact, is down only around 2.5%. Acme Solar, the stock is flying away. The street is liking those numbers that we've seen, and that's why that stock, in fact, is up and about in today's trading session. Good growth, good profitability as well. That's doing well. Sai Silk as well. I think we should get that one up as well. That one as well has opened up with some good gains this morning. So that as well in reaction to its numbers. Both of them, in a market that's wobbly, these stocks are actually flying away. So the market's willing to reward good numbers. Manorama, another one that's already seen a big run in the last few years. It's up another 7% as we speak. Just take a look at the beautiful move that we're seeing on that name. And remember, these are stocks that have already done well. Aadhar Housing from the housing pack as well. That stock has seen a good run. So, though we're talking about numbers not being too good and the earnings season being a little bit subdued, well, I've named 5 to 6 stocks actually this morning that are actually reacting with gains of around 5 to around 8% in today's trade. So, I think, Prashant, you need to be a little bit selective. It's not that the earnings season is just throwing up all sorts of negative surprises. There are select names, particularly from the broader markets, that are actually doing well.
Number one volume-led gainer on the NSE is Sharda Cropchem. Sharda had a massive move on Friday.
20% up.
Yeah, it was, so basically last Thursday stock closed at $900. On Friday it closed at almost 1,100, right? So Sharda Cropchem, almost 1 million shares out of the gates, right? And its stock's up about 3.5%. That's a big one. Orient is picking up on the back of those numbers. 5% now. It started slow, but 5%. So 263 is the second largest volume traded gainer. Look at Aadhar Housing. Aadhar Housing Finance is up 7% and humongous volumes for this point in the day. 1.2 million shares on Aadhar Housing. Third largest volume-led gainer right now coming through. There is Reliance Infra, which is coming up about 2.5–3%. Last few sessions, stock has been under pressure. Highs were about, 430, 440. And it basically hit a low of about 330 or so, but starting to come back up. Volumes are high. Poonawalla FinCorp, I think we mentioned it, 2.5% higher. Sai Silk, Nigel mentioned. We have Wockhardt Pharma. There was that flash at the bottom of the screen. about this. I mean, their sort of novel antibiotic, which of course many people are betting on big, which is apparently in UK, some of the tests have proven to be very effective. So more on that later, but 3% higher. Stocks cooled off from 1950, which was the high. Stocks at about 1720, but up today. Kajaria Ceramics, Eris Life Sciences are some of the other names which are coming up. But volumes start to thin out very, very quickly. You know, I was asking Mitesh about IEX, and Mitesh was saying that probably it head back to 120 eventually. IEX is down 7%. So that Friday's 10% move is completely getting reversed this morning. And that's huge volume. So $10, $11 lower on IEX coming through. And I mean, so many others, right? I mean, Kotak Bank we mentioned, SBI Card, Lodha, SAIL, GMDC, all in the region of 3 to 5% cuts at this point in time. Pankaj Murarka is with us, CEO and Chief Investment Officer at Renaissance Investment Managers. Pankaj, good to have you back on the program. Thanks very much for your time. At the margin, you think this, if there is an interim deal, India-US, it provides, will that be seen as a bit of a trigger? And I'm only asking you this because over the weekend we learned from sources that they're not ruling it out. At least government sources are not ruling it out. And that perhaps because if you don't get an interim deal and then talks continue on a wider deal, perhaps the rate reset is pretty steep. I mean, that 10% base plus 26%. We don't know if that is going to be the rate if we don't get an interim agreement in place. But do you think that is also kind of weighing in? And if that deal is, an agreement is signed, it acts as a bit of a trigger? Pankaj.
Morning, Prashant. It's anybody's guess which way this goes, whether we get an interim one or a full-scale deal. But I still believe that eventually, irrespective of the fact whether we get an interim or not, even if there's some higher tariffs in the interim, I still think there could be a carve-out in terms of extension if they're not able to reach a deal with India. And eventually we get a deal and probably we get a tax treatment or a tariff structure which is similar or slightly lower to some of the other bilateral deals that US has done with the larger trading partners, including Japan and European Union. Net on an aggregate basis, I do not think it moves at the aggregate Indian economy level. I don't think so. It moves the needle in the near term over the next, let's say, 6 to 8 quarters from a growth perspective. So the fact is that the economy has lost some momentum over the last year. And probably I would like to believe that there's an economic reset. So if you see post-COVID for 3 years between FY22 and 24, the economy was growing at 8%. Last year, our growth slipped to 6.5%. And I think probably somewhere around 6.5%, the new normal for the economy for the next 2 years, probably this year and next year. Because the pent-up demand that we had accumulated during COVID lockdowns, that has run out of steam. And also, I must say at margin, the government did significant reforms pre-COVID. Probably we've reaped benefits of those reforms and they're already in the base. So probably the economy needs fresh trigger. The government has, I would say, given significant fiscal stimulus in terms of the tax cuts we had in the budget. On top of that, RBI is cut rate by 100 basis points. So that's a very significant monetary stimulus. Combination of the fiscal and monetary stimulus, I think probably we have an injection of $25 billion into the economy, into the hands of the consumers. And I think the next driver for the economy will be a recovery in consumption as this monetary and fiscal stimulus starts playing out or coming in the hands of the consumers from the second half of the year. So,
Hi, Pankaj. Yeah,
sorry,
go ahead. No, you're making that point. You still think?
No, I was saying that probably we have a downward economic reset at about 6.5% growth. And I don't think so this deal will move the needle either way. It's good to have that deal so that it does not have an adverse impact on some of the sectors which have a higher share of exports to US.
Hi, Pankaj. Good morning. Good to see you. And I think that's the uncertain event is something that's plaguing the markets. Once we get whatever the percentage is, at least we can move ahead, right? Uncertainty is behind us. So we'll have to, see how that pans out. But let's talk about the big talking point this morning. TCS talking about pulling back 2% of the global workforce. Now, some would, the commentary, if you look at social media and the likes, is very, very skeptic. But actually, the management clarified it's not AI-led. It's a bit of a mismatch in skill. We'll have to take their word for that. But how do you see this pans out from here on? Now they've bitten the bullet. They've taken the bold call. And, we've seen some of the global peers. You look at Meta, Amazon, when they started those workforce cuts in 2022. From there on, margins started improving. So do you think this is an additional negative? Because as it is, we knew, right, that they're going to grow in mid-single digits for the next couple of years. Your take?
Yeah, Nigel, I take your point. So I don't think so this will lead into any downward revision in terms of revenue growth or earnings growth for these companies. And we need to acknowledge that, uh, for example, when you talk about TCS, it's a very large ship, 6 lakh employees, over 6.3 lakh employees. They do have to and employee is the most important resource or the asset they have, and they do have to manage their resources in terms of demand supply economics. My understanding of it is that at least the tier 1 IT companies have been facing a slightly higher competitive intensity, because for the last few years, at least 2 out of the global top 7 IT players were on a weak footing, and now they've had a new CEO, organization rejig. If you look at Cognizant and one of the other large global players, and they're clearly giving some of these larger tier 1 companies, meaningful competition when it comes to large deals. And obviously, there's a slowdown in the discretionary spends have been held back in US. So I think there are business pressures at margin as far as these IT companies are concerned. But when it comes to valuations, I think as it is, meaning the growth expectations are very modest that are priced into these stocks at this point of time. So I don't see a downward revision to earnings growth or revenue growth, because as it is, as I said, those expectations are very modest. But I think it's a reflection of very tight demand supply environment that these companies are experiencing, especially the larger ones on large deals, which are getting very competitive. And these companies have to manage their ship.
Nigel, I was thinking about this, hearing all our guests and, hearing the TCS story over the weekend as well. I think the one difference between job cuts in the Magnificent Seven and here is that their job cuts are happening because it's a brand new technology, which is boosting growth. So shareholders are saying, okay, fine, we're getting great growth. It's coming at the cost of jobs. It's a new way of doing business. Well, that's the new normal. In this case, like Mr. Krithivasan himself has said, that it's not because of AI. It's not like TCS has hit upon a brand new technology that's going to let the revenue shoot up 20% tomorrow. This is because of tightness, like Pankaj is also saying, deal pipelines are tight. There's probably not that much work for the present skill set. So maybe the slight difference between the job losses globally and over here.
My limited point is it may not be the time to sell. It may not be the time to sell the stock. It is a newsworthy note point and a news point, etc. But it may not be the time to sell because of this. Yeah. That's my limited point.
Only a sentiment issue, but I mean, we'll see. I mean, this is probably the first step.
We get back to the growth, margins, how they're going to evolve the business, uncertainty, spending in the United States. So,
and this is probably only the first step, like, we've been debating and discussing as well, that perhaps there'll be more steps ahead to spur growth. But anyway, Pankaj, hi, morning. To get to the other problem area for the market, that's BFSI. I mean, look at the reaction to Kotak Mahindra Bank. The market's hopes were squarely pinned on banks, that they will deliver and that will keep the market trajectory going higher. But first quarter has been disappointing. How are you looking at the frontline banks? And do you think this is just a passing quarter? We shouldn't get too pessimistic?
Morning, Surbi. Just to chip in onto the last point and to Nigel's point, I completely agree. Just think about it. This kind of job cuts done by TCS, and probably there could be some follow-on by other IT companies. Probably we are seeing now after a gap of almost 10 years. So for long-term investors, when companies get into this kind of a thing, probably a tough demand environment, probably I think for a long-term investor, that's an opportunity to buy and not panic and sell at this point of time, as long as you have a slightly more longer-term view. Yeah, I thought I'll just make that point. Surbi, on banks, yeah, the results have been somewhat weak. I agree this quarter, but that's also because RBI has front-loaded rate cuts to revive consumption in the economy, and given the way the sector is poised, where your assets get repriced immediately and deposits get repriced with a lag, I think it was expected in that sense, except for few banks like Kotak and some other banks which have shown some negative surprise on their asset quality. But I still think that we are in the last leg of it, and that's not an area of major concern. So I would still be positively biased on banks, because I am still firmly of the opinion that we see a cyclical recovery in the domestic economy driven by consumption in the second half of the year, and which should drive growth in consumer loans. Apart from playing direct consumer stocks, whether staples or discretionary, banks is the second proxy play because they benefit out of growth in consumer loans. I would still be buyer into these banks taking a view, which is over a period of a year or so.
Okay, all right. Good to hear your thoughts as always, Pankaj. We look forward to having a longer discussion with you in the time to come. Wishing you a good Monday and a rocking week ahead as well, Pankaj. Well, that said, let's get to our next management, that of Laurus Laboratories. The numbers actually have looked encouraging. Mr. Chava, the founder and CEO of the company, joins us on the show. Hi, Mr. Chava. Good morning. Good to see you again. Well, after many quarters of, trying to find out whether or not the best is ahead, you've started delivering very good numbers now. And the street appreciates that because your margin numbers have now held steady at around that mid-20s mark. But let's get a couple of queries out of the way. The CDMO business, well, from being around 10-12% of the business, it's moved to around 30%. You're clocking close to around 500 crores on a quarterly run rate now. You've mentioned that you want this number to go towards 50% contribution. Could you tell us, in the near term though, for FY26, how much will the CDMO business contribute as a percentage of the mix? And also your gross margins, earlier you were talking around 55%, now you're talking about 55 to 60%. For this year, FY26, what should we work with? Please go ahead, sir.
Thank you. As we have demonstrated the quality of business, our gross margins were always between 55, 57 in the previous quarter. This quarter, because of higher revenue contribution coming from CDMO, the margins were over 59% now. Looking at the prospects, what we have, and we estimate the gross margins will remain between 55 to 60%. Primarily because of higher contribution coming from non-ARV and also increasing revenue share coming from CDMO. CDMO, as you have mentioned, in 2021 financial year, our revenues of CDMO was 500 crores. Now, we were able to move towards 500 crores per quarter. And we estimate the run rate looking good. As you are aware, CDMO business is bumpy, but for the entire year, we expect the CDMO revenue contribution will be over 30% for the entire year.
Dr. Chava, hi, good morning. Thank you very much for joining us. Prashant here. We, of course, discussed the CDMO broader opportunity on that program some time back. But we're sticking to numbers here, right? So there is a bit of a, if I can put it that way, there is a bit of a one-off, right? The cepiapterin supplies in Q1, that is responsible for this 130% jump in CDMO revenues. So it's kind of front-loaded, and these revenues may not reoccur. So could you tell us what are the revenues we should work with for the next 2 quarters?
For the entire year, you can assume we will do closer to 2,000 crores CDMO. I will not give you quarter-wise as you have asked, but we supplied 3 NCEs in the last 2 quarters for commercial supplies. That will continue. So we don't have any one-offs. See, when the molecule goes commercial, they will continue to buy. So they may not buy every quarter, but they continue to buy. So we have a very good pipeline in CDMO, and we expect the traction will continue.
So 2,000 crores, fair enough. We'll work with that number. That's what is useful. You said gross margins, as we pointed out, right? I mean, up big time. And you're saying we should be in this 55 to 60% range, right? Even without this cepiapterin contribution. What about EBITDA margins, sir? I think they were kind of flat even as gross margins expanded because of higher employee expenses. Could you give us a sense on EBITDA front?
See, last year we did close to 20% for the entire year. This year we believe we will be at least 25% EBITDA margins.
FY26, 25% EBITDA margins?
Yeah, around 20%.
Okay. Mr. Chava, you said you've signed 2 new deals for NCEs. Is that what you said? If I heard you correctly?
We supplied.
Okay. So how much of the current CDMO traction, as if you can tell us on a broad business basis, is tied to early stage molecules, etc., and how much is kind of sort of close to commercialization and sort of more mature things? If you can give us a state of play at Laurus right now.
Majority of our CDMO revenues are late phase or commercial. So the revenue contribution coming from phase 1 preclinical is not that significant.
Okay. Okay. It's majority all mature and late stage
Yes.
is what you're saying.
Yeah.
Got that.
Okay, all right. Mr. Chava, I wanted to ask you a question from an industry perspective as well. And since we get to speak to you once a quarter, have you seen any impact of the biotech funding slowdown in the United States? And what could the potential impact be on your business?
See, most of our revenue coming from big pharma, where they have a strong pipeline and they are not worried about funding. As I mentioned, our revenue share coming from small and virtual biotech is not that significant. So any increase or decrease in funding to biotech is not going to impact us significantly.
Sir, just a question. I mean, just to understand your exposure to various geographies, I imagine US is still a very big part of it. But what about UK, where, for instance, now we have an FTA? So I was reading a note which was talking about pharma as being a next big opportunity for the UK because the tariffs have come down so dramatically and our share of exports in terms of the UK pharma market is minuscule right now. There's also the US-EU FTA. So all of these new alliances, I mean, can you tell us if that materially has any positive impact at a margin level or at a pricing level for you?
Our formulation sales in Europe are not that significant. Majority of our European sale coming from our CMO revenues. So we don't have any negative or positive impact at this juncture.
Got that. Could you, Dr. Chava, talk to us again, just to go back to the CDMO business, could you talk to us about the opportunity from, if I've got this correct, this is a painkiller basically, right? Non-opioid painkiller, Suzitrizine, which what is the readiness to produce? I think tenders are going to be out. What is the share that you expect? Just give us some sense, sir.
We don't think any tenders for that molecule, and we can't divulge anything potential of that molecule because of confidential agreements.
So, sorry, you're saying there are no tenders at this point?
That business is in US, so there are no tenders. So you might be referring to some analyst report. They have added 2 sentences together. That's the reason you are thinking this. And they are these tenders, and these are no tenders.
No, this is Vertex's Suzitrizine, right? This is the painkiller where you are apparently, I mean, at least that's what reports say, that you're helping them make it. You're involved in some of the processes. Is that correct?
I think based what market predicts, may be right.
Okay, all right, so very quickly before we let you go, it's been a good start to the year. You have helped us out with most of those numbers, 5,500 crores you did last year. After this good start, what should the broad range be on the top line growth for the year?
As we are not giving any top line...
broad numbers. So can you keep up the momentum we have seen in first quarter?
Hopefully.
So that will be roughly 30% then. That's the derivation that we get from that comment. Well, thanks a lot, Mr. Chava.
Now, can I just, sorry, 1 minute. Dr. Chava, sorry to come back. I just want you cannot talk about it, right? That's what you're saying about this molecule, about this drug.
See, because of the confidentiality and all, we can't talk. See, I think people are arriving at numbers and quantities and supplies based on the export numbers. I think we leave it to them. So beyond that, we can't comment.
I see. Okay. Point taken. I mean, I just wanted to get that out of the way. Thank you very much, Dr. Chava. Appreciate you joining us as always. That is Laurus for you, but I think we have Shriram Finance ready with us.
Absolutely. The positive earning of the weekend. And by the way, speaking of positive, check the market as well. It's looking good. We've recovered almost 90 points from the opening gap down. So not bad at all. And Shriram Finance is actually leading that recovery. 2% up makes it the best performing stock on Nifty. Couple of other NBFCs as well, actually. Bajaj Finance, for instance. SBI Life. So the non-banks looking better than the banks this morning. So let's take the conversation forward. We have Mr. Revankar joining in. Mr. Revankar, great to have you on. You know, the market's just breathing a sigh of relief because you've delivered great growth, almost 17% AUM growth, with improving asset quality and a fall in credit costs. The market doesn't get to hear this too often these days. So therefore, I mean, the stock is trending higher. But tell us, I mean, How confident are you that these trends on improving asset quality, your credit cost has come down to below 2%. You've guided for 2% this year. It's already down to below 2%. Will this continue? Are you confident of not meeting any stress? Because, some people are saying, for instance, MSME, pockets are showing stress. But you tell us what you're picking up from the ground.
Yeah, thank you. Good morning. Basically, you are right. See, for us, the rural and semi-urban are the largest market for us. And the last 6 months, if you look at the recovery in the rural, it has been excellent. Especially the Rabi crop has been the highest ever. And the rural economy has definitely got help because of the Rabi crop and also the MSP price announced by the government. And added to that, good monsoon, an indication that the rural economy is continuously likely to grow because of the good monsoon. That also is helping. So overall, the rural and semi-urban markets are really doing good. And that's really helping us in the credit quality, especially. And I think that will lead to credit growth also.
So, sir, since you've had such a strong start to the year, fantastic Q1, why not increase your guidance? I think your guidance is 15% loan book growth this year, right? And credit cost guidance 2%.
Yeah.
Do you think you can outperform your own targets?
See, we always strive to outperform our target, but we keep our guidance for longer time. We don't want to change it in the first quarter itself. Let us see after second quarter how it is shaped up. Because that's very important, because we also will get output, the Kharif output in September. That will also give us a positive indication. And inflation being low, people have some surplus money with them. That also is an advantage.
Okay, on credit cost, can you just explain to us whether we can extrapolate these good trends from Q1? I mean, your credit cost has come down. I mean, our colleague Gaurav, who tracks the company, tells us that calculated credit cost is already down below 2%. So can you give us the exact numbers and tell us whether this kind of performance can be extrapolated into the future as well on asset quality and on credit cost?
No, it is difficult to extrapolate for a longer time because it keeps changing. Right now, we are happy with the rural recovery, and that's really helping us. But generally, if you look at our company over the last 10 to 12 years, we have been maintaining credit cost around 2%. So that will remain at range bound plus or minus 20 basis point. And we're happy with the current quarter's performance.
Okay, so credit cost, 2% guidance, plus minus 20 bips. Got that. That's quite helpful, sir. And you're retaining your loan book growth guidance at 15% for now.
Yes.
This issue of margin compression, and I understand, that I think you carried some excess liquidity, which is why margins fell more than expected this quarter. Just run us through how cost of funds is moving, because again, you're confident that margins will revive to 8.5% by the end of the year. Just tell us what the factors at play are in terms of your cost of funds and how the book is shaping up.
Yeah, the incremental cost is coming down. The book cost for us is around 8.85. The incremental borrowing cost is around 8.34. So that is really helping. And also, we have reduced the deposit interest rate with effect from August 1st week. That also will bring down our retail deposit cost. So overall, we are expecting around 30 to 40 basis point reduction in our borrowing cost, incremental borrowing cost. That should help us to increase our margin.
This fall in the borrowing cost, 30 to 40 basis points, this will show up in Q2?
Yeah, marginally it will show up in Q2. Okay. Over the period, it will inch up throughout the year.
All right. And Mr. Revankar, for the year itself, you're guiding for around 8.5%, right?
Yeah. Now we are saying 8.5 will reach by year end. But however, we may surprise positively on that.
All right. So gradual improvement in NIMs from year on till quarter four. And by quarter four, you'll be at around 8.5%.
Yeah.
So we've got a few numbers out of there. NIMs moving to around 8.5%. Credit cost should be in that vicinity of around 2%, plus minus 20 bips. What about ROA? I think it's currently at around 2.7, 2.75. You're saying that that heads to around 3%. Tell us what are the levers in store, and are you confident you get there?
Yeah, we are confident that we'll get back to 3%. We are working on our OPEX cost and the credit cost. Both will help us in improving our ROA to 3%.
Sir, I mean, to talk about the first quarter issue, which impacted your margins, I believe you were carrying excess liquidity to the extent of almost 27,000 crores in the book. So what gives you the confidence of deploying this? Where is growth coming in? Give us some color as well on which segments are, really firing up for you. What will play out? What will make you get to this 15% growth this year?
See, one of the biggest credit demand which we had slowed down in the last 2 quarters was the infrastructure. I believe infrastructure will come back and the credit demand will grow there very fast. Because the moment the infrastructure demand goes up, then the bulk means the big vehicles and the construction equipment demand will go up. That will definitely help us. And the rural anyhow is doing well, and further increase in credit growth I'm seeing. So second quarter is very crucial for us. I believe post the August 15, many of the new infrastructure activity will start commencing, and that will create additional demand, and hopefully that we'll be able to deploy our excess liquidity.
Sir, I come back to the asset quality question because we've already given the credit cost guidance. But on asset quality, are you reasonably sure that, stress is well contained? Like I said, some lenders that we speak to, they're talking about pockets of MSME where there is stress. And also for you, your gold book declined year on year. And I think their stage 2 assets have increased. So can you just tell us specifically on gold if there is any concern? Any other asset quality concern in any other sectors?
Gold, there is no concern because the credit cost is almost zero in gold because gold value keeps going up. The stage 1 and stage 2 movement in the gold has no relevance for credit cost. So there is no surprise there at all. So because normally the interest is paid on settlement, and some people delay. That could be the only reason for some movement. Otherwise, there is no. MSME, there are some pockets where there were challenges in the third quarter of the previous financial year. But I think it is now addressed. I don't really see a big challenge in the MSME. But the cash flow mismatches for small business people will continue to remain. We are basically lending to the service and trading community, especially shops and small businesses. We don't lend to manufacturing. So we don't have much fluctuation in MSME.
In MSME. Yeah. So on that point, sorry, I just wanted to, CV you said is doing very well for you. There's no concern on asset quality. Kotak Mahindra Bank cited retail CV stress as one of the major reasons why their credit costs have gone up and asset quality issues have cropped up. Are you seeing anything on the retail side of CV?
No, we don't really see. Because see, the business model, ours is different from that of a bank. We have a one-to-one relationship with each of our customer. So we do have that kind of access to the customer. So we do manage, whenever there are challenges, we do manage. And we also regulate the collection by either visiting the customer or even sometimes taking back the asset. So this helps in controlling the retail portfolio.
All right, Mr. Revankar, good speaking with you, sir. Thank you very much. So another good quarter, and I think that winning streak continues. If I were to it's unfair to look at quarter, but that's, you've got to do that as well. But it's been a fantastic run. Thank you very much. We take a break here. We are back. We have the Lodha Group management joining us to talk about their first quarter earnings and outlook going forward. Stay tuned. You know, from the opening levels, markets, of course, doing much better, just about 20 points lower. That's it, 24,800 is where the index is trading at right now. Let's focus on, some real estate earnings now. Lodha reported a steady performance in the first quarter. Management is confident of achieving that, full year sales guidance of 26,000 crores. So H2 will have to really fire. Sushil Kumar Modi is Executive Director of Finance at the group. He's with us now to take some questions. Sushil, good morning. Prashant this side. So morning, in Q1, you've basically done about, 21% of your guidance, right? 21% of your guidance.
Yes, that's right.
So you're on track for that 20,000 crore plus number for the full year? Because some are saying maybe we've hit a bit of a soft patch here, Q2 and beyond.
Prashant, if you really see our business and the trend for last few years, you would have always noticed that in general, our industry and we as in particular always deliver significantly far higher in second half, because the festivities, which is precursor to our business in a substantial manner, end up in our country coinciding with the second half. So to that extent, in general, 55-60% of the business in any case gets originated in the second half, and we don't see this year to be any different. So pretty much we are on track. We see, first half potentially delivering 40-45% of our business. As you rightly pointed out, 20% plus we have already delivered of the yearly guidance in the first quarter itself. So yeah, we remain on track, and that can also be seen vis-a-vis the fact that our significant amount of the launches are going to be also coinciding in the second half. We launched just 8,000 crore worth of inventory, in the Q1, but the second half and the remainder 9 months will have a significant launch pipeline around 18,000 crore, which, needless to say, we would be more and more coinciding with the festivities to capitalizing on those, auspicious time period when the consumer tend to consummate their transactions quite often.
Sushil, are you having to moderate price increases? Because I think what the results say is that average like-for-like price growth was about 2% quarter on quarter. Now it's nobody's case that there should be. We had a few years of very good run there in terms of price growth. But does this suggest a bit of a tilt towards affordability? Do you have to do that to kind of drive volumes through now?
Prashant, again, this is something very fundamental to our industry, right? The affordability is the key, and thereby we always have maintained that the price growth has to be far more moderate, coinciding with potentially the inflation in the country, and always to track, some bit lower than the salary growth that our country generally sees. So if the salary growth is more in the handle of 8 to 10%, price growth should be more like 5, 6, 7% at best, and which is what you would have noticed again going back in last 4 years. Even last year we delivered around 5% price growth, and that price growth kind of comes across 4 quarters. So to that extent, the first quarter actually is no different. 2% is price growth out of the 5-6 that potentially we target to ensure that the affordability remains robust, and the demand that continues to sit in the country, which to our mind is humongous, knowing the home ownership being so low at this point, should unfold with the affordability being ensured to be intact. And that's the strength of our brand, Lodha, right? We ourselves make sure whichever geography that we are playing, and by virtue of the fact that in any case we are going to be amongst the top 3 players in those geographies or those cities, we have the ability to navigate and make sure that the industry in general ensures that the price growth is far more moderate and ensures the affordability to be robust.
All right. Hi, Sushil. Good morning. Good to see you. When, as you're saying, you're sounding confident about pre-sales of around 21,000 crores for this fiscal, right?
Absolutely.
All right. And the broader, outlook is that you hit around 50,000 crores by 2030. At that point of time, when you go to that sort of a scale, what could the geographic mix look like if you could break it up for us?
Taisel, as you know, that our strategy in terms of geographical expansion is always go deep into any city that we pick up, and rather than wide. And that too, we are always kind of very measured when we enter into any new geography. You can take an example of be it Pune or be it Bangalore that we entered, recently. Bangalore we entered in 2022, but we were very, very moderate. And we ensure and we believe in creating the right set of capabilities, the sales machinery, and the local capability to deliver the business. And once that gets done, which typically takes 2 to 3 years, we get to look for the market share in that particular geography rather than going all out for numerous cities. So that being so, the Bangalore is the city where we entered in 2022. Now this year, we having been satisfied in terms of our local capabilities, the sales machinery, the skill set, the local regulation, we are going for the growth, and which is where we feel confident that in Bangalore market, perhaps we will more than double the delivery or our sales this financial year. And so is the time that we are now looking for another city to be added in the which will go for the pilot stage, just replacing Bangalore, because Bangalore goes for the growth. So potentially the NCR is the one which we are seriously evaluating and hoping that we should be able to tie up the land parcel in this year and thereby launch in the coming financial year. So net, back to your point, by the end of the decade, by the time that we hit our target of 50,000 crore of sales, we would be looking for potentially 40% plus coming from outside Mumbai.
Okay, all right. So, Shriram, just to probe you, since you spoke a lot about Bangalore, and that's one of the IT hubs, right, of India. And news that's coming in today is about TCS going ahead and cutting its workforce, looking at around 2% cut. How much of, the transactions that you'll do come in from tech-related space, if you have a rough number out there? And do you think this will be a bit of a dampener with regard to what's going to happen in the Bangalore real estate market itself? Because some were talking about a read-through. Yesterday social media was a buzz about TCS cutting its workforce. And there were some parts of the market that believe that maybe the Bangalore real estate market could get a hit. What do you have to comment on that?
So Tyson, this is a bit of a dichotomy that we all are seeing, right? So there are certain spaces which are not doing so well, and equally there are a lot many more spaces which continue to do well, and which is where our country's GDP in real terms, we even now, in spite of whatever Trump tariff tantrum and whatnot we speak, is being expected to be in the handle of around, let's say, 6.2 to 6.5%, and nominal terms kind of hitting double digit. So that being so, while one side, let's say the entry-level IT is not doing so well, but equally, as we notice and you also kind of tracks, the GCC is doing phenomenal. So there are numerous facets of the industry which continue to do well in spite of last 3 years not being so good with the IT, and at least from the frontline reading that we pick up. But equally, the demand in Bangalore city year on year, even in last three years, continues to do good, and which is where all the top-notch players, which caters to typically perhaps the audience with salary level, perhaps let's say 10 lakh plus, which is what we cater to, they continue to do well, and the demand for them continues to remain robust. So if the country has to grow, I think the real estate in any case is a precursor, because real estate enables lot many other industries to perform, be it steel, cement, cable, tiles, numerous industries of the employment.
No, absolutely, Sushil, but I think that was a very, very pertinent question that Nigel asked, because the job cuts that we're talking about now at TCS, they're going to be impacting the senior to mid-level positions as well. Let's hope that this is not going to be replicated across the IT sector. When do you sort of launch in Bangalore, and much of the sales are slated for FY26, or is it FY27?
No, so the sales is happening every year. As I said, this year, current financial year, which is FY26, we are going to double our sales, more than double from the last year. So we are expecting to hit 2,000 crore plus of the sales coming from Bangalore this financial year, as against less than 1,000 crore that we delivered the last year. So yeah, we have already launched one more project, and thereby we have 3 locations already up and running. We added 3 land parcels last financial year in Bangalore to look for the growth, and we added one more in the current quarter, the Q1.
Sure.
So yeah,
So 1,000 crores, yeah? You're penciling in 1,000 crores of the sales coming in this year in Bangalore with all your ongoing projects, correct?
2,000 crore. 1,000 crore was last year.
2,000 crores. Got that. More than that. Okay, got it. Thank you very much for joining in, and good luck to you with those plans. That's Lodha Developers, Macroeconomic, sort of their projections for the whole year. Just a quick check on the market. The market has managed to cut down the losses quite substantially. This is despite the fact that big stocks like Kotak Mahindra Bank are still weak, IT is still weak, but there's buying in the two titans, the two banking titans, HDFC Bank and ICICI Bank, some little incremental green over there. The non-banks are doing pretty okay, like Shriram Finance is now 3.5% higher after our interview. Bajaj Finance is doing well, SBI Life is doing well, and a little bit of buying here and there in stocks like Lever as well for some support that's coming through. Okay, let's quickly go back to our, technical setup. At 10 o'clock, we've got Mitesh joining in. Mitesh, what do you make of it? There's a recovery from the lows. Does that inspire any confidence? Any index trades at all?
On the index, no. But on stocks, yes. I think, the idea is that the structure for the indices remains weak. And the Bank Nifty, while also, it's kind of come up from that 56,200 level, which I talked about in the morning. We got a low of around 56,186. I think the Bank Nifty around 56,500, 600 will face strong supply. So, and the structure is on the weaker side. So there's a good chance of us eventually going back to 56,200, maybe breaking below it. So in that sense, on a slightly more higher level, once this bounce plays out, I would even look at shorting opportunities. But on stocks, I have two buy calls right now. SBI Life, I think you were mentioning that. Very interesting chart setup. It's kind of consolidating and suggesting movement on the upside. So buy here with a stop below 1827 for targets of around 1890. And Alchem is the other one. That's a stock which is showing good traction. So Alchem is a buy as well. Keep a stop below 4980. Look for targets in excess of 5100.
Okay, right, SBI Life and Alchem.
Alchem.
Just on Kotak Mahindra Bank, just very quickly, Mitesh, any advice? Any levels to track if someone's already long on the stock?
Post the opening, we have taken some bear spreads on the stock of Kotak. So bought some 2,000 puts, sold some 1,900 strike puts. So very clearly there is a position there for some interest. But my belief is that with this kind of a gap breakdown, the first target should be around 1940, 1942, which is where the 200-day average is. And, in the bad case, the stock can even test 1880, which was a weekly pivot a few months back. We got a weekly closing low of 1876 on the 28th of Feb and similarly 1877 on the 20th of September. So in the worst case, 1880, but 1940 looks to me a good chance. The 200 average should be at least tested.
All right. Lots of stuff moving, right, in terms of single stocks, both up and down. Market breadth is kind of evenly matched, not very much different. We'll take a break. We are back with Manisha on the other side. Commodities in focus. Stay tuned. With I know.
Welcome back. Let's quickly take stock of the commodity market action of the morning. Manisha is here with us. Manisha, what's happening today?
Well, even as we've seen most of the industrial commodities do quite well, what with all those tariff agreements that we are listening in, sense of announcements. But I want to draw closer home and I want to talk about rice right now because there are various headlines coming in for this one. A very positive cue really coming in for the Indian companies here. But I'll start with the numbers first. If you look at the rice stocks with the Indian government warehouses, well, they are at record highs. Remember, we're looking at 2 years of surplus production. And this year as well, the sowing numbers has been quite on the higher side. So when you look at the Indian rice stocks with the government, they have jumped up by 15% in the month of July on an year-on-year basis. They stand at at around 55.66 million tons versus a government target of 13.5 million tons. So this is many times over that you're looking at the rice stocks for the Indian state there. Also, as I said, when you look at the sowing numbers, they have been on the higher side as well. As compared to last year, we're up by 12.5% in sense of sowing at 17.7 million hectares there. Also, it is about higher MSP and assured procurement from the government that leads farmers year after year on sowing higher paddy there. Also, when you look at the export numbers, they have been on the stronger side as well. So while last year was something around $10.4 billion, 2024-25 stood at a tall and near record $12.47 billion as well. Remember, India accounts for 35% of global rice trade or exports, and India did remove all sorts of exports restrictions. That was in March 2025, and the numbers only have been positive since then. Also, apart from that, India does export to almost all of the world, from Asia to Middle East to Europe to West Asia to US. So we are looking at most of the countries being covered here. Interestingly, rice for ethanol, well, we did hear a lot of notifications come in the previous week on this one. So 52 lakh tons of rice is allocated for ethanol production in 2025. Well, 100% broken rice is going for this, and nearly 10% broken rice is sold by the government to the private mills as well. So when you look at the rice availability in the Indian markets, that has been quite well. The stronger numbers, though, come in from the export part of it, basmati and non-basmati, and that is where you have to look at the rice companies in India, which really are laughing their way to the bank. A final word, and this one is on the rice prices itself. So the last week has been quite important because we did see the prices gain up by 2.5%. But apart from that, because of the higher rice availability in the Indian and the global markets, we are looking at prices continuing to decline. Down 2.5% in last 1 month, 10% down in this year until now, and 17% down in last 12 months as well. But the Indian rice exports are, one, competitive. Two, we have great rice varieties, and that gives us an export benefit as compared to various other origin countries.
Right, Manisha, thank you very much for that. That's commodities in focus. We'll come back in just a bit. And my colleague Lata will be in conversation with V. Vaidyanathan of IDFC First Bank, and they talk about the quarter gone by and, of course, the outlook ahead. Stay tuned.
Welcome back. We continue with our earnings analysis. IDFC First Bank has, as always, shown a strong 21% growth in advances and a 25.5% growth in deposits. But profit is down 32% from year-ago levels due to a higher 24 basis point fall in net interest margins. That is a QOQ comparison. Margins have fallen to 5.71%. There has also been a rise in provisions for bad loans, or what you call credit cost. That's risen by 22 basis points compared to the quarter ago. It's risen to 2.78% of total loans. What is important is the defaults in microfinance loans have fallen, but defaults in non-microfinance loans appear to have risen. Joining me to give us more colour on the results is the Managing Director and CEO, Mr. V. Vaidyanathan. Good morning, Mr. Vaidyanathan. Thank you very much indeed for joining us. Many congratulations for keeping the tempo on advances and deposits. But the concerns, I'm asking the concerns first. The rise in credit cost or rise in slippages, it is not microfinance. Where is it then?
So if you see the overall number, Lata, the microfinance has come down as you put it. But the overall percentage of credit cost, about 2.5%, is more because of the fact that composition is still microfinance, like 500 crores out of that is microfinance. So on the rest of the microfinance book, nothing to specifically to call out. You've seen the numbers that have come from the system as a whole. Slippages in the system have actually risen during the last quarter. You've seen results of all companies. I think it's a bit seasonal and, of course, a little bit of microfinance. But the SMA data, which is the feeder data to the NPA or slippages, SMA, that number has actually come down. Last quarter was 1.07. This quarter was 1.01. So we feel the feeder bucket into the slippage will improve in the coming forward.
Fair point. A fair point. Just for those who don't like abbreviations, SMA1 and SMA2 refers to loans, borrowers who haven't paid for 30 days and people who have not paid for 60 days. And that, Mr. Vaidyanathan points out, has fallen by 7 basis points in Q1. And therefore, the feeding into NPAs should perhaps fall. But what is the cause of the slippages, sir? Is it unsecured loans? Where exactly is the trouble? Is it MSME? Where is it?
I know. There are numbers. There are different numbers coming from the system from different players. Someone talked about commercial vehicles. Someone talked about MSME. Someone talked about something. But for us, it's a little more broad-based. That has come. But also, Lata, the main thing to note is also as a slippage percentage sense. In absolute terms, also, percentage sense is also relatively higher for our bank vis-a-vis the system, generally speaking. Also because we do inclusive banking, we do more, if everybody in the country were to give home loans and car loans, really, you need banks like us also who are doing a little more inclusive banking, where the margins also make up for it. If you can see a net interest margin like 5.7% is pretty strong. So as the bank evolves into the next 4-5 years, we'll keep aligning more into the mainstream banking system.
Okay. No, I take your point. Actually, that also intrigued me, and you spoke about this in our previous interviews also. I have drawn up a table between IDFC and Federal Bank. I'm only comparing the two because more or less you are about 2.4 lakh crore in terms of advances, in terms of deposits. So that's why I'm comparing the two banks. Your net interest income is far higher than them because, as you point out, your yield on any loan is higher. But your expenses are also higher. Like theirs is 7,200 crores and yours is 18,800 crores. So operating expenses are higher and therefore your net profit actually, and moreover provisions. Provisions are much higher than theirs. So I just want to understand, what are this cost to income? Why is it higher? Is it because you give more inclusive loans so your collection costs are more?
No. Let's mix. I think I'm mixing up 2-3 things together. Let's talk about one thing at a time. If you see the business model as such, like I said, we do more of inclusive lending, and therefore they give you a higher yield. They also give you a higher slippage and higher credit cost. But that model has been coming for 15 years for us. And truly, if you take the next, it's a stage because this is a startup bank. You initially pay a little more for savings interest rate. You lend a little higher, and that's how you start life. We've come mid-path now, where both have come down for us. If you forward this for 4-5 years, if you see the growth for us is coming from more mortgage and loan against property and gold loans and business banking. So gradually we'll align with the system, so to say. We're also going there. It's a phase. But with regard to operating cost, we'll take a separate question because the bank is setting up just so many things. Federal Bank was maybe set up 100 years ago. So that's been coming along. We have set up 5 years ago. So the setup cost of the model is also very different because it's a 5-year bank, 6-year bank. How do you compare the 100-year-old bank? It makes sense.
No, I agree with you. But, it is not only the branch cost. It looks like even employee cost is higher for you. I didn't put all the line items in. But even employee cost, yours is 5,700, theirs is 3,100. What I'm saying is, do you therefore need more people because you give a lot of small loans? Collection agents have to be more for you. Is that the reason?
Yes, you're right. Because the tickets is much smaller. For example, if we do we do Kiranas financing, we do salons financing. There are 22 categories of customers whom we haven't done deep dive into. For example, we do restaurants financing. There are auto mechanics financing. There are some dairy financing. These are categories of business the bank has developed. So they naturally have higher yield, higher OPEX, related to higher cost. But since you said OPEX, the main thing to note is, Lata, that the bank has built a deposit franchise from scratch in 6 years. 2 lakh crores of retail deposits have come. You'd appreciate what a phenomenal raw material it is for the future of this bank, like into eternity. So the point is that kind of a capability the bank has built in 5 years. It's not 100 years, it's 5-6 years, right? So that has taken technology, that has taken people, that has taken, all the stuff that comes with it. So, and of course, as discussion progresses, I'll tell you many other things bank has built, cash management, wealth management. We've gone full hog to build a universal bank. So this is like, we are setting it up like that.
No, I completely appreciate that point. I'm just asking you if that is the basic difference. It's more a high cost, high return, and therefore, higher provisions. High risk, high return kind of system that you are building.
No, I never like to use the word high risk, high return because we're not high risk. It's like a moderate.
Well, provisions are higher. Provisions are also higher. So at the moment, at least it is high risk. Maybe, as you say, you will eventually go towards, the mainstream kind of banks. So can we say, how will your NIMs trend? At the moment, we have seen this 24 basis point quarter-on-quarter fall. What may be your exit NIMs, Q4, for instance?
So let's talk immediate next quarter so that people get a full clarity. So as you know, this quarter, for example, the deposits yet have not repriced. It takes 1 year to reprice, but the repo has cut and yields have come down. So this quarter has come down to 24 basis points. We expect next quarter for it to dip further because the next 50 basis points yet to be passed on. So think that are marginally even lesser next quarter. But nothing to worry. That's a cycle. By Q3, we expect him to go up again. By Q4, we expect him to come back to about 5.85 plus. So think of it like a dip, and Q3, Q4 will take off from there.
Okay. Because but this quarter, Q2, your margins can fall another 24, you think, because of this giant rate cut?
I can't say 24, but I don't know. Maybe like 20 odd. I don't know. I can't put a number to it. But it's coming down for sure. So people should take note of it. But I tell you, it's a cycle. By Q4, we'll be back up. Because, Lata, one really good thing we have done, we talked about deposits earlier in a very short way, but the deposits of the bank, we have built such a good franchise that we're able to cut deposit rates sharply. Last quarter, maybe a quarter ago, we cut the fixed deposit rates straight from 7.8% on the peak rate to straight to 6.75 in line with the big banks. So that is a big cut, like 115 basis points. And as you know, fixed deposit 50% of our funding. So that will give a material development to the bank by Q4 of this year.
Okay, fair point. Can you just dwell a little more on the credit cost as well? There are some areas where you have seen higher slippages. What are those areas, and how may they pan out by the year end?
So by the year, we think that by Q3, Q4, of course, because microfinance issue will be maybe gone by the time. So the credit cost by Q3, Q4 should be lesser. So like H2, definitely we feel lesser credit cost than the first half. And first half, we said, you talked of many banks, we all talked about seasonality, etc. So H2, progressively, let me say that credit cost as a percentage of average book should continue to come down. And average for the year, like, we are in the zone like 2.05% we talk about, which is about 1.3% of assets.
Okay.
We feel that's comfortable, actually. It will come down. You should watch this quarter after quarter. You will feel that you will see it will come down. And certainly,
But is this unsecured loan, or was it any one corporate loan? I thought you said that there was a toll collector which also pushed up the bad loans.
I don't want to keep calling out one-timers because this is part of business. But to specifically, since you asked, I'll just tell you that there was one ATM company that went down in the last maybe 5-6 months. We had 110 crore exposure to that company. We took it all off in this quarter in the P&L.
Okay. What will be the growth drivers in the next couple of years, or even later this year?
Like we said, we have to align with the systems. Let me just tell you, what are we doing to align with the system? So, because we can't forever be a high yield and high OPEX and high credit cost bank. It's an early stage, right? Eventually, we have to align. So, how are we doing that? So, we are growing 4 lines of businesses, Lata, which will make it up, actually. One is mortgages coming up. If you see this quarter also, this year, YOY growth is 43,000 crores. Of the 43,000 crores, 8,000 crores came from growing mortgages, like home loans and property loans, etc. The second big growth came from business financing, business banking, basically working capital financing for small entrepreneurs. We take properties collateral. That's about 8,000 odd crores, and along with other business financing. The third thing that is growing is vehicle financing. That grew by 5,200 crores. The fourth thing that grew was corporate banking. That grew by about 14,000 crores. So if you add all of these up, that makes about 85% of the total growth. We like these businesses, and when we align with the system, I guess we'll have to keep growing these. We'll also grow gold loans. So we'll build these businesses in the next 4-5 years. You'll see the bank yield also will come down, credit cost also will come down, OPEX also will come down. We're aligning with the system. That's the phase of the bank.
Fair point. Fair point. Actually, it looks like you have convinced the market a great deal by this interview. And in the last hour, your stock has gone up by 1%, overall up 0.7% after these numbers. Thank you very much, Mr. Vaidyanathan, for spending time with us. Actually, it's not just IDFC. It's an overall improvement in the market itself. Midcap's up now almost 0.7. Bank Nifty and Nifty have now turned into the green. Among the big gainers at this point in time, Ola Electric up about 5%. You've got stocks like IGL, Inox Wind, Canara Bank, Bank of Baroda, a whole host of renewable and public sector bank stocks doing extremely well at this point in time. In the Nifty itself, IndusInd Bank, Shriram Finance, of course, has been a winner all the way. Cipla doing well. Hero Motor has picked up in the last hour. And you've got, Tata Motors, again, beneficiary of the US deal with EU. So a bunch of stocks doing well. At the moment, we wrap up on Bazaar on the note that markets are climbing, good for the bulls. Chartbusters will take the action forward.
Shares of Kotak Mahindra Bank slip over 6% is the top Nifty loser after reporting its first quarter earnings over the weekend. The bank's profit missed street expectations. The net interest income rose 6% year on year. It was the asset quality and the net interest margins that has the street disappointed.
IT major TCS is a little under pressure after announcing layoffs of 12,000 employees over the next year, which will impact around 2% of its global workforce. The Nifty IT index also trades a little bit under pressure, though both the index and the stock have recovered from the day's low.
Shares of Tata Motors and Samvardhana Motherson trade higher after US President Donald Trump announces a trade deal between the US and Europe. The European Union will be paying a 15% tariff for most goods exported to the US, including cars. The earlier levy of automobiles stood at 27.5%, so that's a positive.
SBI Cards is down 4% on the back of its June quarter earnings. The company's credit cost remains elevated while the receivables growth slowed to around 7%.
Shares of Acme Solar zoom in trade on the back of their first quarter numbers. The revenue increases 65% from a year ago. Profit after tax also surges aided further by higher other income. The stock up 9%.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the markets actually have bounced 120 points from the low point of the day. There are various technical indicators that indicated that maybe, in fact, you could see a bit of a bounce. Sustaining this bounce is going to be important, but the PCR had moved to around 0.7. The net shorts at around 1.6 lakh contract from the FIs, and the RSI that had dipped below the 40 mark for the first time in the last 3 to 4 months. So, Mangalam, for the time being, we have some green. But sustainability is something that we'll have to look forward to.
It's not very different from the game that we saw yesterday. All was lost, but then there was some resilience.
Yeah.
We did not win the game, but we did not lose. Some draws are as good as wins, and that's exactly what's taking place in the market as well. We've been losing for 4 straight weeks on the frontline index. There is resilience right now. Are we out of the woods? Perhaps not. But the good part is that we're not falling further. There is a bounce that we've seen from the lows. And we have big boys like Reliance do well. On a day when you said that Kotak Mahindra Bank was down 6%, the IT index was lower, you would have had to, take another heavyweight support for the index to recover. And Reliance is the one which is actually taking the bulls, case here right now, or the cause. And it's up around percent right now and taking the Nifty higher from the low. So that stock doing extremely well. Let's get you some ideas for profit in this market. We do have with us colleagues at Money Control Pro, Anubhav Sahu, joining in with a stock that he's tracking. Anubhav.
Well, talking about Himadri's specialty, wherein long-term investment rationale is guided by its progress in the battery chemicals value chain. Now, in this regard, it made a noticeable investment in international battery company, which is setting up a gigafactory in Bangalore by Q4 of fiscal 26. Now, this also presents an opportunity to start the commercial deployment of Himadri's lithium iron phosphate, cathode active and anode materials. Now, other than that, the company is banking on its R&D initiatives and strategic investment in the entities working to advanced anode technology. However, near-term growth would be dictated by gradual ramp-up of the operations of Birla Tyres, which has already started contributing to the top line. Now, as far as legacy business is concerned, carbon black capacities are already optimally utilized. Companies eyeing 70,000 tons capacity addition for specialty carbon black by Q3 of fiscal 26. For the debottlenecking of coal tar distillation capacity is also planned for Q3. Hence, volume growth for these businesses is likely to be seen from Q4 of fiscal 26 onwards. So while management guides for 20% net profit CAGR in next 2 years, we believe earnings growth would be back-ended. As the stock is trading at 20 times EV by EBITDA for fiscal 27, investors should wait for better entry level for this emerging battery chemicals player.
All right, Anubhav, thanks a lot for that. Meanwhile, at the bottom of your screen, numbers coming in very early from Cart trade. We have a big surge in the margins. 15% has turned into 25%. In fact, on an absolute basis as well, there's been a near doubling of the EBITDA, and which has flown all the way down to the bottom line, a jump of almost 94%. The stock, as a result of which, moved mildly into the green, currently at the higher end of today's early trading range itself. So revenue up 22%, EBITDA up 98%, net profit up 94%. Good numbers coming in from Cart Trade. Take a short break. On the other side, we have Ashok Nair, who's the managing director at RPG Life Sciences, joining in to discuss their quarter gone by. Stay with us.
Welcome back. Well, the markets are sitting with some gains, and encouraging to see the mid-cap index actually is doing a relative outperformance. I think the Nifty Bank needs to get its act together. If that's the case, then we can see a bit of a bounce. As of now, the Nifty Bank is at its 50 DMA. But let's go to the first management on the show. J&K Bank reported a steady set of numbers in the past quarter. But what's the way ahead? We're now joined by Mr. Amitava Chatterjee, the Managing Director and CEO. Hi, Mr. Chatterjee. Good morning. Thanks a lot for joining in. Well, the loan growth for the past year was just around, for the past quarter, was around 6%. How do you see growth shape up for the remainder of this year? What's the target in mind? And also, your CD ratio has come to sub 70%. Where do you see this number stabilizing at?
Good morning. Thank you for having me here. The loan growth obviously has been low because of various reasons. For the last financial year, there were quite a few disruptions in this geography. But we have taken up, and there is a lot of potential. We have identified a few process gaps that were there. We are correcting. In fact, the first quarter of this year has mostly gone into correcting those process gaps. So the guidance that the bank has given on 12% credit growth for this year, I am very confident that it will not be less than that. It should be more than that. The growth comes 50% from the UT of J&K, where we have a major presence, and the 50% of the growth comes from the rest of India, where we also have a presence in almost 20 other states. So that is more or less the idea going forward.
All right, we take that point, Mr. Chatterjee, and understandable that there was a fair amount of weakness that we saw in the quarter, given the operations that took place during the quarter on a national geopolitical front as well. So you hold on to that 12% growth guidance. 50% of that will be led by J&K and the other 50% from the rest of the country. What about deposits? That was healthy. Your CD ratio went all the way up to 68%. Where do you see this going forward? And also, because of what took place in the first quarter, do you see any incremental pressure on asset quality by some of your borrowers who may have lost some business?
See, first I'll answer the asset quality part. Yes, if I say that there has been no impact, it will be a wrong statement on my part. There has been an impact not only on tourism but other sectors related to tourism. But if you look at the NPAs and the SMAs, they have not gone up that much. So as I have held earlier also, the resilience on the part of the people of Jammu and Kashmir, and having faced several such incidents in the past, they know how to handle these situations. So I would say it has reached a level from where it is definitely going to come down, the NPA levels. Even otherwise, the slippages have been less than 1%, even during this situation.
So what does that mean for your GNPA guidance and also your net NPA guidance? If you could give us a sense, you had guided for sub 3% by the end of this year. It's currently 3.5%.
Definitely, it will be. See, there are two reasons why it was 3.5%. One is, as you mentioned in the beginning, the credit growth had not been that much. So it's a ratio against the total advances, right? So where I believe the advances are definitely going to go up, and the NPAs absolute level, they have not gone up much. So definitely we have sufficient reasons to believe that there are quite a few resolved cases, high value resolved cases, which are in the pipeline. It should have been recovered by the first quarter. Some reasons, some technical reasons, which resulted in shifting that recovery to the second quarter. So we are very confident that sub 3% is very much achievable, and we will achieve it.
Okay, all right, sub 3% gross NPS, got that. Let's focus on two more points then, on the NIMs and the ROAs. The NIMs saw a little bit of a downtick, but that's expected, right? Because the RBI as well cut rates, and I'm guessing that you would have passed most of that through. So how do you expect the NIMs number to shape up, and what is the targeted ROA?
See, NIM, I believe that still this bank can boast of a better NIM than many other banks, primarily on account of 45% plus CASA deposits that we have. And we are very, very focused on improving CASA further because we have been late entrants in the IT and the technology front in the bank. Now that we have done it, and the bank is poised to take the bank's IT to the next level, through this, definitely we are hopeful of improving our CASA further. So that will help us in maintaining the NIMs to the levels that we have at the moment. Worst, in fact, would be somewhere around 3.6, upward 3.5 definitely. So I believe we also can expect some more rate cuts going forward. So I believe 3.5 to 3.6 would be a fair judgment on NIM. Rate of ROA, we believe that we will be able to maintain the ROA that the bank currently, had in the end of last financial year. This quarter hasn't been, the return-wise hasn't been very good. Primarily on one count, we had to have provisions for the one state, one RRB, one EDB. Regional Rural Bank has been amalgamated with one of the our sponsored Grameen banks. So that has resulted in impairment of, because that was not doing well, impairment of the investment in that. So that has resulted in some sort of decline in the income that has accrued this quarter. Otherwise, we were poised to have the 30% jump on the net profit.
All right, so 3.5 to 3.6% on the NIMs. You believe that asset quality, return on asset rather, will be maintained at around that 1.4% mark, which was what you saw in the fourth quarter. with over 12% revenue, with over 12% loan growth and about 3.5%, less than 3.5% NPAs. What about CASA and the CD ratio? We briefly touched upon the CD ratio earlier. You said CASA is something that you're looking to increase. It stood at 45% at the end of this quarter. Where do you expect to take it by the end of this year? And on CD ratio, do you have a target?
See, CD ratio, if you look at the CD ratio, I look at it as an opportunity. I still have sufficient headroom to take the CD ratio to 75, 76%. Of course, that will be over a period of time. I believe by the end of this year, the CD ratio will be upwards 72%.
Got it. And CASA?
And CASA, we aim to take it to 48%. Looking at the banking sector as a whole, it has been losing CASA and mostly to high-yielding deposits. I mean, whether it is bank deposits or mutual funds. So the entire industry has been losing CASA, but then we have an advantage of being in a geography where we have a very major presence. The market share is more than 60% here, and having been late entrants in the technology front, we have a lot of opportunity of improving our CASA here. So I believe we can take it up to 48%.
All right, CASA at 48%, CD ratio at around 72%. Thank you so much, sir, for joining in and giving us a detailed outlook into what the next 1 year could look like for you. We hope that there are no skirmishes and there is no unforeseen circumstances, and you go ahead and do meet all the guidance that you've set out for your business and your shareholders as well. Take a short break, come back. On the other side, we have another management for you. RPG Life Sciences joins us. Stay tuned. Welcome back. You're watching us here on Chartbusters. Let's talk about RPG Life Sciences. The company reported a subdued set of earnings for the first quarter, and that was understandable because we did have a fire incident in one of their plants. Ashok Nair, who's the managing director, joins in to discuss the numbers in more detail. Thanks a lot, Mr. Nair, for joining in. You know, your domestic formulations up near double digits, no problems out there. International formulations were lower, and API was sharply lower because of the fire incident. So the question is the worst behind? Are we producing enough in the API business, the production back up to speed? And in light of what's taken place in the first quarter, what's your outlook for the full year for domestic, international and API?
Good morning. Pleasure, first of all, me being here. So as you rightly said, our domestic formulation actually, which contributes to almost 70% of our portfolio, has outperformed the market growth and registering a healthy 10% increase versus the last quarter. And of course, the growth is driven by a well-crafted transformation agenda and execution excellence. As you said, the API business witnessed a subdued Q1 performance due to a temporary sales impact from a fire incident at our API plant in January. Now, a dedicated team of almost 155 professionals is working on restoring the plant, which completes in the Q2. So as you said, we will be in a position to see that all those orders which were in pipeline, which is getting deferred for the coming quarter, should be fulfilled. Both international formulations and API going forward because those are the two important pillars for us too. So along with the domestic, we need to fire in this too. And I believe from Q2 by August, September, we should be back on track. And the full year, we should continue to deliver as we've been delivering in the last many years.
That number, sir? Mr. Nair?
Yeah.
What is that number we're looking at for the full year in domestic, in international and API?
So Nigel, normally, you know, we don't give a forward guidance, but if you can see our past track record, you can be sure that we should be there in the same level, and our EBITDA margins also should be positively as we have done before.
All right. Hi, Mr. Nair. This is Nigel here. You're sounding fairly satisfied with regard to those numbers. However, the street is a little disappointed, as it's evident by the share price reaction. It's down 8.5%. But as you're saying, whatever was deferred in the past quarter will be made up in the coming quarters. Absolutely. And we take that point that there's no guidance that you'll give, fixed guidance. But at least if you could indicate directionally, will it be a double-digit growth? First quarter, you've grown by only around 2% on a blended basis. Yeah. If double-digit, if yes, what could we work with? Mid-teens?
So we'll be a double-digit growth. Okay. We'll be just between 10 to 13.
10 to 13.
So that should be there, yeah.
All right. And margins, if I look at it on a year-on-year basis, they've improved, right? Though you didn't have operating leverage, but it's improved from around 18% ballpark to around 21%. Yeah. You mentioned in the past you would like, I think, to go towards mid-20s. For this year, what should that number look like?
So again, as you said, but yes, as I said that...
It'll improve from here on, sir. It'll improve from here on. Can we work with 200 basis points improvement from what you report in the past quarter, which will give us in that vicinity of around 23 to around 24% margins? Gettable?
I agree that. Yeah, absolutely.
All right. Margins between 23 to 24%. What about, Neprosin? You had expected this business to do about 100 crore in sales. A couple of years ago, you said that it will become 100 crore in the next couple of years. Where does that number stand at? That's point number one. And secondly, on your Ankleshwar plant as well, it's been under US FDA warning letter for the last 12 years. Has there been any updates there?
Okay, so I'll answer fast. So our Neprosin is on the growth track to become 100 crore within a couple of years. In fact, the first quarter, we have grown by 17%. So Neprosin, the strategies which we have put in place is working. And yes, we will be at 100 crores as what we had earlier said. As far as the US FDA, we have not further pursued on that. And currently, our whole operations are minus US. So and we need to have a very strong product line to see that we start operating and the US FDA guidelines and the cost impact on that. So we are going slow on that. And we are not planning to enter into US at least for the next 3 to 4 years.
All right, not planning to enter the US for the next 3 to 4 years, so that keeps you away from the US FD, at least in the Ankleshwar plant. What about new products? You said that your Indian business grew or domestic business grew because of your strategy. New products were up to 20% of your sales. You were expecting this number to grow. Where does that number stand at right now? And where will this settle over the next, say, year or so?
So currently we are at 2.6% growth in new products, which if you compare with the industry, in fact, is a shade better. And going forward, the strategy has been to get more niche and specialty products. As we already have a strong presence in nephrology, we would like to replicate that in the rheumatology and the gastroenterology space. So all those products which are in pipeline are in line to see that we enter that segments.
Very quickly, sir, inorganic growth, we'll hear about it in quarter 2 and quarter 3. Is there a target you're focused on?
Yeah, so we are looking into both API and this thing. There is a target. We wish to see at least by first quarter next year, we should be having something.
First quarter of next calendar year. That will be January, March quarter.
Yeah, so let me not put too much of in this thing, but yes, we are working very strong.
And the size could be how much?
Nigel, let's
potential revenue, sir. Potential revenue from the acquired unit. We know you have the appetite, but how big is your appetite? We just want to understand that.
We want to have something which is a prudent value, which actually sees that it is accretive to all of us. So let me not get into that, but we are open, Nigel. We are open.
What's the cash on your books, sir? What's the cash on your books? I remember it being over 100 crores as surplus. Where does it stand at now?
We have 266 crores in our book.
266 crores. And you will not require any other funding for acquisition. So we'll get a sense that you will acquire from your own cash itself.
We will decide that. It can be in any structure.
We'll let you go at that, Mr. Nair. You've given us a sneak peek. We look forward to chatting up with you at the end of next quarter. Maybe there'll be some progress on this front. But thanks a lot for joining in. The past quarter was a little subdued. You're guiding for better times ahead.
Thank you.
On that note, though, we'll wrap up on this edition of Chartbusters. But the team of Trading Hour is waiting by. Stay with us.
Hello and welcome to Trading Hour live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always Hormiz Patakia and Reema Tendulkar. Hi guys. Well, you know, Nifty has been quite volatile in the last couple of minutes itself. So we saw that recovery from the lows that came by, and Nifty did surge from the day's low, reaching that level of 24,899. Then again it saw a dip, and now again there is a recovery. So Nifty is absolutely at the flat line right now, but with some negative bias, or it's been quite volatile, let's put it that way. And most of the components right now, they are in the negative. So we have something like a Nifty Private Banking Index led by Kotak Mahindra Bank. We have the IT pack. Of course, we'll discuss IT at length in just a bit. We do have the banking index as well, which is batting for the bears today. So a lot is happening. The big sector, of course, that remains in focus is the IT space, and the recovery that has come by as well in the banking names. That led to a recovery in the Nifty space as well. But again, it's been very, very volatile.
Well, if this had to come with a disclaimer saying that please do not try this at home, looking at the chart that you're seeing currently is a 100-point swing either side in a matter of minutes. Is that choppy as the index has been in today's trading session, and what promises to be an earnings heavy, data heavy week, not just for our own markets, but of course for the globe as well. You know, there are a lot of earnings reactions, as Sonal was mentioning. Kotak Mahindra Bank continues to remain the top loser, 6.5% lower on that stock in response to its results. Zen Technologies is in a lower circuit. It was in a lower circuit on Friday as well. And the other one is SBI Cards, a slew of downgrades that have come in for the stock and cuts to its price target as well. But not all is doom, because there are some stocks that are doing well in response to their results as well. Acme Solar is one of them, 8.5% higher on that stock. Top gainer on the Nifty 500 today. Poonawalla FinCorp is the other one, 7% higher there. Aadhar Housing Finance is the other one, 5% higher on that stock as well. Most of them trading at the highest point of the day, but the standout has been Laurus Labs. It came out with results during market hours on Friday. It didn't see a major reaction then, but today the stock is up 6%. It's a new high for the stock in today's session, and this despite most of the analysts who track the stock, we saw reports from Kotak, from Goldman Sachs, continued to have bearish recommendations on this name. So Laurus Labs at close to 900 rupees, 6% higher on that stock. But the talking point since last evening has been the layoffs announced at TCS. The entire sector facing the ramifications of it. TCS is trading lower today, and along with it are also stocks like Wipro and Infosys. Reema is here to summarize what does this mean for the entire sector as a whole. Reema.
Thanks so much for that. So the big question is, do the job cuts at TCS signal a big tech reset? Well, the news is that India's largest IT services firm, TCS, is letting go of 2% of its workforce. That is nearly 12,000 employees. And this is largely the mid to senior level, and it would be spread across FY26. Now, this is significant because TCS is the bellwether of India's $250 billion IT industry. Job losses at this scale are not just rare for TCS, they're unprecedented. So what is the key driver behind the job cuts? Well, it is a growing mismatch between demand and the available skills. TCS insists this is not about AI replacing jobs or the need to hire less. CEO K. Krithivasan told Money Control that this is not about AI giving you 20% more productivity gains. It is about skill mismatches and the feasibility of deployment. But that said, there has been a slowdown. There has been pressure on margins. And in an AI automation world, we need fewer people. Fewer managers will be needed. The mantra is basically you can do more with less. Now, global tech giants have already made very deep workforce cuts, and this has been happening for a while. Just this year, Microsoft has axed nearly 15,000 jobs in 2 rounds. IBM has reportedly let go of 8,000 employees as AI has replaced HR. But now what's happening is that the tech layoff wave is hitting closer home. TCS calls it as a part of a journey to become a future-ready organization. But the deeper shift is clear, that the traditional, people-led, a linear revenue model is now giving way to an outcome-based AI one, a platform one. And it hasn't happened overnight. You know, Indian IT companies have been stealthily, quietly rebalancing their headcount for nearly 2 years. You know, this is the picture over the last 2 years and how the headcount has changed. For TCS, it's lower by more than 2,000. For Infi, about 12,500. Wipro, in excess of 25,000. So the question is, What lies ahead? Will other IT companies also follow suit and optimize their workforce to become future ready? So do we have more job cuts coming for the entire sector? Will the industry continue to delay wage hikes? Remember, TCS hasn't given their wage hike as they normally do in April. And in the near term, say for a company like TCS, will this trigger a spike in attrition or will it in any way impact the job delivery? So lots of questions. We'll have to see how this plays out. But this could just be the start of a deeper transformation in the Indian IT, the way it operates and survives in this age of AI.
Okay, all right. That's such an interesting data. And thank you so much for bringing that perspective as well, Reema, for that. In fact, we are joined by Ganesh Natarajan, who's the former CEO and MD at Zensar Tech and former NASSCOM chairman as well, and is currently the chairman at GTT Data and Solutions and Honeywell Automation. Also joining in is Girish Pai from Bob Capital Markets. Gentlemen, thank you so much for joining us. And this is such an important talking point now, right? Mr. Natarajan, let me start with you because you've seen IT industry evolve over years. What are your thoughts on this? Do you think this is the beginning of a more aggressive headcount recalibration? We'll see more cuts across the industry now?
Let me give you a different perspective. If you look at the World Economic Forum's Future Jobs Report 2025, they talked about the structural labor reorientation. And that's what this is, in the sense that they talked about maybe 17 million jobs being created and 9 million jobs being made redundant or replaced. Even if you look at the IT sector, my own bet would be that 1 million jobs will become redundant, whether it's testing or documentation or programming, of course. But at the same time, new jobs will get created. So I tend to agree with the TCS narrative that this is a future-oriented restructuring because, in the days of generative AI, when you're using ChatGPT a little bit and helping yourself, that was fine. But this is the day of autonomous agentic AI, which means that 80% of the work could potentially be performed autonomously. So in that context, when you look at your organization top to middle to bottom, then you do a fundamental rethink. And I think every industry, it does not just IT, but definitely including IT, will do this reorientation. There will be some shedding of jobs. At the same time, they will be creating new jobs with new skills, which is exactly what the narrative that you talked about.
So, Ganesh, I think the question that a lot of people are asking now is that Indian IT company had the best talent. We're the land of engineers. We're flush with capital. Companies have billions of dollars. Could they not have anticipated and proactively dealt with this shift that is taking place? Could we not have realigned our business models in a different way that we don't come to this today?
See, we have to understand that things are happening at breakneck speed. In the sense, the word agentic AI, all of us heard probably less than a year ago. So in that sense, there was no question of long-term planning. And I think a lot more will play out. We are approaching artificial general intelligence, and AGI will make a fundamental shift. If at all we enter the era of super intelligence, it'll be even more game-changing. So I think we have to be prepared for a few years of churn, where you will find that organizations, we do a lot of consulting in GTT Data Solutions, where we're telling people that, look, move from transitional AI to game-changing AI. No, game-changing AI means game-changing for the organization. So we have to be prepared for this future focus, and it's not going to stop here. It's going to take place over the next 2 to 3 years. So I think we should tighten your seatbelts and be prepared for lots of changes.
So you don't think we could have done anything differently, the Indian IT companies?
Well, 2020 hindsight is always there, but I'm saying people have done their bit. You talked about it in your own story. So, but I don't think anything fundamentally different could have been done. And this will evolve over a period of time.
Let's also bring in Girish Pai into this conversation. Girish, good morning. Thank you for joining in. Do you see this becoming a trend now at most of these Indian IT companies? I was reading a note earlier this morning which mentioned that companies that are failing to gain market share could end up resorting to such moves as TCS has embarked upon. Do you see this as a widespread trend emerging? Because if you look at the headcount reduction over the last 2 years, companies like Infosys and Wipro have already seen almost a 4 to 5 digit headcount reduction already.
Yeah, firstly, thanks for having me. So if you look at what the statement of TCS has been, it says that mid to senior level folks have been let or are being let go. AI has not impacted or has not been has resulted in this round of job cuts that TCS has done. I would tend to believe that because AI typically, at least as far as things are concerned right now, have been impacting the lower level jobs, the entry level jobs, not the mid to senior level jobs. Maybe once agentic AI picks up steam and becomes a predominant part of the work that Indian IT companies do, then maybe that could be a situation. My sense is that this is probably, and this is just a guess, there is a market share shift that's happening. The predominant theme, if you seen what the last quarter's calls have indicated, has been vendor consolidation and efficiency. And my sense is that TCS has been at the negative end of the vendor consolidation. And probably there are people who are kind of being released and who are not being are not redeployable, which is a statement that TCS has made. Interestingly, TCS is not the first company to make this kind of a decision. Just 15 days back, HCL Tech said that they're going to do a people plus facilities restructuring, which had to do with skills mismatch and location mismatch. So that didn't catch the media's attention very much, but it's very similar to what TCS has done now.
Girish, according to you, what kind of roles are most at risk in this AI-led shift in the IT industry?
See, right now, I think the entry-level jobs are jobs which involve BPO-related work, contact center work, customer experience-related work, testing work. Those are the kind of jobs I think are low-level coding work. I think those are the kind of jobs which will be at risk under the AI setup. But if there is a market share shift from one vendor to another vendor, and there is a fear that vendors can't go and self-cannibalize themselves, and that typically happens with a large company with a very large revenue base. And there is a fear that that revenue is going to get compressed because if you go and self-cannibalize yourself, that becomes a challenge for revenue growth. So that typically tends to be a problem more for the larger companies and less so for the smaller companies. So I think a TCS, Accenture, an Infosys, or a HCL Tech, or Capgemini, or Cognizant would be probably under much more pressure from this phenomenon that we're kind of going through right now.
So Girish, 3 years out, what kind of revenue growth would the industry be seeing at? And do you think we will see a headcount increase 3 years out now for the IT industry as a whole or for the large cap IT companies?
So my take on revenue growth for the industry has been that unlike a lot of other peers of mine, I think we will probably shift gears down to a mid-single digit or slightly lower than that kind of sustainable rate of growth, because the industry has grown and become a fairly large. It's become fairly large. So if you look at FY25, you look at the top 6 Indian players, the revenue that they generated is about $85 billion. 10 years back, that number was 42 billion. Okay, so from 42 billion to 85 billion is roughly about a 7% CAGR. And obviously, you saw the pandemic-related compressed transformation phase when I think the industry grew by about 15% CAGR for a couple of years. But prior to that, we grew by just about 6.5%, 7% growth. So on a larger base, my sense is that we will probably grow in the 4-5% territory. So you will have to probably pick and choose what you want to invest in, depending on whether that particular player is gaining market share. Yes, the TAM is very large, and it's probably going to be larger. The way to look at how to invest in the sector is to pick up stocks which are at reasonable valuations and can grow at maybe 2x the rate of growth of the tier 1 players.
So in that case, Girish, considering this development that has happened and the results that have come in as well, which for the lack of a better word have flattered to deceive this time around, what is your sectoral call on these Indian IT companies? Any topics that you would like to recommend?
So we've been underweight the sector for a fairly long period of time, precisely because of this. I think we have believed that growth is going to disappoint. And until recently, I think valuations were also fairly rich and seemed unsustainable for the kind of rate of growth that was kind of coming through. We don't have any bias on the sector right now, but relatively, I would probably think that the tier 1 stocks look a little better, but then it all depends on how FY27 is going to play out. We've had 3 years of a slowdown. We have FY26, which is virtually a write-off as we speak right now. Will FY27 be a better year, which is what I'm estimating it to be, or I think the entire street believes that it could be a mid to high single digit kind of growth year. Now, if that disappoints, then we could potentially see another year where not only will revenue growth be slower, I think there could be serious margin pressure related issues that may come up. Because in the last 3 years, we've run multiple cost management programs, your Project Fortius, Project Maximus, Fit for the Future, and a lot of other programs to control costs and maintain margins. I think we've kind of, the low-hanging fruit have been eaten up in one sense. I think going into a fourth year of a slowdown, we will have problems with margins.
Oh, that's well explained. Ganesh, would you agree with Girish that we could be in for a low to mid-single-digit kind of a growth period for the Indian IT, industry, or at least till revenue monetization kicks in, say from AI and all the new applications which will emerge? It will take some time. So till then, we're in for this middling kind of a growth, and also about the kind of pyramid structure, because up until now, the Indian IT industry enjoyed this pyramid structure where we hired a lot of freshers, entry level, but now those jobs are getting cannibalized by AI. So what would be the new structure that Indian IT will adopt?
See, both great questions. And in response to your first one, see, there will not be a reduction of manpower employed in the IT industry because a lot of them will start in startups. And there could be, to answer the question, what Girish is absolutely right, that if you look at the traditional IT services players, yes, you are likely to see maybe a mid to high single-digit growth. Primarily because I think, I've been on the board of State Bank of India for many years, plus, of course, helping Bajaj Finance. So all of them are now using startups very aggressively. So it's not just one large company or one mid-sized company, but it's a kind of sandbox of multiple companies. So in that context, yes, if you look at one company, it will not grow that much, or maybe it'll be muted. But at the same time, if you look at the industry, I think there's opportunities for enough people. So from a people perspective, I wouldn't say there's much to worry about. You have to be nimble, you have to learn new ideas all the time, but you'll be employable without a doubt. And to answer your pyramid structure, absolutely. The classical pyramid is in Jurassic Park. So you will see that a lot of agentic AI will come in. You'll have to redesign your entire organization structure to suit what AI will do and what we should do to enable AI beyond that. And that's the clear future.
Okay, we've got one more veteran voice joining into the discussion. C.P. Gurnani, co-founder and vice chairman at ENEOS, is now with us. He was formerly the CEO and MD of Tech Mahindra, and he ran the company for more than 2 decades at the top. C.P., thank you for joining in. Now, you've seen multiple tech cycles, right? You've seen the industry evolve over a decade, and this is now a new era that we've entered into. The fear is that we're in for aggressive headcount optimization, recalibration, cuts, whatever you would want to call it. Would you agree? How would you expect the headcount to play out for Indian IT?
I think the focus on the Sholay dialogue, kitne aadmi the, or headcount based judging the IT industry, I think, thank God that period will be over. I think all of us will have to rewire ourselves to start looking at output and outcome-based business models, outcome-based pricing, and more importantly, looking at what it does for the business or what it does for customer instead of looking at IT and systems in isolation. So I'm actually quite excited because we have a chance to, Indian IT industry has a chance to prove that they will build platforms, they will accelerate innovation, and they will rule the world with focusing on the application cycle.
Okay. Mr. Gurnani, yes, the industry is excited. You are looking at fresh aspects in the industry as well. But about the job cuts, because there's been a lot of fear, and you have been a veteran, as Reema as well pointed out, and all of us know that. So as per you, what kind of jobs could be at risk because of this AI-led shift that we are seeing? Earlier, it was just freshers. Do you think it will slowly creep up to the other levels as well?
I think we always tend to take the extreme positions. My feeling is it is humanization of AI, and the humanization of AI genuinely means is while there will be routine jobs which will get cut, but at the same time the new jobs will get created. I mean, even today, if you go back and look at each company's job openings, you would realize that the number of job openings over the previous year has only increased. That means I need more AI engineers, I need more data scientists, I need more prompt engineering people, and I need people who can collapse a few functions of an organization. There's no point in having an HR organization. I mean, ultimately it will become, how do I serve my employee? And that means it is a data-centric organization with a human touch.
So, Mr. Gurnani, since you brought up Sholay, I would want to bring up one more dialogue from the film. It says, "Jo dar gaya, samjho mar gaya." Has the Indian IT industry now been driven to a point where the fittest will survive and the fastest to adapt will be the fastest to grow?
I would actually like to believe is that if we look at how a lot of new companies have reoriented themselves, which includes Ionos, we are definitely building a co-creation with our clients, creating platforms, and as I said, the traditional way of looking at verticals, I mean, it is no longer like when you go to an airport, do you consider it to be an airport, or do you consider it to be a real estate, or do you consider it as a retail store? So my point of view is that the advent of technology has only collapsed industries. So I do believe that Indian IT companies will also re-emerge, and they may come up as marketing as a service, they may come up as data as a service, or a quality as a service. But ultimately what we are going to look at is a shape, and the way the companies are presented, it will change over the next 5 years.
Gentlemen, we could go on, but we're out of time. Thank you, all three of you, for joining in. Mr. Gurnani, Mr. Natarajan, and Mr. Pai for joining in into this discussion. We'll get into a break, but do remember to catch our special show, Editor's Playbook, where we will discuss India's IT industry, which is at a crossroad. Will the AI age force a change? Tune in today afternoon at 3:30 p.m.
Welcome back. You're still tuned into Trading Hour. Mahindra Life Spaces developers reported their Q1 numbers. Their pre-sales and volumes declined nearly 50% compared to the last year. The total ongoing projects, they stand at 13.38 million square feet. So what's the plan going forward? Do they stick to their guidance? And a lot more. Let's discuss it with Amit Kumar Sinha, who is the MD and CEO at the company, joining us now. Mr. Sinha, good morning. Thank you so much for joining in. Well, if we compare quarter-on-quarter or YOY, sales have been lower. It's a 50% drop that we've seen in volumes as well as sales as well. This is despite strong launches this quarter. This time, completions have also been nil. What explains this, and what does it do to your FY26 sales this time?
Thank you for having me. I think the launches are a function of approvals, and we have some delays because of the EC issue that the whole industry is facing. And then there are a lot of pipeline, the approvals in the pipeline for us. So I think my sense is in the later part of this year, the launches that we had planned will continue to happen. It's just a function of when they happen. There's no issue in terms of the quality of the launches, what we are trying to bring for our customer. In fact, for later part of this year, we have some of the marquee launches coming up. We're very excited about it. So all of that will get covered in the second, third, and fourth quarters.
Amit, could you give a number in terms of launches? How many in Q2 and FY26?
So I'll give you because the regulatory and the approval process is undergoing. So we have roughly 6 to 7 launches planned for later part of the year. We have one major launch planned for Bangalore, and 4 to 5 launches planned for Mumbai, and one launch planned in Chennai. So those are the pipeline for this financial year.
And in terms of million square feet, what would they amount to, these 6-7 launches?
I'll give you the value tied to it, because some are affordable, some are something that we are getting out. I think roughly between 5,000 to 6,000 crore of launches we are trying to bring in this financial year and the rest of the year.
So what will that do to your pre-sales? Because it was around 2,800 crores in FY25. Will you grow over that?
Yeah, we definitely. See, we have given a plan to grow from 2,800 to 9,500 with a plan of 10,000, the remaining 500 coming for IC business. I think we have a great GDV pipeline. You may have seen we had a very progressive FY25 where we added 18,100 crore of GDV. Even in the last quarter one, we added 3,500 crore of GDV. So in terms of the raw material that's needed to push these pre-sales, we already have that. I think we are going through the motions to get the approval. There's some industry-specific issue, and there are some delays that typically happen as part of the approval process. We want to make sure everything is done in the right way. So my sense is the 2,800 to 9,500 journey would be very exciting for us, and we have the right raw material to get there.
Since you mentioned 10,000 crore, Amit, how would you get there? Would launches be the sole contributing factor in growing towards that number? Or do you see more JVs, more land acquisitions, more inorganic growth? What is the likely contributors that will take you to that number?
Yeah, so a very, very good question. So I think as we look at our journey to achieve 10,000 crore, I think there are 3 parts to it. One is the kind of deals that we have done. We have done, I think you're referring to society redevelopment, joint development, as well as outright. The mix of deal continues to be very exciting for us. And they are capital efficient. They are in the right locations, which is pushing the premium index of our portfolio. The second is the balance sheet. We have done the rights issue in the last quarter, which was very successful. We raised 1,500 crore. Our balance sheet is the strongest it has ever been. It's negative 0.23. That means we have cash surplus. That allows us to get more deals in the pipeline and make suitable land acquisitions. And third is in terms of the flexibility we have from our IC business. I think that is also giving us cash. So we have a very strong cash position. Wherever we see the right deals, right land deals, we'll go after them in an aggressive manner.
Amit, last question before we let you go, because you are one of the players which is aggressively looking at redevelopment projects to expand in the Mumbai market, right? but the general market sentiment has been that the excitement with which redevelopment projects started has come off now. It is not as lucrative anymore, and the quality is suffering as well. What's your take? How much of your new launches and new supply will come from redevelopment in that case?
Yeah, so I think it's a great question. So redevelopment, society redevelopment is actually capital efficient, but time inefficient. It just takes a lot of time to actually bring them to the market. And that deters some of the players to actually move away from society redevelopment. But there are equally more number of players who are coming into society redevelopment. It's whenever we go for a bid, there's quite a bit of competition. But we figure out the secret sauce there in terms of which policy should we use. Should we cluster? Different sections exist under that. Should we use a different kind of mechanism to attract the right set of customers? How do we create the mix of retail plus residential so that we provide the best economics to the customers, to the current residents, so they can choose us. From an overall portfolio, we want to have 1/3, which comes from society redevelopment, 1/3 from joint development, and 1/3 from outright. And our portfolio today is quite well balanced.
Pleasure having you as always, Amit. Thank you for sparing time and joining us. Wish you good luck for the rest of the year as well. The management of Mahindra Life Spaces on the road ahead for the company. Take a short break, but just before we do that, a small programming note for our viewers as the workplace transforms, so must leadership. Now, in the Bengaluru edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. You can catch this live on the 29th of July, starting 5:30 p.m. only on CNBC TV18, CNBCTV18.com and on our YouTube channel. Welcome back. Continuing to remain around the flat line is where the benchmark indices are, but that does not mean that the street is devoid of any movers. Vivek is here to summarize the top movers at this hour. Vivek, what's on your list?
Well, that's right. It's earnings heavy. So most of the stocks that we're highlighting today, mainly moving on the back of results or the back of management commentary in the analyst call or even commentary that they've given to our channel earlier today. First on the list has to be Cipla. Remember, this stock was a strong mover post the beat that it came on numbers. And even after that, there has been a follow-on rally seen, one of the top gainers as far as the Nifty is concerned. The other stock that's doing quite well, and it's been a stark contrast to how some of the other NBFC peers have done, is actually Shriram Finance. Company told us, or the management told us earlier today, that they're confident of a NIM of close to 8.5% for FY26, ROA of 3%. That stock, the top gainer as far as the Nifty is concerned. Laurus Labs, again, strong beat to what the street was anticipating. This particular stock has moved significantly from Q4 to Q1. And today, post the strong guidance the management gave us today, another 7% higher for Laurus Labs. Acme Solar, one stock from the broader end of the market, the top gainer as far as NSE 500 is concerned. Strong up move, margins very strong despite a higher base on the back of that stock higher by almost 9%. And Poonawalla FinCorp, steady Q1, profitability was quite muted. However, the management has told analysts that they see upside risk to the AUM growth guidance on the back of that stock higher as far as almost 6%, one of the top gainers in the F&O space. But on the other side, a few stocks that are seeing a negative reaction as well. Kotak Mahindra Bank, again, a big miss across most of the parameters. NIMS decline, that stock down by 6% for Kotak. Zen Technologies, again, on a year-on-year basis, profitability is halved. Management has given reasons in the call saying that, one key order was deferred, but despite that, this particular stock pushed at the lower circuit. SBI Cards, the cost of fund is something that continues to remain a bit worry. Along with that, growth guidance has been trimmed by the management, down by 5%. SAIL, very big miss as far as Q1 was concerned. Along with that, steel prices domestically remain quite subdued. That stock down by 4%. And APL Apollo Tubes, remember, this stock was a top lagger on Friday. There was a significant guidance cut both in terms of volumes as well as EBITDA per ton. And today, another down move seen as far as APL Apollo Tubes is concerned.
Thank you very much for that. Another one, Car Trade Tech, that's moved to the high point. Very strong numbers. 27% jump in the company's top line. Revenue stands at 199 crore and the profits are up 106%. Big jump, 7.5%. Here is a reminder for all our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, a premium members-only experience on CNBCTV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, masterclasses and curated lifestyle benefits. Welcome back. Let's find out the trends in the futures and options space. Mangalam now joins in. Mangalam.
Well, we're out of danger, but perhaps not out of the woods. That's exactly what the trends in the F&O are suggesting. Why do I say that? Because both while Nifty and Nifty Bank, along with the Sensex, have recovered from the lows, we are still seeing, selling at higher levels. So we're still marginally in the red for the frontline indices. If you look at the key heavyweight contributors to the index, you have the Nifty Bank, which is again in the red but recovered from the lows. Nifty IT index, we had a big discussion around that as well. Off the lows, but still in the red by about 0.2%. That brings Reliance, in focus. The onus of an up move lies on Reliance, and that's actually on its part doing fairly well, up around 0.75% as well. The other thing we're looking at, the Nifty days low has been gradually moving lower, but we are seeing recovery from those lower levels as well. So long as we hold on to this lower level of 24,700 to 24,800, the market's poised for a decent, consolidation, if not a further fall. The India VIX has continued to rise, so that tells you that it's becoming an option seller's market as we move towards expiry. And 24,800 is the fulcrum, because 24,800 put and the 24,800 call, both of them are seeing writing for a combined premium of almost 200 rupees, telling you that these option writers do not expect the market to break this range of 24,600 at the lower level to 25,000 at the upper level. Remember, it's consolidation, but the range has come lower. The key levels to watch out for on a technical basis, on the way up for the Nifty, will be the 50-day moving average, which will act as a resistance, but the same level for the Nifty Bank will act as a support. It breached that level intraday today, but now has come back above that 56,336 mark as well. I'm watching out for a couple of stocks today, early in the day, but a lot of shorts caught on the wrong side on Poonawalla FinCorp. The stock is up around 5.5%. Shorts unwinding their positions out there. And speaking about unwinding, there are long positions being unwound in names like Kotak Bank as well as SBI Cards. Two stocks I will keep on my radar particularly. One is Laurus Labs. Given the activity that we've seen, the stock may enter F&O ban today. Watch out for that. And IEX, that stock, came out of F&O ban on Friday. Seems like it may re-enter F&O ban given the sort of thrust of open interest build-up that we've seen in the first hour of trade itself.
Okay. Okay, all right. Thank you so much, Mangalam, for telling us what's happening in the F&O space. And this is happening at a time when we've seen the sharp fall in the Nifty yet again. It's a 40-point downtick. So that should just come for you, up for you on the screen as well. And the likes of Nestle India, there's M&M, Wipro, Kotak Mahindra. So there is some fall from the highs again on the Nifty as we speak. We'll slip into another break. Management of SBFC Finance will join us next to discuss their Q1 numbers and more. Stay tuned.
Welcome back. Continuing with corporate conversations, the management of SBFC Finance joins in to discuss the road ahead for the company. Mahesh Dayani, who is the executive director at the company, is joining in. Mahesh, good morning. Thank you for joining in. I'll get straight to the point because we are running out of time here. But what's driving the pressure on your credit costs this time around? Because your collection efficiency has also declined on a sequential basis. The early delinquency pool is showing an uptake. Is there a specific segment or a specific region that is causing this? And do you see this normalizing over the next 3 quarters?
So there's been almost 100 bips what we've seen in bucket 1. And that's something that we had called in pretty early. We called in pretty early last year that we see stress building up and building up more in particular pockets in geographies and towards the smaller ticket segment. Having said that, I think we were pretty much prepared for this particular outcome, and that's the reason we had guided that the credit cost is going to be slightly elevated. But if you look at our overall matrix, so you will see that our overall growth in terms of assets was close to around 7% on a quarter-on-quarter and 30%. But the pre-provisioning operating profit, which is your operating profit, grew more than what your assets had grown, so which grew by 9% and 34%, which means that at an operating level, you're able to price your assets well, you're able to borrow reasonably well, and you're sweating your distribution. Now, what are we doing with the enhanced contribution that's coming in? We are going to fortify our balance sheet and ensure that we prepare for the worst possible outcome by improving our coverage and providing more in various stages. So we feel that it's part of the routine, it's part of the cycles that we've seen in the past, and we're not really losing our sleep over it.
But your credit cost guidance has been raised marginally. From 1%, you're now at 1.1 to 1.15%. That's correct, right?
Yeah, so we had said that it's going to be 1.1, and I guess we've landed at 1.1. The way we are now looking at it, we have guided for anything between 15 to 20 basis points from the current level.
From the current level? From above 1.1%, it should be higher. Above, it could be 10 to 15 basis. What about AUM? I mean, it's been growing healthily, 30% up on a year-on-year basis. And I think you spoke about a 5 to 7% increase on a sequential basis in AUM. Yes. What gives you that confidence? What's going to be driving it? And what's the outlook on yields? NIMs.
So we've been guiding for 5 to 7%, I guess, for now more than 9 quarters. Our guidance hasn't changed. And the confidence is largely because of the large distribution that you have. You may have some pockets of inconsistencies which may come in. We've already budgeted that close to around 15 to 20% of the distribution where we might have to curtail. But the balance, 75 to 80% of the distribution is well sweat and will continue to grow. And that gives us the confidence that your 5 to 7% number is going to remain intact. So if you look at our quarter numbers, we were close to around more than 800 crores in disbursal. Even if we were not to grow and we tighten all our filters in terms of underwriting, we will still grow by 20% on disbursal and more than 25% at an AUM.
One final question, Mahesh. You mentioned you're not losing sleep over the rise in credit costs, but is the stress that is building up coming from the new loans, or is it coming in from the legacy book? And what are the underwriting measures that you are undertaking currently? Are you strengthening them further? Tell us more on that.
Yeah, so if you look at our customer acquisition that has happened over the last 4 quarters, you will see that customers with a score of more than 700 have gone up by 200 basis points. Now, almost 87, 88% of our customer acquisition have a score of more than 700. We might end up tightening that further and probably be leaning more towards 90%. When we talk about delinquencies, it's not 90 plus. What we talk about delinquencies is that if anyone who skips a single EMI is counted as a delinquent customer. There are some pockets, early delinquencies, but we've seen that happen in the past. I think close to around 18 months back, we went through the same cycle because of some pockets in some geographies. But it's reasonably fair to assume that we will be able to cure it and then pull it back. So that gives us the confidence that it's not going to worsen from where we already are.
We'll leave the conversation here. Thank you very much for joining in. SBFC Finance now up 3.5%. Get into a break. We'll come back with more on the markets. Indices are mildly lower, but so many individual stocks are buzzing around. There is Sterlite Tech, there is Acme, Aadhar Housing Finance. We'll come back and talk about some of them.
Welcome back. Still 20 points lower on the index in some very, very choppy moves that we are seeing on the benchmark indices. But when you talk of specific stocks, Kotak Mahindra Bank continues to remain the top loser, 6.5% lower. It's been stayed at those levels. But just pull up Shankara Building Products is one of them. That stock is down 10%. And the other big loser today is Paras Defense. That stock is also down 9% now in today's trading session. It reported results on Friday, and since then the stock has seen a very, very sharp gash in the last half an hour of the trading session. But with that, we take your leave on this edition of Trading Hour. From Rima, Sonal and me, thank you for watching. Halftime report on the other side.
Stocks oscillate in a narrow band on mixed cues from earnings and the global trade front. Energy and utilities, the big gainers, while realty, IT and financials drag.
TCS says it will lay off 2% of its over 6 lakh workforce, mostly in the mid and senior management levels due to skill mismatch and no feasibility of their deployment. The move aimed at getting future-ready sparks fears of similar actions by peers.
Kotak Mahindra Bank sees margins crimp in Q1. Credit cost too sees a sharp rise. The bank points to stress in the microfinance and retail CV segments, which it expects should ease in the second half of the year. The stock slides.
The US-EU trade deal has reduced tariffs on auto exports from EU to the US to 15% from 27.5%, resulting in a significant relief for automakers like Tata Motors, JLR, and auto ancillary makers like Samvardhana Motherson, who have facilities in Europe. Both the stocks higher.
Hello, good afternoon, and you're watching Halftime Report coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala, with me is Mangalam Malu as well as Ekta Batra. Good afternoon, guys, and market doesn't seem to be doing anything great, right? Actually, it's very volatile. We've seen it go to the green, then come off the day's highest point. Again, very muted day right now, at least what we're seeing coming in, just a bit of a negative bias. And broader end of the market, that's also quite dull in today's trading session.
You know, if anyone watched the test match yesterday, it was a draw, but some draws are better than wins. And that's exactly what has happened in the market today as well. We were seeing a big gash over the last 4 trading weeks, and now there is some resilience. From lows, the Nifty has seen some improvement, though at the higher level we are still seeing some selling. So it's not a victory, it's a draw, but it's a resilience that we're seeing on the market. The IT index, the Nifty Bank, both of them putting pressure. Nifty Bank because of Kotak Mahindra's earnings, and IT after what's taken place with TCS, them announcing layoffs. But when those two heavyweights are not doing too well, we have the Reliance stock, which is actually doing extremely well. So Reliance is actually supporting the cause of the bulls right now, which limits the Nifty's cut to just 25 points. And even if you look at the broader markets, you know, it could have been far worse than what it is right now. We still have 1,000 stocks which are in the green, and the India VIX too is still moderate at around 12%. In fact, it has seen a rise, but then 11 to 12% is fairly moderate.
Hi guys. Yes, absolutely. I think the biggest talking point is what's happening with IT and what has been happening with the IT index. So that will probably be a key monitorable in terms of the trend for the market as well. If you look at it, month to date, the Nifty IT index is down around 8.9%. TCS, TechM, HCL Tech, all of them are down over 10% this month itself, giving you a sense in terms of the kind of pressure that we are seeing, and it's not stopping at this point in time in terms of negative news. So that continues to be the key talking point for today. But separately, a lot of results coming out today. So BEL, Mazgon Doc, so those stocks will be in focus. Separately, IndusInd Bank also will be reporting its numbers today, along with GAIL as well as Torrent Pharma. So it's definitely going to be a busy day in terms of cues that we can expect as well. But nonetheless, let's kick off the show with Rainbow Children's Medicare, which is the first corporate on our show today. The company reported what was a mixed performance in Q1 with steady margins and healthy profits. Remember that they run pediatric and maternity hospitals across the country. But their occupancies have declined year on year as well as sequentially. Dr. Ramesh Kancharla, the chairman and the MD of Rainbow Children's Medicare, joins in to talk about the quarter gone by. Hi, doctor. Thank you very much for joining in. Well, if you could just start by telling us about, the occupancy is dipping to around 40%, but your RPOPs, or your average revenue per occupied bed, rising in early teens. So just give us a sense in terms of what the mix was, which resulted in these two parameters.
Obviously, the seasonal business, which has actually been quite lower, even the last quarter, the Q4, and which continued into the Q1 of FY26. So what we've seen is that the lower pediatric outpatient volumes, as well as the inpatient volumes, and plus pediatric intensive care. That segment of the business has been still a kind of a knot has come up, which is why we see the lower occupancies and footfalls into the hospitals. So what has done well is that, the pediatric surgical work, pediatric specialty work, and also the pediatric quaternary care, the cardiac transplants and neurosurgical, in those areas have done very well. So because you got the better case mix, and also with the surgical, more in surgical, which is actually pushed up kind of your RPOP because of the big ticket items, as well as kind of shorter loss, because most of the pediatric surgeries are actually minimal access surgeries. They actually go home by second day.
So that's just what I wanted to know. I wanted to understand how much was surgical as a percentage of your total sales this time, or as a percentage of your total revenue, as compared to last year?
I think it's grown by at least by 15%, the surgical overall volumes as well as the revenue-wise.
Right. Dr. Kanjala, if you could, reiterate for the viewers once again your guidance for this year. I remember the last conversation that we had, you had guided for revenues to grow between late teens to about 20% in FY26. Whether that stands, and on the RPOBs as well, you expected that to increase along with occupancy. If you could give us a broad band on all these parameters: overall revenue growth, RPOBs, and occupancy.
We remain very optimistic about our growth because 3 more quarters are there that we just started kind of getting into the busy season. That will give us a kind of the late teens to up to 20% of the revenue growth. And RPOPs, it still depends on kind of what kind of case mix you kind of anticipate and see. If there's going to be a lot more of a tertiary care, intensive care work, definitely RPOPs will be higher. If there's going to be more of a seasonal business, then RPOPs may not be going up significantly. But at the same time, you do drive the top lines, you do drive the EBITDAs. That's what the ALAS gets lower and lower.
You were earlier saying that average revenue per patient could grow 6 to 7% every quarter. Yeah. You refrained from giving a full year guidance, and you are refraining for that now also. But quarterly, we can see this 5-6% sort of improvement, right?
Yeah, I think since this quarter is kind of fairly flattish in terms of the revenue growth, I would expect about 6% growth in average revenue per patient year on year. This is what we kind of guided earlier also. We remain optimistic about the 6% growth.
Okay, 6% growth continue is what we're expecting in average revenue per patient, even in FY26. Dr. Kanjala, what about your margins as well, right? You've seen much better margins than what you've guided for. You'd said 25% and plus around that mark, but now you're managing to do 25%. Last quarter was 31%. For FY26, would you want to, up your guidance for that? Do you think you can still do much better than that?
Very unlikely, because we are going to have 3 more hospitals coming in this year, which is all the 3 new hospitals. Almost about 250 beds are going to come into operation. So there will probably be some degree of margin pressure, probably a half to 1%. That's what always we see it. At consolidated level, what we expect is about the margins pre-Ind AS would be around 24 to 25. The post-Ind AS will be about 29 to 30. This is how our business kind of we envisage.
Okay. Well, Doctor, I wanted to just come back to the surgical revenue. You said that it's risen around 15% in terms of volumes. Is that probably the trajectory that you all are going to look at? High-end surgeries and surgeries as a whole contributing to majority of the sales in order to sort of negate the impact of maybe lower occupancies? And if so, what would it be as a percentage of your sales?
Yeah, I think it won't happen instantly. It's a kind of a surgical volumes to build in a children's hospital. It takes a longer horizon, and because it's a dominantly a medical hospitals, surgical business will grow as we add more and more specialties and super specialties and doing a complex surgeries. That would improve. It's a trajectory is over a period of time, over the period of years. So it will still remain a dominantly a medical hospital, the pediatric healthcare. The surgeries will definitely go up as kind of our hubs start maturing more and more. We start adding more and more specialty surgeries like neurosurgeries, cardiac sciences,
sure,
and those specialties in other geographies like Bangalore and Chennai as we move forward.
Sure. Just a quick follow-up that I had. You have said that you're looking at inorganic plans as well. How much cash do you have on your books right now, and what are the type of inorganic plans that you are considering?
I think we have a cash on the balance sheet about 735 crores as on today. So we are exploring an opportunities probably that may cost about cash outflow maybe about 150 to 170 crores. So this is what we were looking at for the acquisitions. So I think we do not really have a many in the pipeline for acquisitions. Whatever is there, we're trying to work on that. So the rest of them are really a greenfield and brownfield opportunities. What we have and what we have in kind of almost 800 beds for capex. I think that more or less we pretty comfortable to kind of fund all our capex through the internal accruals or the cash and balance sheet.
Okay, Dr. Kanjala, thank you so much for joining in with us this afternoon, giving us an insight in terms of what we should be expecting from the company going forward in FY26. So that was the management of Rainbow Children joining in with us. But on that note, we're actually going to slip into a very short break and, tune in to CNBC TV18's brand new show, Finding Alpha, at 2 p.m. today amidst global uncertainty, volatile markets and asset quality concerns. Our experts will delve into the top NBFC stocks to track. So don't miss this critical analysis as we navigate the current financial landscape with our viewers. Welcome back to Halftime Report on CNBC TV18. Not much of an excitement coming in on the Nifty front as of now. Flattish, bit of negative bias is what is continuing for the market as of now. But let's move on to the next earnings that we have and the management that we have joining in with us. Intellect Design Arena, they reported their numbers. Mixed set of numbers that came in from the company. A bit of a miss that came in on the revenue front from what the analysts were expecting. But deal wins, that was a positive sign. Good deal wins that came in from the company. Now, to understand the outlook of the company going forward, we have Arun Jain, Chairman and Managing Director at the company, joining in with us. Mr. Jain, good afternoon, and thank you so much for joining in with us. Let's just start by talking about your revenues, right? You've spoken about this also, that revenue guidance you've given is around 800 crores per quarter. This time it's somewhere around 700 crores for this quarter. Now, you have a couple of significant deal wins that have come in the month of July as well. Are you confident of achieving this 800 crores in Q2 and onwards for the rest of the year? And overall, what are you expecting in terms of deal win momentums now?
Okay. So first of all, let me clarify. We are not given 800 crore guidance. We look at it that we run the company 100 crore by each. Last quarter was 700 crore and this and above 700 crores. I think somewhere there's a communication gap. We said next milestone is 800 crore in next 3 quarters. So obviously by Q4, Q3, Q4, we should cross 800 crore. And that's how the journey has been moving as an Intellect as a company. It's not a quarterly journey, as you mentioned, an annualized journey. Year on year, we've grown 18% on top line, which is a very, very healthy growth, and 27% on bottom line is a good growth. When we had a last quarter, which was very, very healthy, that has resulted into a large expectation from the analyst, and then they projected higher number. But our consistent growth is more important for us. As we mentioned, that we designed the company for 20% growth year on year. And that's what we are looking for. It can be 15%, it can be 5%. It's in a double-digit growth, which we are looking at, and that's what we are committed to.
All right, double-digit growth. It can be 15%, it can be 20%. Let's see how that goes. Mr. Jain, I remember 800 crores was one of the numbers. You said over the next 5 quarters or so, you aspire to reach over 1,000 crores as well per quarter. So does that aspiration stand? And what about, your revenue mix? I look at your license revenue, your AMC revenue, and your implementation revenue, along with cloud SaaS revenue as well. How do each of these verticals grow over the next 3 to 4 quarters? And when you reach that 1,000 crore per quarter run rate, what would your revenue mix look like?
Yeah, so 1,000 crore run rate was, again, 3 years number, not 5 quarter number. So I think there's somewhere maybe I've communicated wrongly, but that's a number of 3 quarters. That 4,000 crore we want to achieve in 4 years with 1,000 crore PBT in the investor call also I communicated by 29. So that's the number which we are looking at. And from a perspective of the growth, our number coming from Purple Fabric is a great booster for us. We are the first business impact AI platform has been created for the world. It's there are 2 kind of data-driven lifecycle AI, which is done by a lot of AI companies in Silicon Valley, and they are application lifecycle AI, which is done by Palantir, C3, and Intellect. There are 3 companies in the world which have done it. And we have a most easy-to-use platform called Business Impact AI platform. And we are distributing this platform through our SI partners. And then we are looking this to be included in the ISVs. So it's a horizontal strategy. We launched it on June 3rd. I had a first masterclass, and we got 400 leads into this particular area. So this is a phenomenal success, which we mentioned to CNBC earlier, that it can have potential of 4 years, 1,000 crore to 5,000 crore. So I think 1,000 crore is more or less established. Now it's a question of how do we move the journey from an Indian entrepreneurship to make product, to be a great product in a global marketplace. Like DeepSeek came from China, Palantir came from US, and this could be competing against Palantir.
Okay. Well, your guidance, Mr. Jain, at least on margins, were around 21 to 25%. Correct me if I'm wrong there.
Yeah, that's right.
Are you on track to achieve that, considering that you've closed out Q1 FY26 at 20.4%? And the range for, say, Q1 to Q3, I'm not talking about Q4, was 19 to, say, 20%. Only 27.9% was probably the highest you've done in Q4. You would have to really, buck up your margins in the next 3 quarters.
That's right. And those are the investments we made. So Purple Fabric investments are going on. So next quarter, also the investment will be there in distribution and sales. We hired significant senior leadership in last quarter, and we participated in marketing almost 25 events in 1 year. We did 50 boot camps in AI. So those investments will go up. So we are bullish on the acceptance of our platform and eMAG.ai as a platform. And margin is a 21 to 25% is what we are looking at it, and we are consistent on it.
Okay. Mr. Jain, just in terms of geography mix also, I just want to understand overall how are the deals, where are they coming in from, and which segments also, if you could specify. 45% of your revenues are from, I believe, from US, Canada, Europe. And, some of them also have the tier 1 Canadian bank, which is there, which is a win that is coming for the company in the US. So overall, how are we seeing this geography mix move, and will developed markets be the main focus area in terms of growth for the company?
Yeah. So last year when I spoke to you, we were saying eMAG.ai is a platform which is a first principle thinking based platform, simplifying the banking and helping the bank to reduce their tech cost by 20 to 30% using eMAG.ai. And that's why we focus mainly in Europe and Americas. And we got significant deal in last quarter from Europe. This year, this quarter, we got 3 deals in US, and Canada is growing healthily now. So all the 3 markets, UK, Canada, and US are going well. Europe is also doing well in Hungary, Germany, Austria. Those are the other 3 markets which we are looking at it. So with that focus, our percentage business from all Western market will be higher because it's replacing the legacy, and there's a huge legacy sitting in these markets.
Final question before we let you go, sir. It was on Purple Fabric. You did, allude to it briefly, saying that will be a growth driver for you. Could you give us some specific numbers as to where this business would be in the next 3 to 5 years on an annual run rate basis?
Yeah, exactly. That's what I'm saying, that this will be 1,000 crore to 5,000 crore range could be possible.
That's a big range, 1,000 to 5,000. Could you give us a
my potential is so high is that if we put the distribution strategy right, then it could be 5,000 crore. 1,000 crore is what we are doing with the digital experts like insurance business, wealth management business, where we are applying the direct to the financial services. But this is a horizontal platform which can be leveraged by many countries. So that's why the large potential upside is there. But 1,000 crore is embedded into the eMAG.ai.
Mr. Jain, before we let you go, we've all woken up to negative news with regards to the sector that you operate in, TCS, and the attrition or the layoffs that they're looking at. Give us a sense in terms of where you see the landscape probably changing or moving towards, say, in the next 2 to 3 years. We had some experts say that, there could be a shift in terms of the model. There could possibly be a margin crunch going forward as well.
Significantly, I mentioned earlier in an informal conversation, I don't want to mention about it, but it's not looking good. Next 2 to 3 years, Indian industry is looking bad on services side because AI is replacing significantly the new set of skills, and middle managers who are not aligned to relearn to AI are going to, and the companies which have to readjust to their business model, to the new way of delivering business outcome based throughput. So it's a big problem area which I'm seeing in the next 3 years as the overall big slide in the number of jobs in IT industry, unless somebody is focusing on business outcome based, product based delivery and systems into the world.
Okay, Mr. Jain, thank you so much for joining in with us this afternoon on CNBC TV18 and, giving us those detailed insights in terms of what we should be expecting from the company in FY26 and a couple of years from there as well. Thank you so much for that. But let's move on, and we have Hormas to take us through the stocks that are moving around in trade today. What is the news flow around them as well? Good afternoon, Hormas.
Good afternoon, and the index might show you a different picture, but there are plenty of stocks in the broader markets that are moving around in today's session. Paras Defense being one of them, and it reported results on Friday, fell 3% after that, and another 10% knock today, now on very strong volumes as well. And from the 52-week high that it had made in the month of May, the stock has corrected already 30%. Car Trade Tech results came out just a few minutes earlier. The stock fell after the immediate results announcement, but since then has seen a very sharp recovery, 10% higher on that stock. And from the March 2023 low of around 350 rupees, the stock is up almost 6x from those levels. Sudarshan Chemicals is the top gainer on the BSE small cap index today, and it's trading with very strong volumes as well. 11.5 lakh shares already traded on the stock compared to its 20-day average of just around 48,000 shares at this time of the day. Lodha Developers is another result reaction today, but you can also say that the entire real estate space is under pressure in today's session. All 10 stocks on the index are trading with losses. And lastly, Sterlite Technologies, another result mover. Results came out on Friday, 8.5% higher on the stock, and take a look at the volumes here. 1 crore shares traded already compared to a 20-day average of just 36 lakhs. So plenty of movers in the broader market, some on the green and some negative reactions as well.
Okay, all right. Thanks, Hormas, for that. So yes, that's what's taking place in terms of specific stocks at this point in time. The Nifty weak, down around 53 odd points. We have the Sensex, which has lost over 200 odd points, and the Midcap as well as the Bank Nifty down around 0.2%. So volatile day, choppy day, you would have to say at this point in time. The Nifty IT index down around 0.3%. Well, we'll take a break, but as we do that, a small programming note for our viewers as we slip into that break. As the workplace transforms, so must leadership. In the Bangalore edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on July 29th, 5:30 p.m. onwards, only on CNBC TV18, CNBCTV18.com and YouTube.
Welcome back. A bunch of stocks doing extremely well. Emphasis for one has moved to the high point of trade. So a big up move is what we're seeing out there. Laurus Labs is the other one which continues to move higher. And earlier today, we got the numbers of car trade tech. The EBITDA jumped by nearly 98%. Net profit jumped by 94%. Street likes those numbers. Stocks moved into double digits, up around 11% for that counter as well. But let's get in a handle on what's taking place in the F&O space at midday. Nigel joins in. Nigel.
Well, you've seen an intraday recovery from the lows, but the structure and the texture of the market is looking a little bit weakish. And I say that because those bounces actually are getting sold into. And as we speak, we're trading below that 24,800 odd mark. If you look at one index that will have to do the heavy lifting, it'll have to be the Nifty Bank. That's doing, it's falling in line with actually what the Nifty is down. The last time I checked, it was down close to around 0.3%. But I think that holds the key, because it's defending some key technical levels. Let's run you through the options data. The 24,800 call as well as put, both of them are fairly active, and the premium on both of them are around 100 and around 150 rupees. So you club the premium together, it's around 250 rupees. It appears the markets are bracing for a bit of a move in either which direction, and those that are writing both these two strikes, which is known as a short straddle, well, they'll be eating into the premium. So if you just plug in those numbers on the downside, the 24,550 mark becomes important. Keep in mind, we have the monthly expiry that will play out on Thursday itself. So you put the premium together, you pocket close to around 250 rupees or thereabouts, and you hope that the market, trades in this vicinity of roughly around, on the upside, 25,050, on the downside, 24,550. So that's the hope. Now, a couple of technicals that we have been highlighting, they are moving towards a range where we could see some kind of a relief rally. We'll not be out of the woods, but the Nifty PCR, that's down close to around, at around 0.7. Last week, it went dancing away to around 1.2. So that's 1 point. The second point is the FIs have been piling on the shorts, and sometimes they get stumped on the wrong side. That at least is the hope. So we don't rule out that there could be some kind of a bounce if the lower levels are protected, but it could be feeble till we take out decisive levels on the upside. And stocks that I'm looking at, well, SBI cards, that one's seen a lot of pressure. For this series itself, there is some unwinding, though there is some build-up in the next series. MotoCorp, it appears there is some kind of short covering bounce that's playing out on this one. And Cipla, the street, like what the management had to say, there is some long build-up being seen on that counter as well. There are two big triggers that I'll be looking at from here on. The Reliance Industries stock, well, that needs to get closer to around the 20 DMA. So in terms of technicals, that's the very, very important mark, because that's like an index by itself. And the other one is the Nifty Bank. As I said, it's holding on to that 50 DMA. You wanted to protect that and gradually starts making its way to around 20 DMA. So both those two heavyweights, they hold the key from here on. And before we wind up, the stock that I'm looking at is Laurus Laboratories, because if you look at this contract, it appears there is some shedding of open interest. But you look at the next contract, that's the August contract, that's big build-up of open interest, more than 45 lakh shares getting added out there. And if I look at the open interest as a percentage of MWPL, it's around 97%. And to alert to our viewers, if it's more than 95%, then there's a possibility it goes into the F&O ban. So that's one of the candidates that could move into the F&O ban. So as things stand, we're holding on to that low of around 24,725, but a bounce will need to, sustain from here on. Back to you guys.
Okay, all right, Nigel. Thanks very much for that. Yes, in fact, Laurus Labs, that one is really zooming ahead today, up around 7% at this point. Just look at the way it's moved this year. It's up 49% this year itself. So big moves which have come in for Laurus Labs. And in fact, the street seems to be quite happy in terms of the guidance that they've given as well. Sudeep Shah of SBI Securities now joins in on the show to discuss what he's tracking on the technical. Sudeep, hi, welcome to the show. Start of the week. Markets are still choppy. Tell us what you're strategizing both in terms of the index and stocks.
Good afternoon, Ekta. Ekta, yes, markets are choppy, and as Nigel was pointing out, most of the bounces are getting sold into. So what we're seeing is that Nifty is now showing some kind of inability of crossing 24,850, 24,870 post this gap down opening, and some bout of recovery from 24,730, 750 odd zone. So we feel that now from a positional perspective, 24,930, 24,950, where the 50 DMA is placed, that is now becoming a very important level for us. So we feel till 24,950 is not crossed, Nifty could oscillate between 24,550, 24,600 on the downside and 24,950 on the upside. And crossover about 24,950 should be used by bulls to go long and wait till then. From a Bank Nifty perspective, 56,000, 56,100 now becomes very important, although it's very close by to the current market price. But that is the most important support zone that we feel, because below that, 55,500, 55,300 cannot be ruled out. So all trailing stop losses for long positions for Bank Nifty should be placed at 56,000. And on the upside, for the bull run for the Bank Nifty, positive momentum to continue, 56,600 needs to get crossed. So ideally, we are strangled between this tight range between 56,000, 56,600 on the upside. And so 56,000 will have to be a trailing stop loss for all long positions in case of Bank Nifty.
Okay, Sudeep, and the stocks that you're keeping an eye out on?
A couple of stocks, one from the cement space, that is Ramco Cement. Now here we have seen a decent breakout on the upside. 1175 is where the stock is trading currently. Last several weeks, the stock is holding well above its 20-day moving average, 20-day exponential moving average. And once again, even today and on Friday, the stock has taken support at the same moving average, trading above all its moving averages on the daily, weekly charts, breaking out on the upside. So we feel that this could be bought with a stop loss at 1140 on the downside, and potential targets on the upside could be closer to 1220, 1240 levels. The second stock that that I have on the radar is a chemical name which has been decently performing in the recent times, and the stock is Navin Fluorine. Stock is giving a breakout post its consolidation for the last 2 weeks at higher levels, almost at an all-time high level. So from here on, we feel that the stock is placed well to go to higher levels closer to 53.50, 54.30 zones. And this could be bought with a stop loss at 5,000 on the downside.
All right, Sudeep, thank you so much for joining in and giving us your stock picks as well as your call on the index. We are seeing, a couple of stocks being fairly well bid as we move into the short break. Just pull up Asian Paints. Reports their numbers tomorrow. The stock already has seen a correction of 30% from the peak, but has recovered from the lows, citing the worst being behind. That's what analysts expect. So let's see how this pans out. We take a short break, but as we do that, remember to tune into the all-new CNBC TV18 Prime, which brings you insights from policymakers, business leaders, economists, all of them shaping both the India and the world's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens comes in at 8:30 p.m.
Welcome back, and joining us on the show now is Himanshu Agarwal. He's MD Satyam Balaji Group. Himanshu, hi. All headlines when it comes to agriculture commodities seems to be coming in from rice, whether it is about very strong export numbers and the expectation of that continuing, or it's about the kind of procurement that the government seems to be looking at near record highs. Let's start with export numbers first, and from 10 billion to 14 billion, an expectation of a higher number this time around. How are you looking at export markets and the competitiveness that India holds?
Oh, hi, Manisha ji. So what I feel is that in export markets, India is facing a very tough competition from countries like Vietnam, Myanmar, and Thailand. However, we have, held our ship steady, and there is still a bit of demand after especially the price correction that India has seen in last 2 quarters. So now I feel that, eventually we would see a bit of a dip in export numbers going down the line comparing to last few years. But we should not have a huge decline. But government needs to find a way to channelize its stock into the export market in a better way, because we have not been able to gain access to the huge pile of stock government is sitting upon. So that is something which will give a huge boost if government can find a way of doing that. In the meantime, record procurement, 53 million tons, almost 1% higher than what it was last year, and government struggling to find space to keep this cargo. State governments doing auctions all over, but somehow these cargoes are not able to find their way into the export markets. So that, because China has done that, Thailand has done that in the past, that whenever there were stocks went to comfortable over the guidelines and they still had to do the procurement, they found a way of liquidating these stocks into the overseas market. So I think that's one thing government needs to think over if they want to continue the procurement like they're doing right now on year-on-year basis, because this excess that India is producing every year because of higher incentivization of farmers. Now Odisha government has also started bonus, so you would expect more harvest and more cultivation of rice in that state and few other states where new incentives have been announced. So the number of 149 million tons of cultivation is going to go higher with every passing year. So government needs to find a way of channelizing the excess procurement. Only then this wheel can perpetually run.
So, Himanshu, what's your sense on what subsidy or what measures should the government now come out with? Because all those restrictions that we saw in sense of rice exports, almost all have been done away with by March 2025. So what is it that you're anticipating or hoping for from the government?
So basically, we can look at the higher percentage of ROTDEP. We are just getting about 0.9%, because Indian competitiveness because if you see the export numbers of rice, we were at 22 million tons in 2022-23, and there has been a substantial decline on that number. Maybe on absolute, in dollar terms, you're seeing an increase, but in rice quantity-wise, there has been a dip in export. So if you want to go back to 23-24 million tons of export, we definitely need the interest subvention back. We definitely need a higher ROTDEP and access to the government stock. I mean, because if you see on the hindsight, Indian government is the largest consumer of Indian rice in the local market. So they are the ones who are, kind of keeping the price at bay, and it's not reaching at a more competitive level as it were, in 2021-22. So we need to find a way to keep the prices competitive. So, I mean, these are a few measures that government can take by which we can get back to 23-24 million tons of export.
Himanshu, we've seen Indian markets in quite a euphoria when you look at all of those rice stocks because of the kind of rice availability that we have and the expectation that the exports would do better. But you're saying that while the numbers seem really good, it is the concern of competitiveness that the sector continues to face.
Absolutely. I mean, these news of Indian government sitting on such huge stock of rice is not something the buyers in Africa or Asian countries are not aware of. The moment you're speaking to a buyer, he's talking about, what are you guys going to do with this rice? So everybody knows that we are sitting on this huge stock of rice, and with the new crop approaching in the next couple of months, so everybody anticipates the markets to correct, but the government in some way is providing that support to the market, which is not going beyond a certain level. So that's why the competitiveness is, something which is a bit of a concern, because we have today Thailand at par with Indian prices, about $360, $375, which was never the case. Thai used to be at least $30-40 higher than Indian rise, but today they are at the same price. So of course, some of the demand are shifting to the other countries. So if you want to pull back in those demand and we have to go back to the earlier numbers, definitely there's some steps that needs to be taken care of.
Himanshu, how would you look at the international prices as well? Because they have continued to decline too. It's not just India. We're looking at better rice crop in various other origin countries too.
Yes, that is true. But India has a reason. I mean, all of a sudden the duty was removed. So that crashed the prices by about 20-25% globally. And then all of a sudden there was this availability of rice. So while India imposed restriction, while India put on the duty on certain varieties, the other origins racked up their production and everybody was trying to fill in the gap, the vacuum India created. But all of a sudden, when India came back to the market, everybody was sitting on a huge stock and they were all kind of, crashing prices. So this kind of, this phenomena created a depression in the rice market, wherein we are seeing that, it's not like the old days, we're not seeing the demand. It's not like we have people calling, in numbers and trying to get their hands on the rice. Everybody knows that, there are multiple options. So even if India is not available or if India is not competitive, there are multiple origins they can go back to. So this uncertainty in government policy has created, has taken away a fair bit of market share from India in certain destination because, we were absolutely absent for 2 years. So they had to look for alternatives and now they have gone to those alternatives.
Absolutely.
Okay, all right. Thanks very much, Manisha, for taking us through that interesting conversation. We need to take a short break as of now with the news that the markets are still under pressure, quite a choppy day. We'll get you more on the markets and lots of stocks on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. Now let's shift focus and talk about the pharma pack and especially Laurus Labs. That one is trading at a 52-week high. The number came during market hours on Friday. But today the run-up that we are seeing is quite exciting. What's happening here?
Well, you know, the stock is really turning around in terms of the performance by the companies. So they've finally started reporting numbers on a sustainable basis. So there was a lot of worry with regards to, you know, what is taking place with the ARV business, the CDMO business picking up, the margins for Laurus Labs. So there were a couple of quarters which were quite volatile for Laurus, but now it seems as though it's come on track. Now, in terms of the guidance as well, it's been quite positive. So they said that the CDMO revenue is expected to grow from the current 30% to potentially 50% revenue in the medium term. CDMO revenue is estimated to be around 2,000 crores in FY26. Gross margins should be around 55 to 60% in coming quarters. They have not provided for quantitative top-line guidance for FY26, but they've said that it's laid strong foundations for FY26 and beyond, and they expect margins to improve in FY26 as well. Now, in terms of brokerages, Goldman Sachs has a sell. The target price is raised to 675. Jefferies has an underperformed. The target price is raised to 590. And Kotak has written on Laurus. They have a sell with the target price, however, which is raised to 555 rupees. So overall, the street seems to be much more positive with regards to Laurus Labs than before. But let's in fact listen into the management, or maybe we'll take a break on that note and we'll come back with more. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. Now let's talk about IndusInd Bank. That's expected to report its numbers today. What are we expecting this time around? Gaurav is joining you with us.
Well, yes, when we talk about IndusInd Bank, we are expecting weak set of numbers. Let's not forget that we've already seen weak set of numbers in terms of provisional updates, where we have seen loan book actually declining almost by 3%. And as a result, when it comes to net interest income, now Street is expecting 22% decline in net interest income on a year-on-year basis. When it comes to net interest margins, now let's not forget that there was a one-off impact, and that is the reason why in the last quarter net interest margins came to 2.25%. So on a reported basis, we may see an uptick of around 80 basis points. They are expecting 3.2% of net interest margins in this quarter. But if we exclude that one-off impact, the NIMs would have been at 3.4%. So 20 to 25 basis points on a normalized basis is what we are expecting. Other than that, pre-provisional operating profit, there also we are expecting around 40% decline on a year-on-year basis. In this quarter, we may not see credit cost spike because last quarter credit cost was high. So we will see credit cost easing, and at the same time slippages will also ease but still remain at an elevated level, and as a result profit is likely to decline almost by 70 to 75%. Now remember, we will be watching out on the commentary on the net interest margins. How bank is commenting on the growth is also something which we'll be watching out for, and specifically the commentary on the MFI is also something important. But in this quarter, story goes beyond numbers. There are certain things which will be watched out for. First is that the progress on the appointment of new MD and CEO, how the commentary is going to be. Second is that they have recently enabled the provision for 10,000 crores of QIP, so we will watch out for commentary there as well. And third is that now RBI has given an approval to allow promoters to nominate one more director, so we will also watch out for how the tone is going to be from the management in terms of this case. So all in all, in terms of number, weakness is what we're expecting, but commentary is also a crucial thing to watch out for in IndusInd Bank this time.
Okay, Gaurav, thank you so much for that. But with that, we're absolutely out of time on this edition of Halftime Report. Leaving the markets almost at the day's lowest point, advanced decline ratio more in the favor of declines. And by the end of the show, now only 600 stocks almost are advancing. So keep an eye out on that. Up next, your business lunch to take you through all that action.
The market slumps to the lowest point of the day amidst mixed earnings, and on the global trade front, news, realty and metals along with IT stocks are the ones dragging the index lower, while pharma and FMCG is bucking the trend.
TCS says it will lay off 2% of its over 6 lakh workforce, mostly in the mid and senior management levels, due to skill mismatch and no feasibility of their deployment. The move, aimed at getting future ready, sparks fears of similar actions by peers.
Kotak Mahindra Bank sees margins crimp in the first quarter. Credit costs also see a sharp rise. The bank is pointing to stress in the microfinance and retail commercial vehicle segments, which it expects that it should ease in the second half of the year. The stock is the top Nifty loser.
The US-EU trade deal has reduced tariffs on auto exports from EU to the US to 15% from 27.5%, resulting in a significant relief for automakers like Tata Motors, JLR and Samvardhana Motherson, who have facilities in Europe. The stocks gain.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios in what is promising to be a topsy-turvy day for the markets. I'm Hormuz Fatakia. With me, as always, is Vamakshi Dhoria. Vamakshi, good afternoon. Well, just before a few minutes earlier, we were seeing that the Nifty is testing 24,800 on the upside, even moving towards 24,850. And within a few minutes, we are now almost at a danger of breaking 24,700 on the downside.
Oh, absolutely, Hormuz. And gloomy session on D Street is how it's panning out, similar to the weather outside, When you take a look at the Nifty, it's down almost 119 points, trading at the day's lowest point that you've been highlighting, Hormuz. And largely dragging this is Kotak Mahindra Bank. The company came out with a dismal set of numbers over the weekend. Along with it is also Bharti Airtel. That stock is down almost 2%. That is also, dragging the index lower. But on the flip side, what is actually contributing to the index is ICICI Bank, HDFC Bank, Cipla, as well as Reliance. Let's take a look at the mid-cap index as well. The cuts here are far higher as compared to what we're seeing in the benchmark index. The mid-cap index is reeling under pressure, down almost 0.8%. Again, trading close to the day's lowest point. The small-cap index will also come up for you on the screen. And the broader market itself is very, very weak, with the declines far outpacing the advances. The small-cap index too is, underperforming what we're seeing on the benchmark index. But, despite that, we're seeing very stock-specific moves given by the earnings. And Hormuz, it's largely a screen that is, rewarding the numbers that are good and punishing the numbers that are bad.
There's also a case of running up too much too soon, right? We went up from the April lows. We almost had a 4,000 point move from those levels in anticipation of better earnings, and even earnings that are managing to meet expectations are not being rewarded whatsoever. Take CDSL being a case in point. On a sequential basis, the numbers look fairly okay. But on a year-on-year basis, the numbers are lower, and that's showing up on the stock. And it moved up to levels of around 1,700 to around 1,800, and now it's seeing a cool-off to levels of almost 1,500 now. That's a negative earnings reaction that we are seeing in today's session. But of course, there are some big movers on the downside side of CDSL. Paras Defense is now in a 10% lower circuit, and I came out with results on Friday. The stock was down 3% then, and now it's locked in a 10% lower circuit. So the defense companies, we keep an eye out on that, because Masgao Dock also reports results in just a few minutes from now. But the top story of the day, of course, has been TCS and their plans to reduce their workforce by almost 2%, which signifies job cuts for close to 12,000 people. Rima brings in the details on this one. Rima.
Thanks so much for that. So the big question is, do the job cuts at TCS signal a big tech reset? Well, the news is that India's largest IT services firm, TCS, is letting go of 2% of its workforce. That is nearly 12,000 employees. And this is largely the mid to senior level, and it would be spread across FY26. Now, this is significant because TCS is the bellwether of India's $250 billion IT industry. Job losses at this scale are not just rare for TCS, they're unprecedented. So what is the key driver behind the job cuts? Well, it is a growing mismatch between demand and the available skills. TCS insists this is not about AI replacing jobs or the need to hire less. CEO K. Krithivasan told Money Control that this is not about AI giving you 20% more productivity gains. It is about skill mismatches and the feasibility of deployment. But that said, there has been a slowdown. There has been pressure on margins. And in an AI automation world, we need fewer people. Fewer managers will be needed. The mantra is basically you can do more with less. Now, global tech giants have already made very deep workforce cuts, and this has been happening for a while. Just this year, Microsoft has axed nearly 15,000 jobs in 2 rounds. IBM has reportedly let go of 8,000 employees as AI has replaced HR. But now what's happening is that the tech layoff wave is hitting closer home. TCS calls it as a part of a journey to become a future-ready organization. But the deeper shift is clear, that the traditional, people-led, a linear revenue model is now giving way to an outcome-based AI one, a platform one. And it hasn't happened overnight. Indian IT companies have been stealthily, quietly rebalancing their headcount for nearly 2 years. This is the picture over the last 2 years and how the headcount has changed. For TCS, it's lower by more than 2,000. For Infi, about 12,500. Wipro, in excess of 25,000. So the question is, what lies ahead? Will other IT companies also follow suit and optimize their workforce to become future ready? So do we have more job cuts coming for the entire sector? Will the industry continue to delay wage hikes? Remember, TCS hasn't given their wage hike as they normally do in April. And in the near term, say for a company like TCS, will this trigger a spike in attrition or will it in any way impact the job delivery? So lots of questions. We'll have to see how this plays out. But this could just be the start of a deeper transformation in the Indian IT, the way it operates and survives in this age of AI.
Well, thanks so much for that, Rima. But we also spoke to a whole host of experts and industry veterans on what this means for the sector in general. Let's also listen into that.
I think the focus on the Sholay dialogue, kitne aadmi the, or headcount based judging the IT industry, I think, thank God that period will be over. I think all of us will have to rewire ourselves to start looking at output and outcome-based business models, outcome-based pricing, and more importantly, looking at what it does for the business or what it does for customer, instead of looking at IT and systems in isolation.
Even if you look at the IT sector, my own bet would be that 1 million jobs will become redundant, whether it's testing or documentation or programming, of course. But at the same time, new jobs will get created. So I tend to agree with the TCS narrative that this is a future-oriented restructuring. Because in the days of generative AI, when you're using ChatGPT a little bit and helping yourself, that was fine. But this is the day of autonomous agentic AI, which means that 80% of the work could potentially be performed autonomously. So in that context, when you look at your organization top to middle to bottom, then you do a fundamental rethink. And I think every industry, it does not just IT, but definitely including IT, will do this reorientation. There will be some shedding of jobs. At the same time, they will be creating new jobs with new skills.
Looking at Mr. Krithivasan's comments, it seems that it is not AI related, and that is how I would interpret it as well. Because had it been AI related, you would have seen more jobs being cut at the lower end of the org structure. So it probably is just a bit of being more efficient and optimizing the organization. And to that end, I think it is a good move for TCS.
Well, the entire discussion around the layoffs announced by TCS and the expert reactions to that. Shifting focus now to the financial space, and Kotak Mahindra Bank, along with Shriram Finance, are reacting in opposite ways on the back of their first quarter numbers. Kotak Mahindra Bank continues to remain the top Nifty loser. Shriram Finance, though, is bucking the trend in an otherwise weak market. Gaurav is joining in with more details on both of them. Gaurav.
Well, yes, when we talk about Kotak Mahindra Bank, let's not dwell into numbers and see what has actually went wrong with the bank. First is net interest margins. They have declined almost by 32 basis points on a sequential basis versus the expectations of a fall of around 16 to 18 basis points. Now, let's not forget that bank has said that this is because of the shift from unsecured, and at the same time, repo rate is also impacting the net interest margins. They believe that in Q2, net interest margins will reach its rock bottom, and from thereafter, we will see some kind of recovery and stabilization on net interest margins. So that is one area where there were concerns from the investors. Second is the stress in asset quality. Now credit cost that has increased almost by 30 basis points, whereas market was not expecting this move. They were expecting the credit cost to remain stable, or rather they were actually expecting credit cost to decline a little bit. So that was a big negative surprise for the market. What bank has said that specifically they are seeing some kind of stress from MFI segment, CV segment and seasonal factor. Credit cost also for that, they are saying that in the second half of the year, we will see credit cost actually normalizing. So definitely there was some positive comment, but on the back of the numbers, we are seeing a negative reaction from the market. On the other hand, let's also talk about Shriram Finance. When the numbers came on Friday, we saw the stock tanked almost by 3%, but today the stock is recovering, and the reason being the positive commentary. What happened on Friday is that the net interest margins actually came in at around 8.11%. There also we saw a fall versus the market expectation of the flattish net interest margins. That was something which was disappointing. But what management has suggested that by end of FY26, we will see net interest margins going back to 8.5%. On the other hand, they are also reiterating their ROA guidance of 3% and the loan book growth guidance of 15%. So that was something positive. What was already positive is that the credit cost. Now credit cost was actually declined almost by 40 basis points, and there also management has said that the guidance is going to be somewhere around 2%. So that was positive, and as a result, we are seeing some positive reaction in this stock today.
Well, thanks so much for that, Gaurav. So contrasting moves, Kotak Mahindra Bank clearly the casualty of the day, while Shriram Finance, recovering from the losses that it made on Friday on the back of strong commentary. Let's now shift the focus to commodity space. We have our colleague Manisha Gupta joining us, and today we will be focusing on cryptos. Manisha.
Cryptocurrencies as a sector has continued to surge in most part of 2025. And if you look at the previous week, we've seen very strong gains continue here. So while Bitcoin has hit an all-time high of $123,000, that has taken the overall crypto market cap to a record 4 trillion and above. And it's not just about Bitcoin, which has been making newer highs. It also is the kind of surge that we've seen in altcoins, in stable coins, that has been surging as well. So when you look at almost 1,300 exchanges and almost 17,000 cryptocurrencies trading within is when we get to this market cap there. Well, the momentum also has been strong with the kind of institutional and corporate buying that we've seen come in for cryptos, and the kind of very friendly and push-in legislations that we've seen in US as well also has taken the markets on the higher side. Interestingly, it also is about ETFs in the markets, especially for the month of July, where we have seen further inflows coming in for many of these cryptos. When you look at Bitcoin ETFs, well, $5.5 billion is what you saw as major inflows here. Even the Ether ETF has managed to garner $2.9 billion of inflows in the month of July alone. Now, going forward, the street does believe that you could be looking at further gains into the market because the buying in institutions is just about started, not just in US, but major Western world as well. If you look at the last 1 month, the month of July, that is, we've seen Bitcoin prices gain up by 11%, but the altcoins really have surged. So Ether is up 57% for the month of July. Cardano is up 47%, Solana up 26%. So it's having very, very strong gains for the month of July, with an expectation that you could be looking at higher highs for the rest of this year.
Manisha, thank you for that update. Well, it does look like all that glitters right now is crypto. $4 trillion now of market cap for the entire crypto market. Take a short break. But just as we do that, a small programming note for our viewers. As the workplace transforms, so must leadership. Now, in the Bengaluru edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. You can catch this live on the 29th of July starting 5:30 p.m. only on CNBC TV18, CNBCTV18.com and our YouTube channel.
से।
Welcome back. You're watching Business Lunch on CNBC TV18. Well, now on to the latest in the India-US trade front. Sources are suggesting that there has been no breakthrough in trade talks between the two nations ahead of the August 1st deadline. My colleague Parikshit Rutra is joining us with the details on this. Parikshit?
Well, yes, no breakthrough in talks yet. And we're just a few hours away from the 1st of August deadline. In fact, we're told that since the 18th of July, there has been no progress in talks, and they seem to be stuck on certain issues. One, Donald Trump wants to impose a 20% tariff on India, and he wants zero tariff in return. That is not possible. India would want to impose reciprocal equal tariffs on the United States. Having said that, he wants deals on the likes of Indonesia, Vietnam, Japan. Remember, Japan has offered, apart from the trade deal, to invest $550 billion in the United States. Indonesia, too, has promised to buy 50 Boeing jets. They've promised to increase energy purchases to the tune of $15 billion, $4.5 billion worth of agricultural products. So these are the kind of major big-ticket investments and commitments that the US and Donald Trump are seeking from India. There doesn't seem to be any headway yet, but at the same time, the Indian government is not ruling out any interim deal over the next 24 to 48 hours. But it looks very, very difficult right now. Options are being considered. In case reciprocal tariffs come into effect on India, that is 26% plus a 10% BRICS tariff in case Trump decides to go ahead with that as well. India could also impose an equal reciprocal tariff on the US after the 1st of August. Also, what we will see continuing simultaneously is that trade talks for a larger BTA by fall, those will continue. There is a US negotiating team which is coming to India in the month of August, so they will discuss a larger BTA. But for the moment, any kind of breakthrough or progress or deal, interim deal, before the 1st of August looks unlikely.
Well, it does, and that uncertainty seems to be showing up on the markets as well. Now we're slipping below that 24,700 mark on the index at the lowest point of the day, 140 points lower, adding on to the drop that we had seen on Friday's trading session as well. Numbers from TTK Prestige, a 36% drop in its net profit. We'll get to that in just a bit. But in a major breakthrough earlier in the day, the European Union and the US have clinched a hard-fought tariff deal. Under the agreement, the European Union will face a 15% tariff on most of its exports to the US, including automobiles. Now, the compromise averts a full-blown trade war that experts warn could have delivered a hammer blow to the global economy. In what is the biggest trade deal ever, the European Union will buy $750 billion worth of US energy products and invest an additional $600 billion in the US. It is also expected to purchase hundreds of billions worth of military equipment from the US. The number was not specified by the US president. Let us in fact now listen in to the moment the deal was announced.
We have good news. We've reached a deal. It's a good deal for everybody, I believe. And I think you were saying this is probably the biggest deal ever reached in any capacity, trade or beyond trade.
It is.
It's a giant deal with lots of countries, because as you know, Ursula represents a lot of countries, not one country. It's not easy for you. It's because a lot of very different countries, great countries, but some are strong with cars, some are strong with agriculture. Some are strong with both, right?
Well, and as the August 1st tariff deadline looms, the US and Chinese officials will meet again to discuss their trade framework in Sweden's capital, Stockholm, today. China's vice premier and his team will meet with the US delegation led by Treasury Secretary Scott Bessent. Some political watchers say that the two sides could be working on an extension of their trade truce, which is set to expire on August 12th.
We'll take a short break for now. More news and updates continue on the other side. Stay tuned. Welcome back. Now, both Lok Sabha and Rajya Sabha were adjourned for the day after uproar by opposition MPs in both houses. In the Lok Sabha, Speaker Om Birla hit out at the opposition for not letting the question hour take place. The Speaker had adjourned the House till 12 noon with resumption scheduled for 1 p.m. The Operation Sindoor debate was to take centre stage during the proceedings today, with the opposition demanding answers from the government over India's 7th May to the 10th of May operation against Pakistan following the Pahalgam terror attack. The opposition also looks to corner the government over the 22nd of April terror attack in Pahalgam, in which 26 civilians fell victim.
Meanwhile, in some tragic news, 2 people were killed and 32 injured in a stampede at a temple in Barabanki district of Uttar Pradesh after a live electric wire broken by monkeys fell onto a tin shed. The incident took place while devotees had gathered at the temple during the holy month of Shravan, dedicated to the Hindu god Shiva.
And with that, we call time on this edition of Business Lunch. We leave you with the index at the lowest point of the day. From Amakshi and me, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. It's a Monday afternoon which is seeing a 200-point fall from the highs of the day. Midcaps are underperforming and we'll discuss more on the markets, but it is looking like a day for the bears so far.
day for the bears so far, and especially the BFSI space. Earnings across the board, especially for banks, have been quite a bit of a miss. Asset quality, even for NBFCs, has been quite muted. Credit cost worries, all of that is taking the entire BFSI pack lower. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks slipped to the day's low on mixed cues from earnings and on the global trade front. Real estate, private banks and metal stocks drag. Midcap index underperforms.
Optimism around book expansion of 40% boosts Poonawalla FinCorp after company reports its Q1 earnings. Management maintains their AUM growth guidance of 35 to 40%.
Shares of Acme Solar zoom in trade on the back of its Q1 numbers. Revenue increases 65% from a year ago. Profit also after tax also surges, aided by higher other income. The stock is up more than 8% in the session.
Zentek under pressure despite a good Q1 as profit halves as compared to last year. Management says they expect significant orders in FY27 from the United States.
Car trade tech sees a sharp recovery after a good performance in Q1. Net profit nearly doubles while margin also sees a sharp expansion. Stock up 6% from March 2023 lows.
All right, those are the top headlines, but the biggest headline is that sharp market fall that we have seen in the last couple of hours. It's a 200-point downfall from the highs. Nifty is at the day's low, and that downfall actually continues. It has been that one-way fall on the Nifty currently, and as Vivek was mentioning, it is led by these BFSI names. So private banking index, that should come up for you on the screen. 1.6% gone there. Nifty Bank is down 500 points, almost 500 points right now, and that's courtesy what we've seen in Kotak Mahindra Bank as well. The NIM pressure has been higher than what the street was working with. Across the board, there's a big cut. Be it the Midcap index, which is down 0.9%, the advanced decline ratio in favor of declines currently. Most of them are earnings reactions which have come by as well. So any miss on the earnings, the markets are punishing them. And look at those lines. So it was converging at a point in time, and now there's a big gap between the two, more in favor of the declines. And that's what we're going to discuss in the show as well. A lot of mid-caps which are reacting to earnings and news flow.
That's right. What's actually also contributed to the fall today has been some of the interest rate sensitive. So the realty pack, and especially in the last hour, a lot of the realty names have seen a significant cut in the session. Names like Oberoi Realty, Goddess Properties, all of these names, even a DLF for that matter, trading near the day's lowest point. But all of these names and a whole host of other stocks is what Hormaz has on its radar. This is our special segment, Midcap Movers. Hormaz is standing by the wall to take us through the midcaps that are moving around in the session.
If you're a bull, you may want to look away from the screen today. It does not paint a pretty picture whatsoever. As Sonal was just highlighting, any miss on the earnings is getting hammered and how. But we'll take a look at some of the positives first up. It's the earnings reactions that are on the positive side, stocks that are bucking the trend, if you could call it that. Car trade tech earnings came out today, 10% higher on that stock. Acme Solar and Sterlite Tech numbers reported over the weekend, both seeing healthy gains of around 7 to 8% in today's session. There are plenty of negative earnings reactions. You'll find out some of them. Paras Defense came out with numbers on Friday and it's down 10% today. It was down 3% on Friday. CDSL, after that initial recovery, has now slumped to the lows of the day as well. And Home First Finance too has taken a 6% knock in today's session. Real estate, as Vivek just highlighted, is a stock that is an index that remains under pressure, is a sector, is the top sectoral loser today. All of the constituents of the index trading with losses of anywhere between 3 to 5%. Some of the stocks that are doing well on the volumes front though, and look at Sudarshan Chemicals. While the index is at the lows of the day, Sudarshan Chemicals is at the highs of the day, 15% higher. It's a 52-week high for the stock. And Laurus Labs too, and the 900 rupees testing those levels today, 6.5% higher on that stock as well. And Aadhar Housing Finance did well initially, but has since given up some of those gains, still holding on to a 4% advance. And lastly, stocks that are at a 52-week high aside of Laurus and Sudarshan, take a look at Sarda Cropchem. Numbers came out Friday. The stock was up almost 19-20%. Sirma SGS and Manorama Industries too doing very well for itself in today's session. A 52-week high for that stock as well. Back to you guys.
All right, makes sense. Thank you so much for joining us, Hormuz, with that list. It's a good time to get a technical check on the markets. Sneha Seth from Angel One is joining us for just that. Sneha, a sharp fall from the highs. What is the market factoring in? What are the technical charts suggesting now? Do you think we'll break even these levels and see a lower level?
Yes, very much likely because if you see last three sessions fall, we have seen call writers shifting lower. In fact, today we are even seeing fresh writing coming in 24,800, 24,700 call strikes. At the same time, if we look at the daily chart, I believe there is one support zone placed around 24,650. But once we looking at the overall chart structure, it looks very much likely that we can slide below that and head towards 24,500, 450 zone is very much possible over here. Looking at the banking index, which was holding on to the gains, it has also, breached the rising trendline support zone. So looking at the overall chart structure, I think market may continue to, slide a little down, at least towards 24,500, 24,450 is the level to watch.
Thank you so much, Sneha. Sneha, so you see further downside. In this context, what are your top picks for the day? Any buy or sell calls for our viewers?
So one call which would be a buy, that would be Cipla. If you look at the chart structure, this counter has managed to, surpass the one trendline resistance, which was placed around, say, 1550, 1540 zone. So I believe looking at the overall chart structure and last two sessions volume-based buying, what we have seen, I believe this counter is heading above 1600 levels. So it's a buy for me. The target would be around 1620. And the stop loss can be maintained around 1527. Apart from this, the counter, which is a sell, that is IndusInd Bank. If you look at the chart structure for this counter, it was consolidating since quite some time. The counter has a resistance placed around 89 EMA, and this from there itself we are seeing fresh selling pressure coming in. So this counter is a sell with a strict stop loss of around 827 would be the SL, and the target expected will be around 780.
Thank you, Sneha, for joining in and telling us your individual technical picks. By the way, there's a further slide in the markets. We usually talk about the mid-cap movers, but if we take a look at what's happening in the Nifty currently, we have a couple of these big names at the day's low. There's Axis Bank, which is sliding. We have Coal India. Kotak Mahindra is at the day's low as well. There's Nestle, Tata Steel. All these stocks are leading to the fall that we are seeing on the Nifty as well. Overall, it is definitely Kotak Mahindra Bank, which is the biggest loser today, followed by Bajaj Finance. Since the time Bajaj Finance's numbers have come out and they have spoken about weakness, that stock continues to be on our radar. From the broader markets, the Tanla platforms, that should come up for you. That stock is down around 4.5%, reported numbers a while back, and they reported numbers basically, and it has been a slide on that one as well. Revenue grew 1.6% on a sequential basis, 3.8% on a YY basis. So that stock on our radar. JK Paper as well as lower in trade reports numbers today. So that stock as well in our focus. RPG Life reported numbers of the weekend. That stock also is at the day's low. So a lot of names actually which are seeing that sudden slide which has come by, and Nifty too is seeing a fall from the highs as we speak. But a small programming note for our viewers as we slip into a short break. As the workplace transforms, so must leadership in the Bengaluru edition of Future Female Forward, which is season 3. India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on July 29, 5:30 p.m. onwards, only on CNBC TV18, CNBCTV18.com and YouTube.
Welcome back to Midcap Radar. Well, the sell-off has intensified, especially as far as the broader end of the markets are concerned. Now the NBFCs too are falling in tandem. Some of the names like REC, PFCs, the power sector lenders, those are the names now under significant pressure. But one stock from the broader end of the market, especially in the NBFC space, is Poonawalla Fincorp. This particular stock continues to trade with marginal gains in today's trading session. This is after their Q1 numbers. Gaurav joins in with the details of this particular numbers.
Well, yes, when we talk about Poonawalla Fincorp, the one thing which is actually keeping the stock in focus is the growth guidance. Now, what has happened is that EUM growth has been at around 53% on a year-on-year basis. Now, remember, company had given a guidance and they are saying that they can actually overachieve the guidance. So let's understand the numbers first. Net interest income increased almost by 13% on a year-on-year basis. When it comes to the operating profit, we saw a decline of around 24%. But another trigger here is that the credit cost. Now the credit cost has come down to 2.6% on a sequential basis versus what it was at around 3.1%. That is giving some kind of confidence in terms of the asset quality of the business. When we look at profit, now that has declined almost by 78% on a year-on-year basis. But what remains positive is that in this quarter, AUM growth was at around 53% and it also translates into 16% growth on a sequential basis. Now what company has said is that they are maintaining their guidance of 35 to 40%, but at the same time they also indicated that they hope to exceed the target because of the new product line which is gaining good traction. So that is something which is keeping the stock afloat. As a result, when we talk about the stock, even as of now, the stock is up more than 3% today.
Okay, more than up 3%. So basically, whenever and wherever there is some positive indication, market is rewarding that with some returns on the stock as well. CDSL, on the other hand, is under pressure after Q1 numbers. Revenues below street expectations. Wamakshi is joining us to tell us more.
Well, Sonal, the numbers, when you look at the revenue, that saw an uptick of almost 15% sequentially. This is, a recovery as far as the previous quarter is concerned. In fact, in the previous quarter, we did see the revenues dip. The total operating expenses, though, grew at a slower pace as compared to that in the revenues, and resultantly, the EBITDA margin expanded by almost 170 basis points, pushing the EBITDA higher by almost 19% on a quarter-on-quarter basis. The net profit, though, grew only by 2% quarter-on-quarter, and that is because the effective tax rate for the company was much higher, resulting in a miss as far as the net profit is concerned, which is why the stock is down and out in trade today. Other than that, when you look at the segment-wise performance, the depository activity was quite robust. That segment saw an uptick of almost 22%. Remember, this is the core business activity of CDSL, and that has been doing quite well for the company. On the flip side, what did not do well is data entry and storage. That segment was down almost 13%. Repository, which is not such a great contributor, saw an uptick of almost 23%. As far as segment-wise margins are concerned, depository activity margins actually improved this time around to 444 basis points, and data entry and storage margins contracted very sharply by 1,208 basis points. So largely, when we look at the numbers for CDSL, the core business is doing well, but it's a miss as far as the net profit is concerned, mainly on account of the taxes, and resultantly the stock is taking a knock in today's trading session.
Absolutely right, Wamakshi. Thank you so much for joining us. Also remember, CDSL has rallied quite significantly from its recent lows, and that's another reason why we're probably seeing a bit of profit booking today. But Gaurav is still with us. Gaurav, Aadhar Housing also delivered their Q1 results, and along with that also a technical development, especially as far as the ownership is concerned. Tell us more.
Well, yes, when it comes to Aadhar Housing and the numbers were fairly strong. Profit increase almost by 19%. In fact, we also saw AUM growth of around 22% on a year-on-year basis with a strong disbursement growth of around 32%. Apart from that, what remains also positive is that the credit cost, although it has inched up, it is again in line with what the street is expecting. And now management has also continued with their guidance of around 20 to 22% growth in AUM, and at the same time 18 to 20% growth in terms of disbursements. But what is another trigger here is that the change in hands in terms of the ownership. Now let's not forget that Blackstone is a PE firm who owns around 75% stake in the company right now. What is happening is that there is a block deal, there is an open offer from Blackstone. This transaction can be taken as a change in hand because what is happening is one fund of Blackstone is going to acquire around 64% stake from the current promoter fund, which is the BCP Topco V7 PTE. Now what is going to happen is that let's not forget that there was an overhang that there will be some some kind of selling from the PE firm because that is how it works. But given that the PE firm is actually acquiring the stock, once again, it gives some kind of confidence to the investors that, you know, the overhang is not going to be there, at least in the near term. And it also shows some kind of confidence that the PE firm has on the business. As a result, when we talk about stock performance, it is up more than 4%, definitely on the back of the good numbers, as well as this new development which is happening in the ownership as well.
Okay, all right. Thank you so much, Gaurav, for joining us with those details. But a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of the CNBC TV18 Access program, a premium members-only experience on CNBCTV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back to Midcap Radar. Well, a couple of stocks that are buzzing, especially as far as the broader end of the markets are concerned. The top gainer on the NSE 500 is Acme Solar. Now, this renewable energy company delivered its Q1 results over the weekend. A strong set, very strong execution, revenues high by almost 65% for the company in this particular quarter. EBITDA high by 62%. EBITDA margins, despite the higher base, largely steady, and profitability aided by much higher other income this time around has come in at over 130 crore rupees. Now, what essentially transpired is that, especially when you're looking at the commissioning of projects, it's gone ahead and commissioned close to 350 megawatts of projects, including its maiden 50 megawatt wind project in Gujarat. Along with that, operational portfolio now stands at close to 2.9 gigawatt, and the company has signed PPAs for almost 55% of the under construction capacity, thereby improving the EBITDA visibility for the under construction capacity. The street clearly likes this, that particular stock doing very well in the session today. But one stock that's not doing so well is SBI Cards. Gaurav joins in with the details of that particular name.
Well, yes, when we talk about SBI Cards, credit cost is something which is causing the pain once again in the stock. So first, let's look at the numbers. Revenue increased almost by 12%. We saw a bit of a decline in profitability of around 7%. In fact, when we look at net interest margins, we saw an increase of around 30 basis points on a year-on-year basis. But what remains negative is that the credit cost. Now, it has reached to 9.6%, which is a 16-quarter high number. In fact, this is not just it. Now, management is also quoting that the credit cost is likely to remain somewhere in the range of 9 to 9.6%. So definitely we will see this number elevated even going ahead, and they are actually attributing this elevation because of the change in the assumption of the ECL model. And at the same time, let's also not forget that in Q3 FY25, when SBI Cards reported 9.4% credit cost, at that time management had indicated that they have reached the peak, but now we are seeing a new peak from the company. Other than that, what is happening is that the growth guidance has been cut down to 10 to 12% versus what it was at 12 to 14%. Let's not forget that in this quarter, we have already seen the growth slowing down to around just 7% on a year-on-year basis. And from here on, management, although expects growth to pick up, they have actually cut down the growth target. Now, going ahead, there is another trigger for the stock, which is the cost of funds, because now cost of fund is likely to decline almost by 25 to 30 basis points as per management because of the repo rate cut. But definitely at this moment, rising credit cost is something which is not taken in a positive way by the market. And as we speak, the stock is down more than 5% today.
Okay, all right. Take that point, Gaurav. Thank you so much for joining in. So those are some stocks which are on our radar today. But with that, it's a wrap on this edition of Midcap Radar. Stay tuned. Up next is CNBC TV18's brand new show, Finding Alpha. Our expert will delve into the top NBFC stocks to track. Don't miss this critical analysis as we navigate the current financial landscape with our viewers.
Well, hello and welcome to Finding Alpha, the show where we zoom out to understand the macro and then deep dive into the micro. All of this to sharpen your stock selection process. Well, today we'll be focusing on a very, very crucial theme. Who stands to gain amid the rate cuts and asset quality concerns? With the RBI shifting to a pro-growth stance and introducing a series of rate cuts, albeit modest, investors are weighing this against tepid credit growth and some signs of emerging stress in asset quality. Well, to unpack this, we're now joined by Digant Haria, founder of Green Edge Wealth, a firm that builds tailored stock and high-yield bond yield portfolios. Digant, by the way, has been tracking India's banking and NBFC space for over 16 years and brings a sharp lens to what matters and what doesn't in this dynamic sector. Well, Digant, thanks a lot for coming down to the studio. And we're looking forward to learning more about, the financial companies, NBFCs and some HFCs as well. How are you feeling about the sectors right now?
Thanks, Nigel. Pleasure to be here. Pleasure to be on the first show of, the first episode of this new series. So yeah, I think, banks, NBFCs, it's a very large sector. So always there's interest. And the reason for a higher, a higher scrutiny for this sector now for investors is, the RBI started reducing the regulations and they have cut the rates. Yeah. And there's a finance minister who said that NBFCs should not think of themselves as shadow banking and they should now go out and grow. So the government and the regulator wants this sector to grow. Which is the reason why we are all looking very closely where in the large space can we find our growth.
All right, Digant, then let's take that forward and let's focus first on the housing finance companies, because it's more relatable as well. Now, housing finance companies within that, some of them could see some margin expansion, as you said, because of the rate cuts. Lower cost of funds will help them. There is also backed by physical assets, which is good in terms of asset quality. And within housing finance companies, well, we'll break it down into traditional housing finance companies and affordable housing finance companies. First on the traditional lot. And we'll get those graphics up for you on the screen, the likes of LSE, Housing Finance and the likes. Yeah. Anything you like out there? Is there one of those companies that is better placed?
Nigel, I think, traditional housing finance companies, you highlighted a lot of positives, but then, all these positives come with very high competition. All private banks, all PSU banks, all regional banks, everybody wants to do affordable housing, and which is why the margins and growth both will be under pressure for this segment. So this is a segment which is best left for, somebody who's happy with 10% returns, because I don't see, a big upside in any of the stocks in this particular sector. I think if somebody is still very keen, maybe Canfin Homes has a little bit of turnaround story left, but otherwise I think best to focus on smaller names, niche names where banks cannot really come and compete.
So we'll keep the traditional housing finance. They're not giving you anything to really be very excited about. But let's focus on, the other ones. That's the affordable housing finance companies. And when we talk about real estate companies, their advice is always go with the larger names. But I believe from this space, you are looking actually a smaller name from the affordable housing finance. India Shelter, that's the one that's on your radar. I think it's well placed, though the loan book is the smallest, but the ROA is looking quite good. Tell us more and what's the rationale?
Yeah, so I think, the affordable housing story of India, a lot of times we say there's so much opportunity. Actually, that's not true. The opportunity is limited in affordable housing because all the housing prices have gone up. So in housing finance, we have one rule, Nigel, that you focus on companies which are small in size, because the moment you hit 20-25,000 crores in loan book is the moment where either your growth or your asset quality starts suffering. We have seen that with Gru in 2016, Canfin in 2018. These were also great affordable companies at one point in time and they're struggling later on. We've now seen it with Awas and some extent Aadhar also. So this is a space where I think smaller is beautiful. And I think amongst the small space, there is Aptus and there is India Shelter, which is like less than 10,000. Between the two, I think India Shelter has a better growth focus and better prospects of growing and maintaining their profitability. So I think that can be a business which can do well over next 18 months.
Yeah, and as you said, I think the loan book is less than 10,000 crores out there, but it gives you a good potential to grow. Just wanted you to highlight, what about the LAP exposure for these companies? How much is it?
Okay, so that is slightly, like we say these are housing finance companies, but anywhere between 25 to 40% of their portfolio is in loan against property or LAP, as we say. It's a slightly risky segment, but that is what gives them margins. These players over the years have really done it well, but there's a little bit of risk build-up. So you always have to be careful and not go overboard because, mind you, Nigel, these are all trading at 3.5 times price to book also. So they need to execute well. I think India Shelter over last 2 years, they have had a new management from Chola and I think they're doing things right. So I think that is where we have the best probability of success. But yeah, we have to be careful about LAP.
Pick of the pack, India Shelter from Digant there. Loan book size relatively smaller, but they've got triggers. And that's why Digant says that they're favorably placed. Digant, I wanted to ask you about the asset quality. On the asset quality side, particularly in various pockets, MSME, 2- and 3-wheeler space, there are suddenly some signs of some pressure. Right. For the sector on the whole, how are you reading it?
Yeah, so see, I think the pressure is in the high yield lending space. Like if we break down the entire lending space, the pressure is in the high yield lending space. So you look at microfinance, you look at personal loans, you look at unsecured business loans, and lastly, you look at these 2-wheeler, 3-wheeler loans. So these are all places where you lend at more than 20%. There is a stress. The stress is not come today. It is building up since the last 18 months. Yeah. I think another 6 months and we will find our feet. So it's not something which is alarming to me. I think we have already seen bad patches. We are about to, end those bad patches in coming quarters.
Yeah, that's heartening to hear because let's turn our attention then on the vehicle finance companies itself. From that space, HDB Financial, well, it recently listed. And those that bought in the pre-IPO would be a little bit worried, because the IPO came actually attractively priced. Yeah. Now, going at the current state of affairs and, the valuations that it trades at, what's your view on this name, HDB Financial? If you compare it with the traditional darling, that was Chola, always got the best in terms of valuations. Right. Out there, between the two, good pedigree, good parentage, what's your pick? How would you approach both these two names?
Yeah, I think, see, Chola, there is very little to complain, but the macro setup is really we were at the best possible scenario for the last 3 years. Good truck prices, good number of trips. So everything was going good. I think after 3 good years, we have a high base and, we are slowly decelerating. So somebody like Chola, who has seen amazing valuation expansion, amazing returns, I think that should rest now. The best days for Chola as a stock, maybe 1 year is a time of consolidation for Chola, maybe even a little bit of correction because it has run ahead in terms of valuations, around 5.5 times price to book. HDB Financial, on the other end, it has struggled over the last 2 years in terms of asset quality and operating costs. But I think if cycle improves, which is our thesis of this show, that, the lending cycle will improve in the next 4 quarters, I think HDB Financial can meaningfully outperform Chola. Not to say that, these are like small caps who can go up a lot and something like that. But between the two, I think the funds may actually end up shifting from Chola to HDB if HDB shows a little bit of execution. All right. So, and HDB is much more cheaper. So
absolutely, as that chart is telling you, HDB is still relatively more attractive priced if you look at it against Chola. So we take that on board. And in the near term, you would say, if someone is looking at a fresh investment, you'd rather pick HDB over Chola for the reasons that you've given. What about Shriram Finance? It was attractive. Then it became even more attractive, made its way into the Nifty, and it's a frontline name. Valuation cushion, but what is your view on the stock?
I think Shriram has also done really well. If you look at last 3 years, it's done better than Chola also, which will come as a surprise to a lot of the observers of this space. But I think, Shriram should also rest. Just like Chola, I think Shriram should also rest for some more time. Their numbers, we are at 3.5% ROA. So, when you are at a high base and the environment is not very favorable, you may not show very strong earnings growth, and stocks typically don't do well. It's a great business model, great company. But I think, you will get better opportunities after 6 months or 9 months.
Okay, let's talk about then. So Shriram, Chola, maybe a bit of a rest. HDB Financial is something that could relatively better place. But let's talk about a stock actually that's done very, very well. L&T Finance, the stock is up, I think, close to 50% in just the last 8 months or so. It's re-rated a fair bit. But since Mr. Sudipta Roy, since the time he took over, there's been a lot of good news that's coming in there. And we just spoke to them actually. They said that they'll grow by 20-25%. That's good. But they only cautioned that the MFI industry, that recovery could be pushed back by a quarter. Your view on the stock, it's already seen some part of re-rating. Is it getting started, or is the best already in the price?
Okay, so yeah, so see, they had this turnaround 3 years back when the new CEO joined. He changed the way credit is done, especially in two-wheelers and tractors. So I think that turnaround will be visible, from say next quarter or Diwali. And microfinance, as we say, is a pain for everyone.
Yes.
But if you look at the comparative charts, the pain for L&T Finance, Ujjivan, and Credit Access, these three companies, it has been the least. So they have been the best 3 out of the 40 microfinance companies. So I would think that this is one place where you have a large name, comfortable valuations and good potential, combination of all three. So if somebody is looking at the larger blue-blooded names between say Shriram, Chola, Sundaram, Mahindra Finance, L&T, I think L&T is a hands down can be a better performer than the other large names.
But the only point is, after the recent run, it's not that cheap compared to what it was. That said, what would the fair multiple you would give it, for L&T Finance?
So see, L&T Finance, all other diversified large groups, who have corporate backing, they're trading at 3 to 5 times price to book. This guy is at 2 times.
Yeah.
Obviously, it is because the ROEs are at 11-12%. I think as the ROEs re-rate, which they should over next 18 months, I think the valuations also have room to expand. So you have a 20% room to expand in terms of valuations, and then earnings compounding is what people can earn. And in absence of all other ideas, a lot of money can flow. So valuation expansion can be a bigger game as well, which we cannot predict today. But if Sundaram, Shriram, Chola, do not attract money, the money is going to flow somewhere else.
Well, Digant, so that's about the vehicle space, vehicle financing space. But I think the space that gives you some comfort is with the way gold prices have moved up. These gold finance companies actually could be pretty well placed. And also the commentary that's coming from the RBI, particularly in the last, I think, 10 to 12 months, has been favorable. That said, just give us a couple of basic numbers first. What is the size of the opportunity out there? How much of it is unorganized? How much of it is organized? The split between organized and unorganized?
Okay, so see, credit card, people like us, we get credit cards. We can just go and swipe whenever we want. Gold loan is sort of, a credit card for the businessmen and credit card for the poor. Whenever you need emergency loans, you pledge your gold, you get the loans. It is no more a distress loan in India. It's not as if when I don't have anything and there's emergency. So it's like a business loan. So instead of playing a personal loan company or a business loan company, gold loan is a preferred bet. That the overall industry is very huge. More than 15 lakh crores is the total industry size. But half of it is controlled by money lenders. Money lenders charge 36 to 40% interest rates. And it is almost criminal. Those rates are so high that, I think these NBFCs charge between 14 to 19%. So they have a very good case. The banks generally charge between 12 to 16%.
Okay.
So that is the spectrum. I think this is an industry which is growing because 1, gold price is extremely favorable. 2, the regulator has streamlined the guidelines, and the guidelines are actually in favor of the sector growing faster. And 3, you have more and more players who are coming in the gold loan industry, like Poonawalla is starting with 400 branches, L&T Finance acquired Paul Merchants, and so on and so forth. So when everybody markets gold loan, the industry itself expands.
Okay.
And when personal loans and microfinance loans are not easy to get, gold loans is something which shines.
And this 15 lakh crore, as you said, it's divided into 50% each of them.
Organized and unorganized.
So for the industry, what kind of growth rate are you working with for the organized sector?
So Nigel, I think these numbers may sound insane, but 20% is a bare minimum growth in gold loan industry, which we can see this year. That is when our credit growth is going to be 9-10%. So it will grow 2x that of the system, and because of all the 3 factors which I just highlighted before. One factor which every investor has to keep in mind is you have to keep your eye on gold price. If there's a big crash in gold price, then gold loan companies cannot do well for 6 months. That is a patthar ki lakir, or what do you have to say? It's a very big thumb rule.
Okay, all right. Muthoot, that's been the big daddy, right? It's always enjoyed those premium multiples in the space. But that's what could limit the upside. Instead of Muthoot, would you rather play the other ones that can now twinkle? Say a Manappuram that's got new ownership, or an IFL that's coming out of a ban. Yeah. So among these 3 names, at least, what do you like?
So I think there's a spectrum. Each kind of investor can pick what they want. Muthoot Finance will probably do the best because it is best suited to capture all the growth. But Muthoot Finance probably more for the large funds, for people who are happy with 15-20% kind of returns. For people who want to play a recovery trade, I think IIFL has a wonderful gold loan book. They will show you the sharpest upsurge in growth because they had an RBI ban and so on. And there's one more interesting company called FedFina, which is a subsidiary of Federal Bank. I think that is something which got listed a year back, slightly undiscovered by the market. And, to your surprise, in gold loans, we look at what is your per branch AUM. So Muthoot is number 1 with 21 crores of gold per AUM. Number 2 is FedFina. It is not Manappuram. It is not IIFL. Number 2 is actually FedFina. So, FedFina, IIFL are interesting. Manappuram, the new CEO is about to join. They have some more pain in the microfinance. So, maybe I'll wait for a quarter or so for it to settle and then we can move ahead. But these gold loan companies are really better placed than the personal loans, companies like, say, Bajaj, Poonawalla section, which will come to the next.
All right. So, in terms of preference, maybe Muthoot will not shine as much from now on. It could be a compounder, though, from here on. But the delta could come in from companies like FedFina and IIFL as well as a Manappuram. Well, you spoke about some of those consumer-facing finance companies. I'll tell you what. We'll slip into a short break. We'll come back and we'll continue the discussion. Digant will tell us what's his view on a few of those names as well. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha on CNBC TV18. Well, we're still in conversation with Digant Haria. Digant, we have discussed a few themes, but as promised, we're going to be moving now to the diversified consumer lenders. Bajaj Finance, that's been the poster boy, right? If you ask anyone in 15 years, where did you make your money? They would say Bajaj Finance. The problem is now that the numbers, even when they're good, people want more. Ye dil mange more, right?
Yeah.
Do you think Bajaj Finance has run its course? Or can it give, I don't know, maybe a mid-teens, double-digit returns from here on?
I think it has run its course. It's very, it's a very harsh statement to make, but I really think that it has run its course. If you look at last 9 years, the stock price CAGR of Muthoot Finance has been higher than Bajaj Finance. A lot of people don't know this, but this is the reality. See, Bajaj was a leader in physical world, buy now, pay later. You go to a shop, buy a TV, buy this. Now shopping has moved online and Bajaj is no more the leader there. So Bajaj, the main reason why Bajaj is struggling is it is no more a leader in any fastest growing segments. So Bajaj has been moving to different segments like gold loan, micro loan, tractor loan, everything which is traditional. Bajaj never did traditional stuff.
Yeah.
But now because they are not able to grow, I think they have reached a size that unless India's middle class and lower middle class does well, Bajaj cannot really outperform. So Bajaj's outperformance is now so much linked to what happens to the entire middle class. It can no more outperform the country in a big way. So I think we can, personal loans, MSME loans, two-wheeler loans, the credit card loans, they're all struggling. And, which is why, apart from Bajaj Finance, we should also be very cautious on companies like, say, an SBI Cards or companies like Poonawalla FinCorp, which are talking of very fast growth in such an environment. I think these are places where investors will have to wait a lot before they can see returns.
All right, so Bajaj Finance and Poonawalla FinCorp, for the time being, you would not be, looking to jump into it. But I want to ask you about SBI Cards, because that's the only listed credit card player, right? Credit costs remain elevated. Every time, there is something or the other, and now the best is yet to come, it doesn't come. Even, the past quarters numbers haven't been that impressive. So asset quality is an issue, credit costs go up, growth is not coming about, they're not making any big dent in any market share. What's your view on the stock? Because if you look at rank underperformers, this is one stock that comes to your list.
I'll just give you one line, Nigel, that in credit cards, if you want to make money, you cannot sell credit cards at petrol pumps, at malls, at railway stations. If you do it this way, you invite a customer segment which is not very strong, and which is why your asset quality issues never end. So 2021 to 23, their sourcing strategy itself was, you go much lower down the pyramid. And which is why you see quarter after quarter losses come and management is clueless.
Okay, all right. So that's aside. But JM Financial, that's something that you've liked. What's it? What's happening out here? Does it have more legs?
Yeah, so it's a capital market play. And if you look at this stock, 2008, the price was same as it is today. So it's almost 16 years. The company went through a lot of pain in the NBFC space. They have come out of that pain. So I think good times for the company are just about starting. It will be a very interesting capital market play to track for the next 2 years, because it's like a long 7-8 year of pain which is coming to an end. And capital markets division is doing very well. So instead of a mutual fund stock or a broking stock, we prefer something like a JM Financial where, there is a lot more steam in the business.
And it's got valuation comfort as well, even after this big run. So that's something that you like.
Absolutely.
All right, let's wind this down then by turning our attention to the micro lenders. Companies like Credit Access, Arman, they have 70 to 90% in this space, and they appear well placed. Do you like any of these two?
So see, microfinance is always cyclical. No matter what anyone tells you, there is a good cycle, there's a bad cycle. Right now, we are going through the deepest point of the bad cycle. Maybe in a quarter or two, from the deepest point, we'll start the upward journey. So if somebody is interested in playing cyclical stocks, I think this sector offers upsides. The best companies, the best managements are Credit Access and Arman in this space. But, we feel that microfinance, even in the upside, it will be a little slow because that over leveraging was just too much. So in this space, we like something else, which is Northern Arc.
But tell us more about this Northern Arc, because there was a pending large trade. It took place, got cleared out around 200 rupees. From there, that has been one of the biggest outperformers from the broader markets. So at around 260 ballpark, what's your view on this name?
Okay, so...
And what are the key triggers you'll be tracking on this one?
Perfect. So see, Northern Arc is a very unique company. They lend to 300 other NBFCs. That is their first business. Second business is they lend to small LAP, microfinance, just like, a lot of other companies, say SBFC or, 5-Star would do. So they have these two major businesses. One of the business, which is microfinance, had some trouble, and which is why the stock is trading at 1.1, 1.2 times book. I think the base business is so strong that once the microfinance down cycle is over and the up cycle starts, this will also re-rate quite significantly. So in Northern Arc, I see that there is a reasonable room, just like JM Financial or FedFina, there is a reasonable room for the business model to outperform in terms of earnings. So that is our business case in Northern Arc.
Northern Arc and JM Financial. But before we wind down, we had a couple of stocks on the screen, SBFC and 5-Star Business. They traded around 4 times approximately. What's your view on these two names, or are you going to give us an alternate?
See, I think both are into that very high lending space and they're growing fast. So this is an area which I try to become a little cautious, that high yield and fast growth. There's a chance of mistakes. Valuations are also very rich, so there is no margin of safety. So I think gold loan companies in this environment, investors are better off being in gold loan companies than in these companies. Maybe once the environment improves, we can do a shift trade. But
all right, Digant, it's been a pleasure having you on the show. Thanks a lot for joining in, explaining all of that to us. Just to rewind, India Shelter, something that you like. From the gold finance companies, FedFina, something that you like. And from the other stocks, Northern Arc, JM Financial, they could still look from here on. And that trade you spoke about, maybe it's time for Chola to make way for HDB Financial. It's been a pleasure having you on the show, Digant. We look forward to chatting up with you soon.
I'll just say one thing, that investors need to be patient. This whole cycle, it will take 2 or 3 quarters for the cycle to really turn around. And yeah, be long-term, track the businesses, not the stock price. And whatever we spoke is business analysis. That's it from my side.
Well,
thank you for having me.
Bang on, Digant. On that note, though, we'll wind up on this edition of Finding Alpha. Thanks a lot for joining in. We hope we managed to dissect the entire space for you. More news and updates coming up on the other side.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
The Hang Seng currently trading 0.4% higher. The Taiwanese index too trading with gains of a similar quantum.
You were saying this is probably the biggest deal ever reached.
On daily charts, the next support comes in at 24,773. So it's down 0.25%, 24,785 on the Nifty.
The recovery in the rural, it has been excellent.
And most of the components right now, they are in the negatives.
In an AI automation world, we need fewer people. Fewer managers will be needed.
These are the kind of major big-ticket investments and commitments that the US and Donald Trump are seeking from India.
It has been that one-way fall on the Nifty currently.
Well, that is the day so far, and it's turning out to be a negative day. 160 odd points lower on the Nifty is what you have as things stand. I mean, you know, Friday the market broke the previous low, and today we are basically down to the near-term. Actually, we've broken near-term supports as well. So, will the market find? Try to build some base around here. We'll talk about why that perhaps is the reason, especially from a futures and options perspective. Lots to talk about here in terms of single stocks as well. This is Closing Bell. We're coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant Surabhi. Rima with me, guys. Good afternoon.
Hi, afternoon. The picture across globe is a lot better right now. I mean, look at Asia. Hang Seng closed with a gain of about 0.7%. The Korean market's up nearly 1%. Even in Europe, now that the deal is struck between EU and US, you've got some gains, initial gains at least, about 0.5% up on the CAC tax and the FTSE. Perhaps the hope is we're closer to the end of the tariff-related uncertainty. The risk premium associated with the uncertainty is now ebbing. So there is green on the screen. But look at our own markets here. Look at that mid-cap, small-cap index.
But Rima, that's not been a trajectory of only 1 or 2 days. That's been the story of the last month and a half. And I was looking at precisely this. If you look at the divergence between the S&P 500 and Nifty, in just the last 4 weeks, the S&P 500 has climbed 3.5%. Individual stocks are done even better. Nifty's down 3.5%. So the gap is over 6%, exactly. And of course, you have the trade optimism in Western markets, and then you have earnings. I mean, solid US earnings, right? Whereas we are dealing with the earnings issues, earnings casualties. Today's name, of course, would be Kotak Mahindra. We'll talk about that. SBI card. Short point is that earnings, barring, of course, there are good names. I mean, Laurus would be a case in point. But these kind of stocks, big stocks, which when they come out with disappointments, something that was not penciled in, asset quality issues, it's a problem. And folks, I don't think we were going in with so much of asset quality concern in this quarter. Everyone was talking about margin compression. Market was prepared for that. But credit cost rising, asset quality becoming an issue, that's one more thing.
Absolutely. And, not very much to go with on the positive side, right? I mean, lacking in triggers. I just want to quickly run you through what's lined up here over the next 60 minutes or so before we go any further. And then we'll sort of get to trades, F&O, etc. So the sell-off in Dalal Street, of course, intensifying a little bit. Nifty has failed to defend the crucial 24,700 level. Real estate, metals, private banks, the worst. We'll take stock of the setup in the final hour of trade. Stock-specific action, Laurus Labs, of course, is up about 5-6%. The last I checked, we had the management with us, sounding quite bullish, actually. So that's something in a bit. IT pack, right? I mean, down just less than 1%. It's already sold off quite a bit, but it's another sort of downtick here. So we'll talk about this in the context of course, the announcement over the weekend from TCS, and we'll sort of take stock of earnings, which will come later. IndusInd, GAIL, Bharat Electronics are some of those which we will get you previews for. So that's the lineup here as far as the programming is concerned, and the stocks that you will see us discussing. But we want to quickly get to the action, don't we? So let's get to Mitesh with what he wants you to do in terms of specific trades here. Mitesh, are we at that point where you start to turn a little bit, think about the other side, or not yet?
Good afternoon, Prashant. Not yet is my answer, purely because, I mean, look at the market. The market isn't showing any signs of turning around. Barring a few pharma names, I think the rest of the market, majority of it, is still showing signs of this corrective pullback, kind of continuing, marginally extending. I talked about the fact that we could test 24,900, and if we break below that, we could even test 24,500, 550 zone. So I still believe that that's a likely outcome. Around this 24,500 or levels, give and take a few points, a couple of weekly supports kind of kick in. So I think that is the zone, where you would want to at least reduce your short exposure, take some profits on the short side, and then see if there's a reversal happening on the hourly probability charts, which I think we are still, few hundred points away from there. Having said that, on the stock side, I have one buy and one sell call. Dr. Reddy's, and I've talked about pharma as the positive setup. So Dr. Reddy's is a trading buy for me. Keep a stop below 1265, look for targets of around 1310. And on the short side is Adani Enterprises, which I would recommend selling with a stop at about 2550 for targets of around 2420.
Got that. This is going to be a big week globally in terms of earnings. 40% of the S&P 500 report earnings this week. They include tech giants like Apple, Amazon, Microsoft, Meta. You've got the Fed meet, and to end it all, you'll have the jobs data. And back home today, we've got earnings from BEL, Mazgao, IndusInd Bank will be tracked very closely, and Gale. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is now with us on the show. Mitesh, thank you for joining in with those trades. We'll come back to you. Gurmeet, first, Kotak Mahindra Bank, 7.5% gone now. I mean, were you taken by surprise? What is the advice? Did you hold it in your portfolio?
So, Rima, actually, they gave a very good Q1 update, and the stock ran up actually along with SBFC and Bank Nifty. And then Q1 earnings was a miss. So it's more of a bit of a reset if you see the movement in Kotak post the Q1 update. I think what slightly surprised the market was a larger than expected dip in NIMs. They were expecting about 20 bips. It came out to almost 30, 35 bips, if my memory serves me right. Also, the credit cost marginally went up, which led to more provisionings also, especially in the CV portfolio and a little bit in the MFI portfolio. But I don't see any reasons for stress. Good banks tend to provision more. They've sold their general insurance business also some time back. So I don't think so there's a structural any issue there. It's just that the market was expecting, it's the positioning which was there, expecting a better set of numbers. But if you see the credit growth, it was about 14%, which is higher than the industry growth. Also, I think with more mobilization in saving, and maybe in a quarter down the line, even NIMs should stabilize. The NIMs in Kotak in that case anyways are much higher. It's above almost like 4.5 versus some of the other banks. So I don't see any reasons to be worried. Also, the stock is consolidated for long. Disclaimer, we don't hold Kotak in our portfolio. We have ICICI, HDFC, Federal amongst the private sector banks.
Okay, Gurmeet, just coming to you. Good afternoon. Just the F&O setup, right? And let's bring in Mangalam. For exactly that, are there any indications from the F&O side, data points, PCR, etc., which gives us a sense one way or the other? Mangalam, take it away.
Well, the indication is more of the other way than one. We aren't likely to see any sort of immediate up move. That's what the data is suggesting. Earlier there were indications of the market being oversold, and thereafter there could be some sort of recovery, and that's exactly happened in the first hour of trade as well. But thereafter, once those recoveries were sold into, the bulls have thrown in their towel, and that's exactly what we're seeing on the frontline index. The Nifty Bank, as well as the Midcap index, all of them lower, and the India VIX, which was factoring in complacency over the last two trading sessions, has seen a big spike now. From the lows, it's rallied almost 21% from the lows that we saw just before Friday. And broader markets as well. There too, we've seen some towel throwing coming in, because at around midday, we had 1,000 stocks advancing. That number has now fallen all the way to 600, and the number of stocks which were declining have crossed past that 2,200 mark as well, telling you that both the red and the green lines are the widest distance that they've been all through today's trading session. Earlier we also saw the 24,800 put see some writing, hoping for support come by around that 24,700 mark. But now if you look at the 24,800 put, positions are being unwound out there. The writers out there have been caught on the wrong side, and the open interest out there has come down as well. Importantly, the writing on the 24,800 call, 24,700 call continues unabandoned, and the 24,500 put writers are now finding some sort of action out there. So the street believes that maybe supports coming lower for the market from 24,800, 24,700 come down to around 24,500. And the put call ratio, which was already at the lower end of 0.7, has now come in at 0.6 as call writers have increased their positions and put writers are winding down some of their positions. So now the next important level, if the market fails to hold the 24,500 mark as well, will be the 100-day moving average on the Nifty after having fallen from the 50 and the 20-day moving average. Amidst all of this, there are a couple of stocks which are seeing some amount of bidding, and we have Amber Enterprises. That's actually outperforming in an otherwise bleak market. Short positions out there are being unwound, so some short covering on that counter. But Laurus Labs and IEX, I'm keeping a very close watch on. Laurus Labs, in all probability, enters F&O ban today, and IEX as well, very close to the threshold level of entering F&O ban. So that's another stock we'll watch out for. Remember, IEX got out of the F&O ban just in the previous trading session.
Okay, absolutely. Need to keep an eye out on this one as well. Mangalam, thanks very much. And Laurus, definitely. We'll get the fundamental check on Laurus in just a bit. Stock's done very well after the numbers. Speaking of numbers, quite a few came out today and not inspiring much confidence. Actually, even where numbers are decent. For instance, Nippon Life, which is the mutual fund business, numbers were decent because you've got at least double-digit growth on the top line and the bottom line. And that's rare in a market like this. But the stock not doing too much, down about 1% or so. TTK Prestige was a weak set. Decline, top line, bottom line. Not a great quarter for TTK Prestige. Stocks down about 0.5%. But the two stocks that I want to put the spotlight on are from the defense space. And these are smaller private sector defense players. Zen Technologies and Paras Defense. And this is what the stocks have done after the numbers came out. Both have had a rough quarter. For Zen Technology, I mean, there's a major decline now. Year-on-year, revenue is down. Margins have compressed 300 basis points. For Paras, there is revenue growth, 11% revenue growth, but there's a margin compression of over 500 basis points. And given the rally, especially since April in many of these stocks, clearly the market is disappointed. Gurmeet, hi, good afternoon. You know, we always discuss this, and you're a specialist in this space, right? Having picked Solar Industries. So help us out here. I mean, a lot of people who would have bought these smaller private sector names going beyond the HALs of the world, they would be very confused, saying, should we hold on? This is just a one-quarter aberration. Or does it mean that this is too risky a space? What would you say?
So, Subi, it is tricky, and you got to probably, and it's a very technical business, and you do need to understand the lumpiness of the business because it's dependent on government orders and export orders. Zen Technologies, in this case, I think the subsidiary saved them the blushes, otherwise the numbers could have been even softer. I think what they have mentioned is that they will, over 3 years, they will do 6,000 crore stock. And that is where you can't take it quarter on quarter, right? So recently they got one more patent and then the stock ran up. And, the stock moves like this. When it went down from 2,500 to 1,100, we kept seeing lower circuits of 5%. And then from 1,100 to 1,900 also was 6-7 days of 5%. Okay, but, to their credit, they have 23, 24 patents. Because of the emergency procurement by the government in army, the normal orders, there is a bit of a delay. I think, the second half could be better. Also in simulators, which is where the biggest market is, they have 100%. They have 100% market share there. So as more orders come up, they should do well. And they're doing a lot of stuff in the anti-drone system as well. Have about 24 patents, if I'm not wrong, one of the highest in Indian companies. So you have to live with this volatility. You have to, look at and see what it has done in the last 3-4 years and not see it on a daily basis.
So you'll be a buyer of the dip. So Zen is a thumbs up. What about Paras?
Paras we don't have in the portfolio. So we have Solar, we have Zen, we have Bharat Electronics, and we have small exposure in HAL now. See, India is down to now 29 squadrons. We need like 43 in case tomorrow if we have a three-way war. And once this engine issues get resolved, you will see, massive order book playing out. Also now 60% of the revenue comes from service and repairs. So that also gives you some kind of stability and not as much as lumpy as some of the other businesses are.
Okay, so Solar, BEL, Zen, and a little bit of HAL. That's your defense portfolio right now.
I just want to say one thing. I just went back, Surabhi, if you remember, the first show on Editor's Playbook was defense, right?
The defense opportunity.
So I just went back and looked at where we did it, right? We did it on the 15th of May.
It was just after Operation Sindoor, I think.
Yeah, so 15th of May.
Yeah.
Guess what? The Nifty Defense Index, from that point, had a nice not a very large rally, but it sort of, because there was a phase when things were going well and all the beaten down names like IDFC, which had for years done nothing, they were all coming back.
Correct. Yeah.
We are exactly back at it's like a round trip. We're back at the 15th of May levels. The short point being that I think, and we were making that point back then, that, news flow and everything is one thing, but when you're buying stocks, you have to be careful about what you pay.
Yeah.
Because otherwise you get carried away, right? In terms of in terms of what you will pay. It's like rising tide lifting all boats, but not boats are equal in that sense. So I think it's important. Even something like an IDFC, I mean, I'm surprised. I'm looking at this now because I thought it rallied quite hard. I mean, from 360, 370 levels, just had a one-way move to about 650. It's back to 450. From 650
fizzled out very quickly for
650 to 450.
Yeah.
I mean. So you got to be mindful and be careful of what you pay. Otherwise, especially when you have a little bit of a frenzy, momentum, you buy something and then you're stuck. Then you don't know. You're waiting for they probably wait a while for you to sort of get your price back. It doesn't apply only to defense, it applies to everything. But I just thought make a quick point. Laurus is the one that Rima was going to. So let's just focus on that a little bit. Stocks up about 5.5%. Let's get the details of the results first with Ekta, who will play out the sound bites.
Well, yes, Laurus Labs, the guidance in the conference call has been quite encouraging post the numbers that came out during market hours on Friday. So they've said that the CDMO revenue is expected to grow from the current 30% to potentially 50% of revenues in the medium term. CDMO revenue is expected to be around 2,000 crores for FY26. Gross margins could possibly expand to around 55 to 60% in coming quarters. They did not provide a quantitative top-line guidance for FY26, but they've said that they've laid the strong foundations for FY26 and beyond, and they expect margins to improve in FY26. Goldman Sachs has a sell, but they've raised their target price to 675. Jefferies as well underperformed, raised the target price to 590, and Kotak Institutional has raised their target price to 555 and have a sell rating on the stock. In fact, let's listen in to what the management had to tell us earlier today.
Our gross margins were always between 55, 57 in the previous quarter. This quarter, because of higher revenue contribution coming from CDMO, the margins were over 59% now. Looking at the prospects, what we have, and we estimate the gross margins will remain between 55 to 60%. Primarily because of higher contribution coming from non-ARV and also increasing revenue share coming from CDMO. In 2021 financial year, our revenues of CDMO was 500 crores. Now we were able to move towards 500 crores per quarter. And we estimate the run rate looking good. As you are aware, CDMO business is bumpy, but for the entire year, we expect the CDMO revenue contribution will be over 30% for the entire year.
What a move in Laurus Labs. This year itself, Gurmeet stock is up nearly about 48% now on a year-to-date basis. Your thoughts?
So we continue to hold, Rima. So I've seen 70 to 700, then back to 250. Now a new high almost made today at 900. Again, very lumpy business. And I think in between they did heavy capex, and that did not come off the way they guided. And that led to severe underperformance in the entire bull market of 22-23. Laurus did not participate. And now once you have molecules getting commercialized, if you see the numbers of export month on month, June was almost 107 million. And now they've also got a big land allotted by Andhra government, where they've committed heavy capex, more capex than they've done probably in the last 10, 15 years or next 4 or 5 years. I think that is also one trigger for the stock to work, and promising employment also. So I think their chemistry skills, their ability in CDMO in terms of late life cycle strategies and I've been saying this for a while, that CDMO is where IT outsourcing was in 90s. And I think there's a huge opportunity once the Biosecure Act, if it gets passed and sees some light at the end of the day. I think a lot of our companies can do well. Catalent, Lonza, some of the Chinese companies do $6, $7, $8 billion top line. The largest one in our case does what, 600-700 million, which is Divis. So Laurus is already talking of 500 crores CDMO per quarter, which will 2,000 crores for the year. Still still a fraction of what the global market is. So I think there is an opportunity here. But obviously, as I said, it is a lumpy business, and players like CDMO, defense, you got to size your bets well. Diversify it. Don't go overboard in terms of having 10-15% weight in the portfolio, and have a 4-5 year view in terms of the R&D they are doing and what will pay out. It's extremely important not to chase momentum here.
You liken the CDMO opportunity to Indian outsourcing in the 1990s. Well, Indian IT outsourcing, the penetration, the arbitrage was very promising. But now in the age of AI, all that is getting questioned. And TCS's news flow over the weekend really rattled and shook sentiment. 2% of workforce on their base of 6 lakh plus. We're talking about 12,000. And TCS isn't alone. Even HCL Tech, and I think that news sort of got missed, but HCL Tech also clearly spoke about people and non-people, facility restructuring, which will play out in FY26. They didn't give any details, but they specifically said we will have people restructuring also in FY26. So clearly tough times. Global giants have already announced, job cuts, and they have been for the last 1 or 2 years, but now it's hit closer home. What have you made of all the, news flow? And, is just this the start? And we are going to see aggressive headcount cuts. And how will the investors react to this?
Obviously, they haven't done as much R&D as they should have, considering the cash balances most of our large IT services companies had. But there have been exceptions. There have been exceptions in mid-cap IT, especially Persistent, Coforge, maybe KPIT to an extent. In general, now we are hit with an auto slowdown, but maybe with the trade deal with the EU and US, where EU talks of only 2.5% import duty to US, it might be just good news for KPIT and auto, as a sector as a whole. I think some of the bad news is in the price. If you see the price action over a period of time, and we should not write off Indian IT services companies. I think we've made this mistake so many times. But AI is a bit of a genie out of the bottle. So we'll see how it goes. But I think we have the ability to pivot and really contribute towards it. They have the cash balances. There is a realization there. But for now, I think it's better to be slightly underweight there. Maybe tactical bounce can happen once the trade deal happens, or there is a some positive news flow order base. In our case, we are less than 5% in IT services. We have HCL Tech amongst large cap. And we are looking at adding in case we get better price points between Persistent and Coforge.
Okay. Got that. Gurmeet, come on, time for a new name.
Nothing new, Prashant. We've been, as I said, researching chemical. I think one space which has been out of favor has been chemicals, under-owned. 2-3 years of inventory destocking, price points. So we added JG Chemicals, which is into zinc dioxide and recycling of zinc. The end use is tire, and now they're expanding the end use to ceramics, specialty chemicals, pharma. That's done very well for us. We added at around 350 odd levels, so it did do well, and now there's a bit of a retraction happening. We are looking at some tactical plays in refinery space, considering the valuations. A lot of them are now. Some of them are like half of replacement cost, or maybe 1/3 of replacement cost. And with I think inventory losses behind you, shutdowns behind you, diesel cracks improving, you might see very good GRMs and sudden bump in profitability. Those are more tactical in nature. And we are, as I said, looking at some more opportunities in the recycling space. That's one space I really like. We call it a circular economy. And I think that's something where the market size is too small. So we are looking at increasing weightage in the likes of Vatek, Ganesha, Gravita, and some of the other names.
Okay. All right, Gurmeet, we'll leave it on that note. Thank you very much for joining in and giving us perspective. Quite helpful in times like these. We do have to take a very quick break. Market, well, still nursing a cut of about 150 points on the Nifty. Midcap index still down over 400 points. Take a break. We'll get some perspective going with Nitin Bhasin, Head of Institutional Equities at Ambit, as we get through what has been so far a disappointing Q1.
Welcome back. The Nifty below 24,700, 150 points gone in the benchmark. Sensex down 550 points. What about individual stocks? Hormus is here to put the spotlight on mid-caps and small caps.
There are plenty of movers within the broader markets today, and some of them are earnings reactions, some of them not so. But we'll start off with Paras Defense that came out with results on Friday. In response to that, the stock was down 3%. And today, the stock has seen a 10% knock as well. And that is the biggest single-day fall that the stock has seen since June 2024. And now with this fall, it is moving towards its 100-day moving average of 684. And this is also down now 30% from the 52-week high that it had just made in the month of May. So within the next 2 months, the stock has corrected 30% from those levels. Another earnings reaction which came out last week and since then has been sulking is DAM Capital. Another 7% knocked off in today's session. It's down 12% in the last 3 sessions. Now already trading below its IPO price, but it has already halved from its post-listing highs, which were well over 450 rupees. So continuing to see some value erosion, and since the 17th of July, the stock has gained only once. Northern Arc Capital is the other one. That too has taken a big knock in today's trading session. Another 7% gone today. It's the 5th straight day of losses, down 13% in the last 5 trading sessions. And even this stock now trades below its IPO price of 263. Now the fall here in Northern Arc Capital comes on lower volumes, which are less than its 20-day average in today's session. On the positive side though, Cartwright Tech came out with numbers earlier today. The stock saw a bit of a dip and then has seen a one-way move on the upside, 10.5% higher on that stock. It was a very strong recovery that the stock had post-earnings, and this was one of the biggest underperformers in terms of the new age companies until March of 2023 when it made a low of 350 rupees. The IPO price is 1600, and since those levels, the stock is up almost 6x, and today it's traded almost 40 lakh shares compared to the 20-day average of just 3 lakh shares. And lastly, JK Paper is one of them. At one point, paper stocks, everybody spoke about them, but today the stock is down almost 5%, down 6 in the last 7 sessions. And the last 3 years, the stock has had negative returns, even you compare in absolute terms. And this is after gaining 90% each in 2021 and 2022 as well. So plenty of movers on the downside, some of them trading on lower volumes despite seeing a big knock in today's session.
Right, Hormus, thanks very much for that. So that is the unusual movers pack with Hormus as always. Nitin Bhasin is with us, head of institutional equities at Ambit. Nitin, good afternoon. Good to have you with us here. Thanks very much. I mean, I think the big talking point is, of course, what's happened with the IT services, and Rima has been covering that for us. And Surabhi was reminding me that you had a bit of you were constructive on IT, Nitin?
Yes.
Back in March, you still hold that view after the result season? Maybe too late to sell, but I mean, do you think it'll make money from here?
I think you're right. For the last month and a half or so, our strategy call was to go underweight on banks and perhaps increase weightages on IT. Hasn't worked out. In the last 1 month, IT sector has underperformed the bank Nifty by about 5 or 6 percentage points. I think clearly that's what the past is. However, we are continuing to see that there is more risk building up on the credit in India in terms of credit growth, in terms of NIM margins, etc. So we believe that if you were to take a little longer view of 3 to 6 months, our view for the midterm for our investors, institutional investors, is from here on perhaps to not that much of risk of FY26 earnings estimates, at least for the large caps in the IT sector.
But Nitin, I mean, just elaborate on that call, because earnings estimates anyway, they're so feeble, right? We're talking 0 to best case 3-4% growth. So what is the view? I mean, is it just going to be a play on the cash, maybe better buybacks and dividends? Or is it that you're bearish on other parts of the market? Like you mentioned banking. So I'm sure the call is in tandem with the other tactical allocation. So just elaborate on that. And also the negative view that you have banks, that's turning out to be, absolutely spot on, at least just looking at short-term earnings. I mean, first quarter has been really disappointing. Barring HDFC and ICICI Bank, most others have disappointed, either on margins or on asset quality or both.
So, fair point. I think what we've been highlighting is that we are into the fiscal year in which the flows are reducing because of the last 12 months of Nifty performance or funds performance, because of which entering into a fiscal year where the earning estimates are very feeble again. Remember, the whole Nifty is not supposed to grow earnings more than about, let's say today, 8 or 9%, which is not any different from about one quarter back, 9 or 10%. So in a market environment where flows are perhaps reducing, number two, where the earning estimates are very, very frail or feeble or low numbers, where do you actually go and park your money? We've seen such cycles in India in the last 15, 17 years, twice play out for about 2.5, 3 years, where market has increased in concentration, in which profits start becoming concentrated. And hence, the three sectors which have performed in each of those two cycles in the past, when we've had that in 2010 to 13, or let's say between 17 to 20, what we've seen is IT, FMCG, and pharma have historically, delivered or outperformed the market. That could be one of the reasons that we have in saying that where the market moves, perhaps for the next 6 months or 12 months or slightly even longer, we've already seen market move sideways for the last now 9-10 months. Where do you go and lose less money? Perhaps that was the call. FMCG, pharma, which includes healthcare also, plus now IT. So that was one of the larger thinking behind this call. In the near term, what we said was the IT sector has seen a lot of downward revisions in the last couple of weeks or 3 weeks. And with that behind us, we thought that it's right time to add IT, but clearly hasn't worked out. But we said banks would actually go through more downgrades. It could continue in June as well as in September quarter.
So Nitin, the call is in the second half of the year, things get really tough for the Indian markets. We're in for a correction.
So clearly, I don't know about the market correction. We've seen periods in the past where we have seen markets move sideways, not generating more than about 2 to 4% CAGR or -2 to -4% CAGR. Because what are we looking for? We're looking for flows to pick up in India with a considerable trend, or we're looking for earnings trajectory to actually recover. Clearly today, FY27 earnings may be looking buoyant, but FY26 earnings clearly aren't looking buoyant. And if you look at the flows also, last one quarter may be good or 1 month may be good for domestics. But again, FIs have turned sellers in the last 1 week or fortnight. And what we see is pretty much a very unpredictable or not a very secular trend of flows. So hence, where earnings visibility is, at best, high single digits or perhaps, low single digits or mid single digits, and flows moderating, I don't see markets going considerably to higher levels. It could oscillate for the next 6 months to 9 months also.
Speaking of earnings, that's a big top line miss for BEL. It's a wide miss, almost 600 crores of a miss. The profits are fine. Maybe at the top line, it could be some spillover effects, some orders moving in, maybe to the next quarter. The revenue estimate that we were working with was around 4,800 crores. The company's done, far lesser than that. Though the EBITDA line and the margin line is not too bad. And that explains why the stock perhaps is holding up. In fact, they announced an order. BEL, in fact, just over the weekend announced a big order. It was a 2,000 crore rupee order. So that's what I'm saying. I'm not sure if that was expected to be accounted for in Q1 and spilled over to Q2. But anyway, that's BEL and stock is in focus. We'll get you more on the earnings in just a bit. On earnings, Nitin, hearing you out, we started the year with everybody telling us FY25 was bad. We had 5-6% earnings growth. On that low base, 12-13% to ho jayega. But will it happen? Do you see those numbers come through for the full year?
I think I've shared this before as well, that if you look at the last 15 years in India, every time we start the year at about 18-19% earnings growth expectations, and we moderate ourselves down to 11-12%. Perhaps that's the signs of optimism every country or every market faces from the sell-side analysts. This year around, we started the year with about 10 or 11% earnings growth. and we've already come down to closer to about 8 or 9% earnings growth. Last I checked was that mid caps and small caps have done slightly better than the Nifty earnings for this year. This quarter, with about 24 odd companies announced numbers, we're only up about 5% PAT growth as compared to 7% last year and 12% the quarter before. So I think earnings growth, as I said in the beginning, we're looking for, market always looks for either earnings or looks for event, or it looks for flows. Clearly, earnings are not playing out, flows are moderating. The event which is coming up to all of us is perhaps the festive season. And we all know that the consumption trends are again volatile. So the market will start looking at the trends of consumption going into the festival season. That information will start dominating the market moves or gyrations in the near term.
Nitin, just a quick word. So the big sector calls are you're bullish on tech, pharma, consumer, and you're negative underweight on banks. What about some of the smaller, themes like platform companies, quick commerce, or real estate, defense, realty, cement? What about, just quickly take us through the overweights and underweights here?
Sure. We've spoken about this, that as the market moves sideways, or perhaps it's very difficult to find trend-alike behaviors in one particular index or otherwise. It's a stock pickers market. We've maintained that for the last 6-9 months. And you can see that stocks wherein the FIs came in the last 3 months, whether it was heavyweights such as Bharti, Reliance, an ICICI Bank, or an HDFC, those stocks performed really well. Whereas, where they sold, perhaps they didn't do that much well, whether it's an SBI or Infosys. So I would not hazard a guess at a single sector, a single theme, barring those 3 sectors which you mentioned, overweight, an FMCG, or healthcare/IT, I would say in the near term. But again, in that you'll have to be selective. So let's say even in IT, why should one be actually thinking of TCS? And why not things such as relatively inexpensive, can't actually see more downgrades like TechM, Infosys, or Cognizant? Those would be the ones. So I think we'll have to see what stocks, defense, etc. We aren't finding them to be any, beyond a theme right now. Hence, we would advise staying away from thematic, but more focusing on quality of companies.
Okay, and next time we will talk about specific companies, because I think you sort of have a decent small mid-cap coverage universe as well. And on the back of earnings, I was noticing some upgrades, some earnings cuts, and so that kind of action as well. So we'll talk about that. For now, thanks very much, Nitin, for coming on as always here. Appreciate your time. BEL is not really moving very much. It's down 1.5%, 1240 EBITDA compared to a poll of about 1180 odd crores. So at an operating level, numbers are just fine. Margins actually are much better, almost about 350 basis points better than expectations. Take a break. Back with D Street Chatter with Nimesh. He tells us, of course, a sense of what he's picking up out there. Of course, a list of stocks he's watching, and we'll get you some trades as well. Stay tuned.
Welcome back. So the market is still nursing, a cut. The good news is that we're not at the lowest level for the Nifty, and at least it's not making lower lows. But let's see, still not very, very inspiring. And of course, a bigger problem in the mid-cap market, with the mid-cap index down almost 1%. Nimesh is joining in with D Street Chatter. Nimesh, red is the color this Monday. What have you been hearing? Dealing room?
Hi, Surbhi. It's largely a down day, dragged by a few individual sectors like financials, technology. These are the two large sectors, and because of tech, there is a bit of a secular impact on the real estate names as well today. So the real estate index itself is also down more than 1.5%. So clearly, these are the three sectors which is dragging the overall markets down. But from a flow perspective, my sense is it's more of lack of buying than aggressive selling from the larger institutions. So the FI and DI data could be interesting to watch out. But at least my sense is there is no large selling is what I can understand or get a feedback from. There is very sharp reactions to earnings, and that's the trend which is likely to continue. We saw today what happened to Kotak Mahindra Bank, or a small disappointment, down 7%, and the other side, Laurus is up as well. So these individual stock reactions on earnings is likely to continue in the very near term. Technically, 24,450 is the level to watch now on the downside. That's a very strong support on the Nifty. So let's see if if you hold on to those levels, we're still a few hundred points away. And also the PCR after such a fall has come to 0.65 levels, and generally we've seen a bit of a pullback from those levels. So a pullback could be on the cards, but from a flow perspective, it's lack of buying rather than aggressive selling from larger FIs.
And you're seeing sharp reactions to earnings, as you pointed out, on both sides, on the way down, on the way up. Cartrade Tech, Sudarshan Chemicals, Acme, Aadhar Housing Finance, Laurus Labs. What big moves. What about stocks, Nimesh? What have you picked up?
Well, so the first stock on my list is Marksans Pharma. There was a large block, 2.3% equity got changed hands. I understand it was a clean-out trade from an FPI investor of Marksans Pharma. So looks like some domestic funds were buyers. So disclosures would be quite interesting. But from a seller perspective, my sense is it's a large FDI investor who sold out completely today. So that's the first name. The second stock is Godrej Properties. I spoke about real estate under pressure in general, but Godrej Properties stands out on back of very strong selling. And also additionally, I understand there could be a large block in Godrej Properties very soon. Remember last week also a large FI sold out, and another large FI investor could be a potential seller in a block in Godrej Properties. So that's the second name. The third stock is Bharti Airtel. Even that's under pressure today. Aggressive selling is what I understand, and one long only fund seems to be an active seller in Bharti Airtel at current level. So that's the third name. And the last is a couple of stocks where I'm anticipating large block deals very soon. Paytm, Emphasis, as well as Flare Industries. In Paytm and in Emphasis, there are strategic investors who could be potential sellers. And in Flare Industries, the promoter entity could be a likely seller. So expect large blocks in these three names in the days to come.
Okay, all right, got it. Thanks very much, Nimesh, for all the buzz and the chatter. By the way, I just want to point out one stock, which is Bajaj Finance. Pull up the intraday chart. The market's been weak throughout, so was Bajaj Finance. But now it's picked up momentum, a lot of momentum on the way down. It's the second worst performing stock on the Nifty. With that 4% down on Bajaj Finance, that's not a small cut. After Kotak, it's the next worst performing stock on the Nifty. We had Digant Haria on our news show with Nigel just a while back discussing banks and NBFCs. His point was that Bajaj is not present in the online space. Online, electronic sales. That is where there are other financiers, and it's traditional bastion of retail consumer finance that's getting challenged. That was one view, but anyway, this is a big decline on Bajaj. A good time to bring in Mitesh as well. Mitesh, just throw in a word on these big financials which are falling before you get to your calls. Kotak, no respite, and this Bajaj 4% drop. What do you make of it?
Kotak, I think, I talked about that in the morning, that 1940 is the 200 average area. We should possibly head there. We are not very far away from there. Once it breaks that, then there's a good chance of it happening. I am even looking at a test of around 1880. So the structures turn weak for Kotak with this kind of a big fall. And similarly, I think, Bajaj Finance, the correction started, I think, yesterday, but rather on Friday. And now it's, nearing the support level. So Bajaj Finance for me, 873 to about 864 is the medium-term support area. We might go break it in the the first chance and therefore get a bounce back. But I believe that the structure is weaker. So I think if you get prices around 900, 915 zones, I think that will be good levels to possibly for the short term, it is good levels to exit.
What about any other trading ideas?
On the stock side, I have sell or STBT on Havells with a stop at about 15.10. Target around 14.95 can be looked at. And the other stock is STBT on Hind Copper with a stop at 250 for targets of 242.
Okay. Got that. By the way, Mitesh, just one more stock, IndusInd Bank. Obviously, it's just ahead of numbers. Stocks at days low now. Just levels to watch on IndusInd?
See, the entire banking pack, post the Kotak numbers are coming to pressure, and IndusInd Bank had started correcting a few days back itself. The first level is around 765. So there's still about 4-5% trading downside left. In case you break that, and there's a good chance of that happening, I'm even looking at 725, 730 being tested.
Okay, all right. Sudarshan Chemicals is something we want to talk about. Mitesh, thank you for that. It's up sharply. I mean, some 15% or so. Now, they reported numbers, but mind you, not for the first quarter. Okay, it's coming off as we speak. 6%, 7%. So it's not reported numbers for Q1 the earnings season that we are reporting on, but they report numbers for the fourth quarter. Sonal has got more. Sonal.
Well, do remember, Sudarshan Chemicals is surging in trade, but it is the Q4 FY25 earning that the company has reported. This is after the UBAC consolidation or the acquisition which was completed in the month of March. The company has said in its notes that Q4 FY25 numbers are not comparable to any other quarter. So that's why if we look at the revenue number, it looks quite elevated. So it's a growth of 76% on a YY basis for Sudarshan Chemicals in Q4. However, EBITDA is down this time around because costs related to the acquisition, they have shot up. That's why EBITDA looks lower. There is a profit element of just 31 lakhs, which compares with 58 crore rupees. There is an exceptional expense to the tune of 61 crore rupees. There are various adjustments that the company has made because of this acquisition, a huge acquisition that the company had made. So remember, this is not on the back of Q1 numbers that the stock is surging. We are still awaiting Q1 numbers for Sudarshan Chemicals, and that is something which will have more numbers from the acquired entity and also the outlook going forward for the pigments business. So that is something which will be important to track.
Okay. All right, Sonal, thank you very much for that. At least some green on an otherwise red-looking screen. Let's go back and look at IndusInd now. We just got a technical check with Mitesh, but let's prep you up for the numbers which are slated to be released today. Gaurav is with us. Gaurav, tell us, what's the expectation?
Well, when it comes to expectation for IndusInd Bank, we have already seen in the provisional update, the loan book has declined almost by 3%. So the weakness is definitely there. And as a result, they are expecting weakness in the results as well. So net interest income, it is expected to go down almost by 22% on a year-on-year basis. For net interest margin specifically, in the last quarter, there was a one-off impact. So on a reported basis, they may increase almost by 100 basis points. So they are expected to come somewhere in the range of 3.2%. But at a normalized basis, if we compare on a sequential basis, they are expected to go down almost by 20 to 25 basis points. Another point to highlight here is that the operating profit, that is likely to decline almost by 40% because there won't be any kind of push from the other income as well. When it comes to the credit cost and overall asset quality, now we are not expecting any kind of negative surprise here, at least in this quarter. We have seen elevated credit cost for the last quarter as well as slippages. So we are expecting some kind of easing in the credit cost as well as slippages, but they are still likely to remain elevated somewhere in the range of 1.8 to 1.9%. When it comes to profit, now brokerages are expecting profit to decline almost by 70 to 75%. Now this is because of the one-off impact that we saw in the last quarter and also because of the weakness in the loan book that the bank has shown for the last few quarters. When it comes to some things to watch out for, first is that the growth in net interest margin and the trajectory, how they are going to call out for the trajectory of net interest margins is something which is a key thing to watch out for. Second is that MFI asset quality, and third is the growth trajectory going ahead in terms of the asset size as well. So definitely we are watching out on the IndusInd Bank, but at least for this quarter we are expecting weak set of numbers.
Okay, all right, Gaurav, got that. Thanks very much. So waiting by for IndusInd Bank's Q1 report card. Also waiting by for GAIL's report card, actually. Let's go back to Sonal to get the expectations laid out. Sonal?
Well, GAIL is expected to report numbers, and there will be a sequential decline in the revenues this time around of 3.3% to come in at 34,474 crore rupees. EBITDA, however, is expected to increase by 5.5%, margins at 9.8%. Profits, however, will see a decline of 3.5%. Well, let's talk about the segments first, because this time around, the transmission, petchem, LPG businesses, all of them are expected to remain weak. In fact, the losses in petchem is expected to widen this time. Kotak has put out some estimates. They expect gas transmission volumes to decline 7% YOY, but they will be up 1% sequentially. Petchem sales volumes will be flat YOY, decline 26% on a quarter-on-quarter basis. LPG sales will also be up 3.5% quarter-on-quarter, but they will be down 6% on a YOY basis. And marketing EBIT will come at 1,250 crore rupees, which will be a decline both on a quarter-on-quarter and on a YOY basis.
Thank you, Sonal, for that. Get into a break. A quick small programming note for all our viewers. As the workplace transforms, so must leadership. In the Bengaluru edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on the 29th of July, 5:30 p.m. onwards, only on CNBC TV18, CNBCTV18.com and YouTube. Welcome back. Counting down to today's trading session. It's been a challenging start to the trading week. The Nifty is below 24,700. The pain is more acute in the mid and the small caps, and the advanced decline ratio is negative now for the 7th consecutive day, firmly in favor of more declining stocks, 1:3 in terms of advanced decline. Dharmesh Kant from Chola Securities is now with us. Dharmesh, afternoon. Lots of mid-caps are bucking the trend. There's Acme Solar, Sterlite Tech, Laurus Laboratories. Any of these stocks that you like, or which one has been the pick of from the earnings season in the last couple of days?
Yeah, Dr. Rima. I mean, see, earnings have been all over the places in this season around, and chemicals is one sector which, I mean, the performance has been far better than the other sectors. Cement, chemicals, metals, they have done pretty well. Today's earnings, be it Laurus Labs, I take it with a pinch of salt because the reason being earlier also the management has guided strongly, but last 3 years there have been many misses than hits on that front. And look at the valuation multiple, it's at around 92, 93 times trading PE multiple, which is they are trading at. So to my mind, I mean, CDMO business is fine, but scaling back up to 32 kind of a margin would be difficult for that. And going by the valuation multiples, it's time to take profits. So that is the take. The earnings spec which I liked was more to do with the chemical space where things are happening. Maybe Ether Industries is one company which one should look into, which posted a good set of numbers. And in independent power producers, one should be looking into NTPC Green Energy earnings. It's due, and the capacity additions for this year would be around 5 to 6 gigawatt, sorry. And that would be entail a huge amount of profitability going forward. We have seen the proof of the pudding in the other independent energy producers, which they have given the numbers and how capacity addition helps in the earnings growth. So NTPC Green is what we are banking on. Let the earnings come through, and then further we can take a call on that.
BEL just reported numbers, and EBITDA margins and bottom line looks pretty solid. Even though on the top line, I think there's about a 7-8% miss. Dharmesh, any thoughts? Bharat Electronics?
Yeah, got from Bashar. Yeah, the numbers were okay type of numbers with better EBITDA margins. But when we are looking at defense companies, one should not be looking on quarterly basis. That is my sense. Because if you look at the 13, 14 listed companies, all put together post a revenue of around 68,000 to 70,000 odd crores. Whereas the order book stands as in excess of 3 lakh odd crores. So more, the visibility of order book is 4 to 5x, and these are basically lumpy businesses, not cyclical in nature. And there are a few years where you will have a good round of, revenue booking and profitability coming into play. So any declines out there for a company like BEL or HAL, we are recommending to accumulate on every declines, and the horizon should be 3 to 5 years kind of a perspective, because the opportunity size is very large. It will entail over a period of time. But as of now, because quarter to quarter, the kind of value traders may be booking profit, and they are the ones who also carry the stock prices forward. So stay invested in both BEL and HAL. Defense looks pretty attractive to us.
What are you advising on Kotak Mahindra Bank post the numbers?
Yeah, Rima, the difficulty with the large banks and the large IT companies has been they have been very candid about the growth and trajectory and the atmosphere prevailing into the economy. And Kotak Mahindra Bank, the basic problem has been the guidance for in fact Q2, the retail and the two-wheeler, three-wheeler division, which is basically a small ticket size of loan, and they have cited that there's a problem out there. So it's still valuation is expensive, around 2.3 times price to book value at current price. I think some more downside out there, and one has to wait for Q2 to pan out before taking a jump into financials, because it's not only Kotak Bank which has guided for a weak set of retail credit growth. It's across the board we are finding the same kind of synergy. So financials are barometer of the economy. So let's wait and see rather than jumping the gun and buying it out right now.
Okay, all right. Dharmesh, stay with us. We're going to just wrap out things here, and then we'll come back to you on markets forward. So you've got the indices all lower, varying degrees, 0.5%, about 1.25% lower. Nifty Bank, small cap, mid cap indices. But apart from that, not very much at all. So a drifty lower day. Market breadth, of course, clearly on the negative side, some 3:1 over 3:1, declines to advances on the NSE is what you had. So it was on the downside. If you look at the Nifty, it was a bunch of financials, right? So Kotak Bank and Bajaj Finance, IndusInd Bank on the Nifty were the top losers. Outside of Nifty, SBI Card was the big loser. On the large caps, the IT names were the other pack, which were lower. TCS, HCL Tech. Wipro, of course, was down about 3.5–4% as well. And of course, real estate as a pack did not help either. I think as a index, the Nifty real estate index was the top loser. Lodha was down sharply, Godrej Properties, and a few more as well. So enough moving, but it was largely on the downside, continuing the downside that we've seen develop over the last couple of weeks or so. Rima.
Well, with that, it's curtains down on closing bell. But since the IT industry is in the spotlight in the new age of AI and so much business disruption, you'd want to listen in to this next show. It's our special show, Editor's Playbook, where we will discuss India's IT industry that is at a crossroad. Will the AI age force a change? Coming up next.
India's software industry is a key pillar of the economy. It accounts for nearly 10% of the GDP. Now, Indian engineers are a mainstay even in Silicon Valley. From Sundar Pichai at Google to Satya Nadella at Microsoft, Indian engineers occupy corner offices at some of the world's biggest tech companies. But the software industry seems to be at a crossroads. After a pandemic-fueled bump, growth has largely moderated. Employee strength and salaries at top IT companies have remained stagnant over the last 3 years. In fact, some have seen a reduction in the headcount. There are new opportunities and challenges in the form of automation and, of course, now generative AI. Add to that, software service providers facing more competition, with multinational companies establishing their own global capability centers, or GCCs as they're called. IT companies need to transition to new technologies while also rethinking their business models. This is the Editor's Playbook. Each week, our team of editors will put the spotlight on the most compelling events across the world and try and decode what they mean for India. I'm Shireen Bhan. With me, our band of editors, Prashant Nair, Nimesh Shah, Reema Tendulkar, Surbhi Upadhyay, and Shriram Finance. Guys, thanks very much for joining us here on the program. For context, I want to go back to a conversation that I had in January of this year. And everyone was talking about a demand explosion. It was Infosys, Salil Parekh, Kotak Mahindra, Mohit Joshi, Kriti at TCS. Everyone was talking about how they anticipated this year to be a much better year for Indian IT services because of what Trump would do with deregulation and the demand explosion that they were hoping it would unleash. But I had a conversation then with Frank D'Souza, the man who used to head Cognizant, and these were his words. He said, Indian IT companies are facing an existential crisis. Now, this is not the first time this has been said. I would imagine it's not the last time that this is going to be said either. So let's go across to our own in-house IT expert, Reema Tendulkar, to put this in context for us. Reema, to start with, is there a problem? What is the problem? And what are we talking about?
So let's, Shireen just put it in context, right? Look at the last 10 years, FY15 to FY25. And here I'm going to break it down in the last, in 3 periods, right? There is FY15 to FY20, which is pre-COVID, when IT companies were growing at 8, 10, even 12%, barring, say, a Wipro. Then you had the COVID boom. Okay, from a low base of FY21, FY22, 23, IT companies were growing at 15 to 20%. The drivers were digital transformation, there was the cloud migration, and then there were these very, high intensity, short duration projects to enable, say, a work from home or to realign the supply chain. So therefore, IT companies were booming, 15, 20% kind of a growth, perhaps even more. And then came, the after. So FY23, FY24, FY25, growth rates started tapering off, and we're talking about 2 to 4%. And this year is also going to be no different. Look at Infi. They're guiding for a 1 to 3% growth. So growth rates have literally fallen off the cliff in the last 3 years. Everyone was saying that, tech budgets are unutilized. So at some point, you're going to get that pent-up tech, boom, but that's not coming so far. So the worry now is that are the Indian IT companies in a structural slowdown? Gone are the days of an 8%, 10% kind of growth, but we could be in a low to mid-single digit kind of a growth rate over the medium term.
I mean, just look at the graphic that's coming out.
Structural slowdown. Yeah, go ahead, Shriram. I just wanted to address this issue. When Reema talks about a structural slowdown, it kind of also seems to reflect what Frank D'Souza was talking about. I mean, he used a more dire expression, an existential crisis. But is there a growth problem? Is there a business model problem? Is there a capability problem? I mean, that's what we're trying to understand here.
I think it's a mindset problem, to my mind. I mean, if you just go back a couple of months when Piyush Goyal was complaining about the lack of deep tech work, absence of deep tech work in India, a lot of people reacted, venture capitalists, startup founders, etc. Yeah. But to me, the silence of Infosys, TCS, Wipro was conspicuous. I mean, they should have been the first one to answer that question, because what does innovation require? Capital, talent. And if you have about 1 million engineers, techies working for you,
I think 10 million last count.
Exactly. I'm just saying, you can't, I mean, if each company has to put together 50 people and say that, do whatever you want. And we could have been on the forefront of innovation instead of just talking about it. I mean, I was just pointing towards the graphic that was just fired, right? One could argue that, their growth rates have fallen from 21% a couple of decades ago to now, what's the number?
2, 4, 3.
Yeah, exactly, right? I mean, the last 5 years, CAGR is 8.1%. But I'm saying one could argue that it's a base effect. But this existential crisis, Shireen, that you spoke about, like you only said, it's not the first time that somebody has said this. In the last 4 decades, we've had 3 such existential crisis moments for Indian IT. One was after the global financial crisis, when the whole world was moving from, to cloud and big data. Then you had the digital services around 2016, 2017. The cloud had taken shape. Now the SaaS had exploded all over the world. So Indian IT services had to respond to that. And then you had, now you have AI. 4 decades, 3 big shifts. And 2 lessons that are very clear to us, which is macro headwinds, whether it's political in terms of Trump presidency, Brexit, the whole movement against outsourcing that happened at the start of the 2010s. Yeah. All of this is inevitable. You can't do anything to control it. What can you do? What can you control is the money that you spend on R&D. If you don't innovate, if you're not ahead of the curve in terms of what technologies are coming up, then you will constantly play catch up. And quite honestly, to be fair to them, they have caught up also very efficiently, right? I mean, they've managed to do that. But, you can't bet on that each time. They've made a lot of money for investors, but have they built a lasting company?
And that that's an important point to bring up, because, you know, again, I was having a conversation with someone who said, and his rebuttal or response to this existential crisis thing was that, look, the same thing was said when the digital or digitization wave took place. But today, you don't even differentiate when you talk about Indian IT company revenues. You don't differentiate between digital and the rest of the pie, so to speak. So they have made that transition. But on the innovation
the point, Shireen, my point is that
everybody on board. Then I want to bring everybody on board on that and get them to respond. Does the market reward the big bets on innovation that may not play up in the short term?
The market, I think.
Who wants to go, guys?
I mean, I have some data, which is, but you know, it's not exactly answering your question, Shireen, that does the market reward, you know, continuous spending, R&D spending, you keep spending and then, you know, something sort of clicks, right? I mean, that kind of, I think that is your question. But in the US, right, and it's always been different. Indian IT services companies were always all structured
as a services
hundreds of thousands of people. TCS is what, Rima? 6 lakh employees, right?
Yeah,
plus. So it's like a, and it was always cost arbitrage. That was the work. It was never leading technologies and building products, etc. Maybe it'll change as time goes by. So US IT has always been about products and new technologies, etc. They've been customers for Indian IT services companies. So just take a look at this. Magnificent 7 companies in the US account for about 47% of R&D spend in the S&P 500, right? 47% of the R&D spending is out of S&P 500 is these 7 companies. And guess what?
Yeah.
To the question, are they rewarded? These 7 companies are 34% of the market cap of the S&P 500.
Yeah.
Now, is that a straightforward answer? Of course, there are so many other things which go into the mix. But I just thought the data was kind of very, very stark.
So I want to bring in the R&D figure here.
Yeah.
In the last 6 years, we have spent they spend on average 1% of the revenue. So if you take FY25 revenue, it's about 6 lakh crore for the top 5 companies. I'm not going beyond it. And 1% of that is 6,000 crore. If you look at the actual number, it's about 3,500 crores. That's what they spend on R&D. And on the other hand, the investors in India have rewarded them for being consistent paymasters. They have given 1 lakh crore, these 5 companies have given 1 lakh crore as share buyback, as payment back to the shareholders. And that's what they've been rewarded for. So in terms of wealth creation, it's important to differentiate between how is the wealth created. By building a sustainable business or by short-term gains or long-term gains. And I think on that we've been sort of slightly...
In the US, by the way, buybacks are a huge thing.
Yeah.
I mean, actually, there have been studies which show that a majority of the gains in the US over the last 10 years, US stocks, has come through buybacks, not through...
that's a short-term gain.
That is, but I'm just saying as a method.
You've had activist investors, activist investors in the US pushing for buybacks, and you've had, we haven't had activist investors, but the call for buybacks here has been pretty loud as well. But, the data points to that. But,
Shireen, if I can,
back to this innovation question, just one minute. I just want to get Rima to come in here on this innovation question because, this takes me back to the time that CVK came into HCL Tech, Rima. And I remember very vividly then, he was trying to sort of push this idea of innovation along with the bread and butter kind of infrastructure business. And at that point, there was a pushback from investors. There was a pushback from the market. So I wanted to understand from your point of view, because, you look at this quarter on quarter, how do the markets perceive this?
Just one more example, Shireen, you remember when Sikka was there at, Vishal Sikka was there at Infosys in 2015.
OpenAI.
Yeah. He wanted to pledge $1 million in OpenAI and, we don't know, but I think the rumor is that the board shot it down.
OpenAI, by the way, the last valuation is $300 billion.
Yeah, so he wanted to invest.
Yeah.
So, it's been very hard, going back to the
I was going to make that point. Sorry, go on, please.
No, just the mindset, right? That every time a company wants to get into products, because it's so different, the payback, etc., the investment, the kind of capabilities that you need, there has maybe been a pushback from, the board. So, just wanted to give that example.
So from a market point of view, I'll just add what the market thinks of and how they take it. In India, there is still not enough patience for investors as well. You rightly pointed out what happened to Infosys, what happened to HCL Tech as well. And generally, it's a success which people like to follow, right? In India, we've not seen a big success in terms of R&D actually making big, whether it's a pharma, whether it's in IT. We haven't seen.
We have Glenmark. We have Glenmark now.
Now we have Glenmark.
Finally, Glenmark.
Exactly. So we just had. Exactly. No, I'm coming to that. Correct. I'm coming to that point.
But yeah, those are few.
Very few.
But it's an exception that points the route.
Glenmark is the first instance where you're seeing the fruits of 20 years of effort in R&D finally paying off. Equally, if you look at Spark, the Sun Pharma Advanced Research, for 20 years they've been spending money on R&D and everything. Investors are frustrated and they've not made a single money on it, right? So even from investor point of view or from analyst point of view, there's a lot of pushback there is not much enough patience. I'll tell you a simple today. I'll give you today's example. Look at Infosys results. Street is happy that they've raised the lower end of the guidance from 0 to 1%.
And they're not happy that the stock is down.
The commentary is this is the best that Infosys reported among all the large cap IT companies, which is true. But
I just
happy.
I just want to make one point that, and I remember HCL Tech categorically for the use of this phrase, moving from run the business to change the business. I think they used this phrase at least a decade ago, if not earlier. But the real transition in terms of moving to change the business side of it, I think that's been missing, and that's where now there is serious disruption. Therefore, maybe talk of existential issues because there's AI. If you don't change now...
I want to put that quote in context. When HCL Tech used to speak about, run the business to change the business, it was they were talking on behalf of their clients. They were not talking for themselves. They were not changing their own business. So,
AI is now forcing their hand, as we speak. And We'll talk about this, about what some of the companies are doing.
Today's example, Coforge. Now they're not investing in some great R&D, but they are saying we're going to put money in to build a data center. Stock is 8% CC growth, quarter on quarter. Strongest ever. Stock is down 8%.
No, but that's a different argument. Right? Data center could be a real estate company's business. It's not a hardcore software solutions
business.
But
I'm saying new things, right?
But no, again, that's
you don't
not
know
a real estate company. But anyway,
No. Data center is not a real estate business.
Exactly, not a real estate play.
In fact,
it's a pure data play.
This is another misconception.
Exactly.
This is another misconception that has, especially in India. And I remember this conversation that I had last month in the Valley with Raju Vegasana of SIFI, because they're doing data centers, and he said this idea that data centers are a real estate play in India is just a complete misnomer, and we need to get away from that idea that it's in fact a real estate play, because it's nothing of the sort. But let's talk about the markets and how the markets are looking at this sector at this point in time.
So, Shriram, from a market point of view, barring few, mid-cap companies like what we spoke about, Coforge, Persistent, some of those high-growing companies are still, getting richly paid. They are almost at all-time highs, and actually investors are rewarding as well. But the problem is with the large-cap 5 IT names, right? I mean, I was just looking at the data of last 10 years. Riva spoke about various periods from 2015 to 20, then COVID, then last 3-4 years. But if you look at if you look at the 10-year period of the large 5 IT names, the numbers will shock you in terms of revenue, top line, and operating margins. Wipro in the last 10 years has given a revenue CAGR of 3.3%. The profit CAGR for Wipro is just 1% in 10 years. That's the kind of number that this large cap IT companies have thrown. Of course, they don't collapse or they don't fall much because of the cushion of dividend and buyback that they keep announcing every year and a half. So across all 4-5 IT companies, everybody has reported single-digit revenue, EBITDA and profit growth for the last 10 years in terms of CAGR. Who have done well? Again, as I said, the mid-cap IT companies have relatively outperformed in the last 10 years in terms of growth. Coforge stands out, L&T Mindtree stands out, Persistent stands out, and something like Tata Elxsi stands out. So at least these companies have reported double-digit revenue growth over the last 10 years period. Otherwise, it's been a very painful
one of the things
phase for this large cap IT.
And guys, sorry, I just want, and if we can bring up that graphic that has Wipro on it as well, because that's a startling number. I didn't realize that it was just 1%.
3% revenue, 3% revenue, 2% EBITDA, and 1% profit growth in 10 years.
The last 3 years, no revenue growth.
In 10,
but it's kind of gone through. Wipro perhaps is the
lowest of the pack, the others, and they've had multiple CEO changes.
I think 3-4 CEOs in that period.
See, all these numbers includes change of CEOs, acquisitions, everything put together.
You didn't mention this in the CEO discussion.
This is the kind of...
That's why we said new hands coming in, need for fresh blood and all
we
that.
We do have a new hand at Wipro.
Yes.
But I'm just going by the data there that Nimesh presented, and again it takes me back to the conversations that were happening a few years ago, where the question mark was on, will mid-cap IT survive?
Yeah.
What will happen to mid-cap IT? Mid-cap IT seems to have done fine, Rima.
So again, the pivot what Surbhi and Rima were talking about, the mid-cap IT has been able to pivot very fastly, change with the environment and do the right things.
Certain technologies.
I think there's also a matter of size, right?
Exactly.
It's a big matter of size, and even this
car around. It's very easy to move a trailer, turn a trailer, right?
With size and if with the money that all these guys have,
correct.
You can't give an excuse just because
I'm not giving an excuse. I'm saying it is a factor.
They can't pivot.
It's over-conservativeness. Maybe it's just that. It's just being very, very cautious and maybe
the base effect. Like the growth rate in mid-cap IT looks better.
I think Prashant has a point. I think Prashant has a point there. You can't totally discount the base effect.
Yeah. Of course. Like TCS is $30 billion in size, Infy is $20 billion, and these companies are $1 billion. Exactly, they won 1.5. Their aspiration for Coforge and Persistent is to get to $2 billion.
So my limited point is that yes, size, base effect does matter, but the fact that with this size, with the kind of might they have, the kind of cash they were sitting on,
correct.
None of them made an effort to pivot and go for an aggressive.
But had they invested in R&D with the huge cash balances, right? $5 billion plus for an Infy
and the human capital.
And the human capital, right? We've got the best homegrown engineering talent. But at that point, your buybacks would have come down, your dividends would have come down, and then you would have had.
That is what.
So it would have been a bit of a trade-off at that point.
It's like I want
to take back one point about what Rima said, right? It's a trade-off between share buybacks and investment in R&D. And Prashant also mentioned this, that there has been, and you also said, right, there has been outrage in the US for the amount of buybacks that were happening. But those buybacks were happening after a 12%, 15%, 20% spend on R&D. Yeah. They were not doing it at giving 1% for R&D and then doing buyback. It's a very small but a very significant difference.
And that's what the argument on size, which Prashant was also making. But again, look at the size of the Magnificent Seven, and they're growing. Look at Nvidia, and on that base.
Growth is 20 to 30%. There's very strong growth at that base.
Yeah,
which is what I'm saying. So the base argument beyond a point, does it really
that
hold?
growth has happened. Surabhi, that growth comes because we woke up to AI after ChatGPT. They've been building ChatGPT
That's precisely
and all peers, right? So they were spending on R&D.
TCS is a very large base and large revenue and large number of employees. So therefore, we can't innovate and think on our feet.
No, actually, the argument of size was between Indian large cap IT companies and Indian mid cap companies, right? It was easier for mid-cap companies to grow given the size. But Shireen, where...
There is a risk also for mid-cap companies. If they pivot and if that thing doesn't work out...
That particular technology,
blow up the entire company, right? So there is a risk as well with such small companies. Even from an investor point of view, if you invest in a large-cap Infosys or TCS, you're safe.
Yeah.
Whereas you're looking for a very small niche company.
I think that safety...
that swing is very huge.
That safety moat that we talk about...
It just blows you up.
I don't think... that safety moat is shrinking by the year, right? Every year.
I personally feel, there has to be 4 or 5 big R&D success stories in India. And I'm telling you, then every investor, every company will start chasing and start putting money into
But
R&D.
it's chicken and egg, no?
It's just that
You have to put the money for that.
success has
You have
to
to,
come.
but that's,
Unfortunately, it's not come in the last 20
Guys,
years.
should we talk salaries? I think.
You know, AI is everywhere. But it's not on the top line, it's not on the bottom line, but it's there in terms of your job.
You know, Rima and I, Shireen, were asking the TCS management, and I feel I've asked it twice or thrice now. So, you know, you have 100 people to execute one project. You start using AI and you're executing for an American company, and you don't need 100 people now, you can do it with, say, 60 people, right?
Yeah.
You can go on for, say, a few quarters, you save on costs, etc. But at some point, the guy on the other side, your client is going to realize, right? You're doing a lot more, the same amount, with a lot less cost. And you've got to have to pass it on. So that is the pricing, the question, right? Is AI deflationary? It's going to be, in the context of our discussion, is AI deflationary for IT companies? And I mean, the answer has always been no, it is not. But it just...
And that's hard to argue because no matter which report you pick up, if you talk about the maximum productivity benefits, it's the BPO sector, obviously, where everything is getting automated. And then it's software development, number 2. So, I mean, productivity benefits, depending on whose projection you're reading, between 40 to 50, 60%.
Yeah.
And somewhere these benefits, clients will want a bang for their buck. So, yeah, I really agree with that argument.
the point is that we let people, our talented people, go to the US and build great products there. And here we kept complaining that how, you know, we don't have all 90% of our engineers are not employable. Every IT CEO would have said this once, at least in the last 10 years. But pay the good guys and keep them there, na? So, Prashant, cue salaries.
You know, this is very interesting data. I checked, by the way. This is out of memory in the year 2003, 2004. I mean, when I started working, you had an entry-level college graduate was getting paid about 25,000 rupees a month.
3.5 lakhs.
3 lakhs. Basically, it's about 25. Yeah, roughly that, right? Now, the entry level, I am told, is about 3.6, 3.7 odd lakhs, entry level out of college.
Yeah.
You adjust for 6% CPI inflation. Inflation adjusted in real terms, you can put the numbers in, you'll get it. You're basically looking at about it's actually over 70%.
Dismal.
Roughly 65 to 70% drop in real income over a 25-year period. Almost 25-year period.
I asked the same question to the Infosys CHRO at that time. I think it was 2019. So, and I was like 3.5 lakhs, and now we are 15 years, 20 years later, we're talking about the same number. You know, what explains this? Oh, then same question, same answer, upskilling. We will train you, we'll make you better, and in 2 years your salary will be double.
Shriram, media ke liye bhi bol sakte hain.
Still a chip better. Let me not say anything.
The AI upskilling.
Not much has changed. Not much has changed.
Exactly.
Ours is a very low skill job.
Which is ours keeping quiet. Let me not get into it.
They may turn around and say, so why are you talking?
No, but I know, that'll be a whole other conversation. That'll be a whole other conversation.
I guess, folks, I mean, but Shireen, don't you think it's a real question? Because from employing thousands and millions of employees at very low salaries, the model seems to be shifting to lesser but far more upskilled people at higher salary points.
That is exactly, and I think that is something that, you know, and that's a challenge not just for these companies, but that's a challenge for the larger economy as well. Because
absolutely,
remember, this is a sector that's been an employment, that's been an employment generator, and now if you're talking about low code, no code environment and moving very quickly, I mean that's not 5 years on, that's happening now.
Absolutely,
you know, CEOs are almost bragging about the fact that so much of our code is now being generated by AI. 30%, 40%, 50%. It's almost as if they're in a race with the other guy to say, you know, maximum amount.
No, absolutely. In fact, I share that worry with Lata ma'am almost on a weekly basis. I mean, the 90s IT revolution that built the middle class of India. I mean, we're talking about a bigger change than perhaps in the coming years.
But there is one counterpoint to this. One counterpoint to this, which is that I think from the client's POV, like the people who are going to pay TCS and Infosys and HCL Techs, I think they'll be willing to pay a bigger amount. I think what they are asking is, yes, do it with fewer people, etc. There is no premium on that anymore. Just because you can do it, if you can give me a great product, a great solution. So everybody called the death of the SaaS products as a whole, right? Like outside in the world, everywhere else outside India, SaaS is dead according to them, according to many critics. Then what they are starting to ask is service as a software, like just flip it on its head. Add an AI layer to it. Add add decision making to it.
This is an AI specialist who I met in the Valley, and he's the father of many things AI, and he said the machine will not have the ability to ask questions. It may have the ability to answer all kinds of questions, but it won't have the ability to ask questions. So perhaps that is what we're going to be. What is your question?
Richard Baldwin, Globotics Upheaval. It's the book where he says the only way to beat the machine is to be more human.
Guys, it's been fun chatting with you. Unfortunately, we are out of time on this one, not out of ideas. So we'll be back again with the editor's playbook from Nimesh, Prashant, Surbhi, Rima and Shriram. Thanks very much for joining us. We'll see you again next week. Till then, goodbye.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Layoffs at TCS spark fear across Indian IT. Stocks decline across the board after TCS announces more than 12,000 job cuts in what is the biggest layoff in the software industry. Yet, TCS claims the job cuts are not linked to artificial intelligence and blames a mismatch in skills. US and Europe agree on a trade deal with days to go for the August deadline. US will impose a 15% tariff instead of the 30% proposed earlier. Auto tariffs reduced from 25% to 15%. Steel tariffs to continue at 50%. Business leaders in Europe criticize the deal. European Commission's president says this is the biggest deal they could get. India evaluates its options as the August deadline approaches with an interim trade deal almost ruled out. Sources say India is considering all options, including the possible imposition of reciprocal tariffs, hope to find consensus on a full agreement by fall. Sensex and Nifty near a 2-month low after a sharp fall on Dalal Street. IT and bank stocks lead the decline. No respite for mid-caps and small caps as the sell-off continues. Shares of Kotak Mahindra Bank plunge after a disappointing Q1. ICICI Bank emerges as a top performer among private banks this quarter. HDFC Bank is largely steady. Axis, Kotak and IndusInd Bank face some headwinds. Defence Minister Rajnath Singh says no important military asset was damaged during Operation Sindoor as Parliament kicks off a debate. Minister also says the operation was stopped after objectives were achieved and not under any external pressure. The Union government is likely to launch the revamped central KYC registry from March 2026 instead of 2025. Government officials say that each KYC record covering individuals and entities will be assigned a confidence score based on the strength, validity, usage and revalidation of identity documents. Finance Minister Nirmala Sitharaman questions India's private sector over the lack of capital expansion, asks why is the industry sitting on passive funds instead of investing in growth. Supreme Court refuses to stop the publication of the Election Commission's draft voter list for Bihar on the 1st of August, nudges the EC once again to accept Aadhaar and voter ID cards to verify voters, as many fear lakhs of voters could be disenfranchised. Maharashtra government culls more than 26 lakh beneficiaries from the monthly stipend scheme for women. This after 17 lakh beneficiaries were removed in April. The state government had credited the Ladki Behan scheme as a key reason for its return to power. More people starved to death in Gaza, even as Israel allows a temporary pause in military action to allow food assistance. The overall death toll in Gaza nears 60,000 in the 21 months of the war with Israel. Elon Musk confirms Tesla has signed a $16.5 billion chip contract with Samsung. The South Korean giant mentions July 26th as the effective start date of the contract in its filing, but does not mention the name of the counterparty. The contract is effective till December 2033. The big story we are tracking this evening, Tata Consultancy Services has said it will fire 2% of its total workforce, equating to roughly 12,000 employees over the course of the current financial year. This is Indian IT's biggest layoff exercise till date. The company had laid off more than 3,000 employees, equating to 1% of its total employee count in FY 15. Shares of the firm tanked in trade in response to this development. Reema Tendulkar is here with all the details. Reema.
Thanks so much for that. So the big question is, do the job cuts at TCS signal a big tech reset? Well, the news is that India's largest IT services firm, TCS, is letting go of 2% of its workforce. That is nearly 12,000 employees. And this is largely the mid to senior level, and it would be spread across FY26. Now, this is significant because TCS is the bellwether of India's $250 billion IT industry. Job losses at this scale are not just rare for TCS, they're unprecedented. So what is the key driver behind the job cuts? Well, it is a growing mismatch between demand and the available skills. TCS insists this is not about AI replacing jobs or the need to hire less. CEO K. Krithivasan told Money Control that this is not about AI giving you 20% more productivity gains. It is about skill mismatches and the feasibility of deployment. But that said, there has been a slowdown. There has been pressure on margins, and in an AI automation world, we need fewer people. Fewer managers will be needed. The mantra is basically you can do more with less. Now, global tech giants have already made very deep workforce cuts, and this has been happening for a while. Just this year, Microsoft has axed nearly 15,000 jobs in 2 rounds. IBM has reportedly let go of 8,000 employees as AI has replaced HR. But now what's happening is that the tech layoff wave is hitting closer home. TCS calls it as a part of a journey to become a future-ready organization. But the deeper shift is clear, that the traditional, people-led, a linear revenue model is now giving way to an outcome-based AI one, a platform one. And it hasn't happened overnight. You know, Indian IT companies have been stealthily, quietly rebalancing their headcount for nearly 2 years. You know, this is the picture over the last 2 years and how the headcount has changed. For TCS, it's lower by more than 2,000. For Infi, about 12,500. Wipro, in excess of 25,000. So the question is, what lies ahead? Will other IT companies also follow suit and optimize their workforce to become future ready? So do we have more job cuts coming for the entire sector? Will the industry continue to delay wage hikes? Remember, TCS hasn't given their wage hike as they normally do in April. And in the near term, say for a company like TCS, will this trigger a spike in attrition, or will it in any way impact the job delivery? So lots of questions. We'll have to see how this plays out. But this could just be the start of a deeper transformation in the Indian IT, the way it operates and survives in this age of AI.
Right. Thank you, Reema, for that. The employee strength of IT majors have also remained largely stagnant in every fiscal since FY23. In fact, TCS and Wipro have seen a reduction in headcount, while employee strength has improved for Infosys. This as companies reduced hiring after stocking up on talent during COVID. Furthermore, growth has largely moderated after a pandemic-fueled surge, with constant currency revenue growth even falling quarter on quarter in the case TCS and Wipro in the first quarter of the fiscal. Now, software service providers are also facing more competition, with multinational companies establishing their own global capability centers for GCCs.
The focus on the Sholay dialogue, kitne aadmi the, or headcount based judging the IT industry, I think, thank God that period will be over.
So I tend to agree with the TCS narrative that this is a future-oriented restructuring, because I mean, in the days of generative AI, when you're using ChatGPT a little bit and helping yourself, that was fine. But this is the day of autonomous agentic AI, which means that 80% of the work could potentially be performed autonomously. So in that context, when you look at your organization top to middle to bottom, then you do a fundamental rethink. And I think every industry, I mean, it does not just IT, but definitely including IT, will do this reorientation. There will be some shedding of jobs.
Seems that it is not AI related, and that is how I would interpret it as well. Because if had it been AI related, you would have seen more jobs being cut at the lower end of the org structure. So it probably is just a bit of being more efficient and optimizing the organization.
The big global story we are tracking. The United States and the European Union have reached a trade deal after 4 months of negotiations. President Donald Trump, flanked by European Commission President Ursula von der Leyen, announced the deal at his golf course resort in Scotland's Turnberry. US President Donald Trump has said that the country would impose a baseline tariff of 15% on most European goods, including cars. Further, EU has agreed to buy energy products worth $750 billion from the US and invest additional $600 billion in the country. However, US is expected to keep 50% tariff rate on steel and aluminium. However, Europe remains divided over its response to the deal. While German Chancellor and Italian Prime Minister welcomed the trade deal, French President hinted that it was a dark day for the Union. German exporters remain wary over the deal as well. They feel it could have negative repercussions. European Commission's president says this is the best deal they could get.
We have good news. We've reached a deal. It's a good deal for everybody, I believe. And I think you were saying this is probably the biggest deal ever reached in any capacity, trade or beyond trade.
It is.
It's a giant deal with lots of countries, because, as you know, Ursula represents a lot of countries, not one country. It's not easy for you. It's because a lot of very different countries, great countries, but some are strong with cars, some are strong with agriculture, some are strong with both, right?
15% is not to be underestimated, but it is the best we could get. It's overall across the board. Important was for us, it includes not only the cars, so go down with the tariffs for cars to 15%, but also all goods and semiconductor and pharma.
Moving on, the United States and China are set to resume a fresh round of talks for an extension of the trade war truce between the two nations. Treasury Secretary Scott Bessent and China's Vice Premier will meet in Sweden's Stockholm to restart negotiations. The current 90-day truce between the US and China is set to end on 12th of August. US Commerce Secretary has said that Washington's August 1st deadline for imposing tariffs will not be extended. Speaking to Fox News Sunday, he said that the US president is willing to continue negotiations even after the tariffs kick in. However, he maintained that no country will be given a grace period. And speaking of trade deals, the United States has managed to secure agreements with most of its biggest trading partners. China, Japan and the European Union are Washington's top trading partners and have achieved trade deals in the tariff range of 10 to 30%. Similarly, 3 countries of the South Asia region, Vietnam, Indonesia and the Philippines, have also reached trade pacts with the US. However, other countries of South Asia, including India, have not been able to finalize a trade deal and are facing a proposed tariff rate in the range of 25 to 36% ahead of the August 1st deadline. And speaking of striking a trade deal with India, sources have said that with only 4 days to go before the August 1st deadline, there have been no signs of a breakthrough on trade deal yet. Parikshit Luthra joins us now. Parikshit, with no breakthrough in sight, what does this mean for both the countries?
Well, it looks like it's going to be difficult to have any sort of interim deal before the 1st of August deadline. Sources telling us there is really no breakthrough in talks since the 18th of July. That's when the 5th round of talks between India and US ended in Washington, D.C. Since then, we've not really reached a point where we could say that both sides can have an interim deal with the issues that have been agreed upon till now. What seems to be the case is that Donald Trump and the United States want a bigger, more ambitious deal. We have seen the kind of deals he has struck with Vietnam, Indonesia, also the European Union and Japan. Many of these deals are one-sided, with the US getting unprecedented zero-duty access in these markets, but in turn it is imposing 15 to 20% tariffs. That's not acceptable to India. India wants the tariff arrangement to be equal and reciprocal. Secondly, US has also got major big-ticket investment commitments from companies like Japan and Indonesia. With Japan, almost $550 billion worth of investment commitments. Now, many experts would say these are not binding, but at least on paper, those announcements are definitely there. Can India give in to such commitments? At this stage, it seems we're not ready to make such big-ticket announcements for the US. There are definitely energy purchases, defense purchases in the pipeline, but not to the extent of what is being committed to, or what he's claiming to be commitments from Japan, Vietnam and Indonesia as well. So let's see what happens. While both sides are not ruling out any interim understanding, any deal looks difficult as of now, but post the 1st of August, discussions on the larger bilateral trade agreement by fall would continue. In fact, a US negotiating team is coming here in the month of August to see if there can be some sort of breakthrough in talks.
All right, thank you, Parikshit, for that. On that note, we will slip into a short break. Coming up next, Defence Minister Rajnath Singh says no important military asset was damaged during Operation Sindoor as Parliament kicks off a debate. Welcome back. On to the day's market action now. The market fell for the third straight session, ending nearly at a 2-month low. IT and bank stocks led the decline. Large cap IT stocks witnessed a broad-based fall after TCS's job cut announcement. Kotak Mahindra Bank erased its market cap of over 30,000 crore rupees after reporting weak earnings. The Finance Ministry has said that India's inflation in FY26 could be lower than the Reserve Bank's projection of 3.7%. In its economic report for June, the ministry said that this creates room for the easing cycle to be sustained. However, the report flagged that the slowdown in the United States could dampen further demand for Indian exports. The government has plans to roll out central KYC framework by March 2026. This is slightly later than the original deadline of 2025. The new KYC rules will introduce a risk-based and confidence scored system. Sapna Das joins us now with more. Sapna, take us through the new rules.
Well, this has been in the pipeline very clearly. So instead of the current calendar year of 2025, we are given to understand that probably we have March 2026. The central KYC registry should be ready to roll out this revamped KYC process, or rather the framework, so to speak. Now, if you recall, the finance minister in her budget speech had also alluded to the same. She had said that in the current year, this is going to roll out. Plus, it's also going to help in periodic updation of KYC records. So having said that, 3-4 important elements that will be brought out from March 2026 in support of customers and regulated entities, which we should be aware about. First, of course, the confidence score. This is the first that's going to happen in terms of your KYC data. So, it will be kind of categorized on 4 counts: basic, complied, enhanced and assured. So the higher your confidence score, the better it is for you as well as for the regulated entities. How will this help in the times to come? Well, every time when there is a re-verification of KYC documents, if you're in the highest confidence scoring category, it may just be possible that your re-verification will be relaxed by the concerned regulated entities. That's one aspect. The second, of course, is also in terms of, risk, basically the re-verification process. Again, what I was talking about, the updation of records, that's going to be far more streamlined. We are given to understand, for instance, if, as of today, every 10 years, your KYC documents are kind of re-verified. But today, for instance, if you have a PAN which is updated, so starting from that particular date, your next re-verification will happen. So, to that extent, it's going to be very beneficial for the customers. Also, all your data is going to be there in a streamlined fashion on the registry. So, any regulated entity that wants to check on your records, instead of asking you, can actually access that database directly. That's second. Third, of course, we also came to understand, last but important, we also came to understand that there will be also risk-based KYC, in the sense that low, medium and high risk. Now, this is being done to basically, check and prevent money laundering.
All right.
So on that count also, there are certain criteria that are going to be introduced.
All right. Thank you, Sapna, for that comprehensive update. Shifting focus now, the monsoon session of Parliament session resumed today with Defence Minister Rajnath Singh leading a debate on India's Operation Sindoor against Pakistan. The Defence Minister rejected allegations that the operation was halted due to external pressure. He clarified that it was only paused after India achieved its political and military objectives. When questioned on the number of Indian jets lost during the operation, Rajnath Singh slammed the opposition and said that the result is what matters. He reiterated that Operation Sindoor was a clear military success.
कभी-कभी हमारे प्रतिपक्ष के लोग ये पूछते रहे हैं कि हमारे कितने विमान गिरे। मुझे लगता है उनका यह प्रश्न हमारी राष्ट्रीय जनभावनाओं का सही से प्रतिनिधित्व नहीं कर रहा है, मुझे लगता है। उन्होंने एक बार भी हमसे यह नहीं पूछा कि हमारी सेनाओं ने दुश्मन के कितने विमान मारे गिराए। आपको प्रश्न पूछना है तो यह प्रश्न पूछिए, क्या ऑपरेशन सिंदूर सफल रहा? तो उसका उत्तर है हाँ।
देश ये भी जानना चाहता है, वे 26 लोग जो जिनके परिवारों में आज कोई गुजर गया, वे ये भी जानना चाहता है कि 100 दिन गुजर गए और वे 5 दहशतगर्दियों को ये सरकार पकड़ नहीं पाई।
At least 3 terrorists have been killed in an ongoing encounter in Srinagar's Dara district. The operation has been codenamed Operation Mahadev. A joint team of police, army and the CRPF launched search operations in Lidwas this morning. Officials said that there were reports of terrorist movement in the area. The army has clarified that the operation is still ongoing. The union government has said that Elon Musk-backed Starlink will offer services at around 3,000 rupees a month in India. Chandrasekhar Pemasani, the Minister of State for Telecom, told CNBC TV18 that Starlink's India entry will not be a risk to existing telecom players. The company's capacity is also to provide only around 20 lakh connections in India. The Maharashtra government has culled more than 26 lakh beneficiaries from the monthly stipend scheme for women. This after 17 lakh beneficiaries were removed in April. Santya Gora is here with more. Santya.
Right. So in a significant development, Maharashtra's BJP-led Mahayuti government has slashed 26,34,000 beneficiaries from its flagship Mukhyamantri Mazi Ladki Bahin Yojana. The state government claims that these beneficiaries were ineligible for the scheme. Now, why were they ineligible? According to state government, they were either availing benefits under multiple schemes or multiple members of a single family were getting the cash handout. In fact, in some cases, even men had enrolled and they were receiving money under the scheme. The important part is that these 26.3 lakh ineligible beneficiaries were slashed from the beneficiaries list after having received 1,500 rupees every month for all these months. Women and Child Development Minister Aditi Tatkare said that regarding action against those who fraudulently enrolled in the scheme, the state government will take a suitable decision. So whether or not action will be taken, that remains to be seen. Also, this is not the first time that ineligible beneficiaries have been found availing benefits under the scheme. In April 2025, benefits for 8 lakh beneficiaries were reduced to 500 rupees per month, citing that they were already receiving stipends of up to 1,000 rupees per month from other schemes. That same month, 17 lakh beneficiaries were removed from the list. In June 2025, 2,200 government employees were found availing benefits and were subsequently removed from the list. In July, 14,000 men were found receiving benefits under the scheme, a scheme which is purely meant for women. And now, 26.34 lakh ineligible beneficiaries have been removed. The scheme was launched in July 2024, just months before the Maharashtra Assembly elections. Before the elections, the total number of beneficiaries under the scheme was 2 crore 63 lakh. Since then, 43 lakh beneficiaries, including these 26.34 lakh, have been removed, but only after they had received 1,500 rupees per month for several months. This has attracted criticism from the opposition, which is calling this a criminal waste of taxpayers' money. The opposition claims the government allowed these ineligible beneficiaries to avail benefits for electoral gains.
All right, thank you, Santya, for that. Shifting focus now, 19-year-old Divya Deshmukh has won the 2025 FIDE Women's World Cup in Georgia. Deshmukh beat veteran Grandmaster Kuneru Hampi in the second rapid tiebreak with the black pieces. With this, the teenager has etched her name in history as India's 88th Grandmaster and only the 4th Indian woman to achieve the prestigious title. All right, with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV18.
Well, hello and welcome to Finding Alpha, the show where we zoom out to understand the macro and then deep dive into the micro. All of this to sharpen your stock selection process. Well, today we'll be focusing on a very, very crucial theme. Who stands to gain amid the rate cuts and asset quality concerns? With the RBI shifting to a pro-growth stance and introducing a series of rate cuts, albeit modest, investors are weighing this against tepid credit growth and some signs of emerging stress in asset quality. Well, to unpack this, we're now joined by Digant Harya, founder of Green Edge Wealth, a firm that builds tailored stock and high-yield bond yield portfolios. Digant, by the way, has been tracking India's banking and NBFC space for over 16 years and brings a sharp lens to what matters and what doesn't in this dynamic sector. Well, Digant, thanks a lot for coming down to the studio. And we're looking forward to learning more about, the financial companies, NBFCs and some HFCs as well. How are you feeling about the sectors right now?
Thanks, Nigel. Pleasure to be here. Pleasure to be on the first show of, the first episode of this new series. So yeah, I think, banks, NBFCs, it's a very large sector. So always there's interest. And the reason for a higher, a higher scrutiny for this sector now for investors is, the RBI started reducing the regulations and they have cut the rates. Yeah. And there's a finance minister who said that NBFCs should not think of themselves as shadow banking and they should now go out and grow. So the government and the regulator wants this sector to grow. Which is the reason why we are all looking very closely where in the large space can we find our growth.
All right, Digant, then let's take that forward and let's focus first on the housing finance companies, because it's more relatable as well. Now, housing finance companies within that, some of them could see some margin expansion, as you said, because of the rate cuts. Lower cost of funds will help them. There's also backed by physical assets, which is good in terms of asset quality. And within housing finance companies, well, we'll break it down into traditional housing finance companies and affordable housing finance companies. First on the traditional lot. And we'll get those graphics up for you on the screen, the likes of LSE, Housing Finance and the likes. Yeah. Anything you like out there? Is there one of those companies that is better placed?
Nigel, I think, traditional housing finance companies, you highlighted a lot of positives. But then, all these positives come with very high competition. All private banks, all PSU banks, all regional banks, everybody wants to do affordable housing. And which is why the margins and growth both will be under pressure for this segment. So this is a segment which is best left for, somebody who's happy with 10% returns, because I don't see, a big upside in any of the stocks in this particular sector. I think if somebody is still very keen, maybe Canfin Homes has a little bit of turnaround story left, but otherwise I think best to focus on smaller names, niche names where banks cannot really come and compete.
So we'll keep the traditional housing finance. They're not giving you anything to really be very excited about. But let's focus on, the other ones. That's the affordable housing finance companies. And when we talk about real estate companies, their advice is always go with the larger names. But I believe from this space, you are looking actually a smaller name from the affordable housing finance. India Shelter, that's the one that's on your radar. I think it's well placed, though the loan book is the smallest, but the ROA is looking quite good. Tell us more and what's the rationale?
Yeah, so I think, the affordable housing story of India, a lot of times we say there's so much opportunity. Actually, that's not true. The opportunity is limited in affordable housing because all the housing prices have gone up. So in housing finance, we have one rule, Nigel, that you focus on companies which are small in size, because the moment you hit 20-25,000 crores in loan book is the moment where either your growth or your asset quality starts suffering. We have seen that with Gru in 2016, Canfin in 2018. These were also great affordable companies at one point in time and they're struggling later on. We've now seen it with Aavas and some extent Aadhar also. So this is a space where I think smaller is beautiful. And I think amongst the small space, there is Aptus and there is India Shelter, which is like less than 10,000. Between the two, I think India Shelter has a better growth focus and better prospects of growing and maintaining their profitability. So I think that can be a business which can do well over next 18 months.
Yeah, and as you said, I think the loan book is less than 10,000 crores out there, but it gives you a good potential to grow. Just wanted you to highlight, what about the LAP exposure for these companies? How much is it?
Okay, so that is slightly, like we say these are housing finance companies, but anywhere between 25 to 40% of their portfolio is in loan against property or LAP, as we say. It's a slightly risky segment, but that is what gives them margins. These players over the years have really done it well, but there's a little bit of risk build-up. So, you always have to be careful and not go overboard because, mind you, Nigel, these are all trading at 3.5 times price to book also. So they need to execute well. I think India Shelter over last 2 years, they have had a new management from Chola and I think they're doing things right. So I think that is where we have the best probability of success. But yeah, we have to be careful about LAP.
Pick up the pack, India Shelter from Digant there. Loan book size relatively smaller, but they've got triggers. And that's why Digant says that they're favorably placed. Digant, I wanted to ask you about the asset quality. On the asset quality side, particularly in various pockets, MSME, 2- and 3-wheeler space, there are suddenly some signs of some pressure. Right. For the sector on the whole, how are you reading it?
Yeah, so see, I think the pressure is in the high yield lending space. Like if we break down the entire lending space, the pressure is in the high yield lending space. So you look at microfinance, you look at personal loans, you look at unsecured business loans, and lastly, you look at these 2-wheeler, 3-wheeler loans. So these are all places where you lend at more than 20%. There is a stress. The stress is not come today. It is building up since the last 18 months. Yeah. I think another 6 months and we will find our feet. So it's not something which is alarming to me. I think we have already seen bad patches. We are about to, end those bad patches in coming quarters.
Yeah, that's heartening to hear because let's turn our attention then on the vehicle finance companies itself. From that space, HDB Financial, well, it recently listed. And those that bought in the pre-IPO would be a little bit worried, because the IPO came actually attractively priced. Right. Now, going at the current state of affairs and, the valuations that it trades at, what's your view on this name, HDB Financial? If you compare it with the traditional darling, that was Chola, always got the best in terms of valuations. Right. Out there, between the two, good pedigree, good parentage, what's your pick? How would you approach both these two names?
Yeah, I think, see, Chola, there is very little to complain, but the macro setup is really we were at the best possible scenario for the last 3 years. Good truck prices, good number of trips. So everything was going good. I think after 3 good years, we have a high base and, we are slowly decelerating. So somebody like Chola, who has seen amazing valuation expansion, amazing returns, I think that should rest now. The best days for Chola as a stock, maybe 1 year is a time of consolidation for Chola, maybe even a little bit of correction because it has run ahead in terms of valuations, around 5.5 times price to book. HDB Financial, on the other end, it has struggled over the last 2 years in terms of asset quality and operating costs. But I think if cycle improves, which is our thesis of this show, that, the lending cycle will improve in the next 4 quarters, I think HDB Financial can meaningfully outperform Chola. Not to say that, these are like small caps who can go up a lot and something like that. But between the two, I think the funds may actually end up shifting from Chola to HDB if HDB shows a little bit of execution. All right. So, and HDB is much more cheaper. So
absolutely, as that chart is telling you, HDB is still relatively more attractive priced if you look at it against Chola. So we take that on board. And in the near term, you would say, if someone is looking at a fresh investment, you'd rather pick HDB over Chola for the reasons that you've given. What about Shriram Finance? It was attractive. Then it became even more attractive, made its way into the Nifty, and it's a frontline name. Valuation cushion, but what is your view on the stock?
I think Shriram has also done really well. If you look at last 3 years, it's done better than Chola also, which will come as a surprise to a lot of the observers of this space. But I think, see, Shriram should also rest. Just like Chola, I think Shriram should also rest for some more time. Their numbers, we are at 3.5% ROA. So, when you are at a high base and the environment is not very favorable, you may not show very strong earnings growth, and stocks typically don't do well. It's a great business model, great company. But I think, you will get better opportunities after 6 months or 9 months.
Okay, let's talk about then. So Shriram, Chola, maybe a bit of a rest. HDB Financial is something that could relatively better place. But let's talk about a stock actually that's done very, very well. L&T Finance, the stock is up, I think, close to 50% in just the last 8 months or so. It's re-rated a fair bit. But since Mr. Sudipta Roy, since the time he took over, there's been a lot of good news that's coming in there. And we just spoke to them actually. They said that they'll grow by 20-25%. That's good. But they only cautioned that the MFI industry, that recovery could be pushed back by a quarter. Your view on the stock, it's already seen some part of re-rating. Is it getting started, or is the best already in the price?
Okay, so yeah, so see, they had this turnaround 3 years back when the new CEO joined. He changed the way credit is done, especially in two-wheelers and tractors. So I think that turnaround will be visible, from say next quarter or Diwali. And microfinance, as we say, is a pain for everyone.
Yes.
But if you look at the comparative charts, the pain for L&T Finance, Ujjivan, and Credit Access, these three companies, it has been the least. Like, so they have been the best 3 out of the 40 microfinance companies. So I would think that this is one place where you have a large name, comfortable valuations and good potential, combination of all 3. So if somebody is looking at the larger blue-blooded names between say Shriram, Chola, Sundaram, Mahindra Finance, L&T, I think L&T is a hands down, can be a better performer than the other large names.
But the only point is after the recent run, it's not that cheap compared to what it was. That said, what would the fair multiple you would give it, for L&T Finance?
So see, L&T Finance, all other diversified large groups, who have corporate backing, they're trading at 3 to 5 times price to book. This guy is at 2 times.
Yeah.
Obviously, it is because the ROEs are at 11-12%. I think as the ROEs re-rate, which they should over next 18 months, I think the valuations also have room to expand. So you have a 20% room to expand in terms of valuations, and then earnings compounding is what people can earn. And in absence of all other ideas, a lot of money can flow. So valuation expansion can be a bigger game as well, which we cannot predict today. But if Sundaram, Shriram, Chola, do not attract money, the money is going to flow somewhere else.
Well, Digant, so that's about the vehicle space, vehicle financing space. But I think the space that gives you some comfort is with the way gold prices have moved up. These gold finance companies actually could be pretty well placed. And also the commentary that's coming from the RBI, particularly in the last, I think, 10 to 12 months, has been favorable. That said, just give us a couple of basic numbers first. What is the size of the opportunity out there? How much of it is unorganized? How much of it is organized? The split between organized and unorganized?
Okay, so see, credit card, people like us, we get credit cards. We can just go and swipe whenever we want. Gold loan is sort of, a credit card for the businessmen and credit card for the poor. Like, whenever you need emergency loans, you pledge your gold, you get the loans. It is no more a distress loan in India. It's not as if when I don't have anything and there's emergency. So it's like a business loan. So instead of playing a personal loan company or a business loan company, gold loan is a preferred bet. That the overall industry is very huge. More than 15 lakh crores is the total industry size. But half of it is controlled by money lenders. Money lenders charge 36 to 40% interest rates. And it is almost criminal. Those rates are so high that, I think these NBFCs charge between 14 to 19%. So they have a very good case. The banks generally charge between 12 to 16%.
Okay.
So that is the spectrum. I think this is an industry which is growing because 1, gold price is extremely favorable. 2, the regulator has streamlined the guidelines and the guidelines are actually in favor of the sector growing faster. And 3, you have more and more players who are coming in the gold loan industry, like Poonawalla is starting with 400 branches, L&T Finance acquired Paul Merchants, and so on and so forth. So when everybody markets gold loan, the industry itself expands.
Okay.
And when personal loans and microfinance loans are not easy to get, gold loans is something which shines.
And this 15 lakh crore, as you said, it's divided into 50% each of them.
Organized
so,
and unorganized.
So for the industry, what kind of growth rate are you working with for the organized sector?
So Nigel, I think these numbers may sound insane, but 20% is a bare minimum growth in gold loan industry, which we can see this year. That is when our credit growth is going to be 9-10%. So it will grow 2x that of the system. And because of all the 3 factors which I just highlighted before. One factor which every investor has to keep in mind is you have to keep your eye on gold price. If there's a big crash in gold price, then gold loan companies cannot do well for 6 months. That is a patthar ki lakir, or what do you have to say? It's a very big thumb rule.
Okay, all right. Muthoot, that's been the big daddy, right? It's always enjoyed those premium multiples in the space. But that's what could limit the upside. Instead of Muthoot, would you rather play the other ones that can now twinkle? Say a Manappuram that's got new ownership, or an IFL that's coming out of a ban. Yeah. So among these 3 names, at least, what do you like?
So I think there's a spectrum. Each kind of investor can pick what they want. Muthoot Finance will probably do the best because it is best suited to capture all the growth. But Muthoot Finance probably more for the large funds, for people who are happy with 15-20% kind of returns. For people who want to play a recovery trade, I think IIFL has a wonderful gold loan book. They will show you the sharpest upsurge in growth because they had an RBI ban and so on. And there's one more interesting company called FedFina, which is a subsidiary of Federal Bank. I think that is something which got listed a year back. slightly undiscovered by the market. And, to your surprise, in gold loans, we look at what is your per branch AUM. So Muthoot is number 1 with 21 crores of gold per AUM. Number 2 is FedFina. It is not Manappuram, it is not IIFL. Number 2 is actually FedFina. So, FedFina, IIFL are interesting. Manappuram, the new CEO is about to join. They have some more pain in the microfinance. So, maybe I'll wait for a quarter or so for it to settle and then we can move ahead. But these gold loan companies are really better placed than the personal loans, companies like say Bajaj, Poonawalla section, which will come to the next.
All right. So in terms of preference, maybe Muthoot will not shine as much from now on. It could be a compounder though from here on. But the delta could come in from companies like FedFina and IIFL as well as a Manappuram. Well, you spoke about some of those consumer-facing finance companies. I'll tell you what. We'll slip into a short break. We'll come back and we'll continue the discussion. Digant will tell us what's his view on a few of those names as well. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha on CNBC TV18. Well, we're still in conversation with Digant Haria. Digant, we have discussed a few themes, but as promised, we're going to be moving now to the diversified consumer lenders. Bajaj Finance, that's been the poster boy, right? If you ask anyone in 15 years, where did you make your money? They would say Bajaj Finance. The problem is now that the numbers, even when they're good, people want more. Ye dil mange more, right?
Yeah.
Do you think Bajaj Finance has run its course? Or can it give, I don't know, maybe a mid-teens, double-digit returns from here on?
I think it has run its course. It's very, it's a very harsh statement to make, but I really think that it has run its course. If you look at last 9 years, the stock price CAGR of Muthoot Finance has been higher than Bajaj Finance. A lot of people don't know this, but this is the reality. See, Bajaj was a leader in physical world, buy now, pay later. You go to a shop, buy a TV, buy this. Now shopping has moved online and Bajaj is no more the leader there. So Bajaj, the main reason why Bajaj is struggling is it is no more a leader in any fastest growing segments. So Bajaj has been moving to different segments like gold loan, micro loan, tractor loan, everything which is traditional. The Bajaj never did traditional stuff.
Yeah.
But now because they are not able to grow, I think they have reached a size that unless India's middle class and lower middle class does well, Bajaj cannot really outperform. So Bajaj's outperformance is now so much linked to what happens to the entire middle class. It can no more outperform the country in a big way. So I think we can, personal loans, MSME loans, two-wheeler loans, the credit card loans, they are all struggling. And, which is why, apart from Bajaj Finance, we should also be very cautious on companies like, say, an SBI Cards or companies like Poonawalla FinCorp, which are talking of very fast growth in such an environment. I think these are places where investors will have to wait a lot before they can see returns.
All right, so Bajaj Finance and Poonawalla FinCorp, for the time being, you would not be, looking to jump into it. But I want to ask you about SBI Cards, because that's the only listed credit card player, right? Credit costs remain elevated. Every time, there is something or the other, and now the best is yet to come, it doesn't come. Even, the past quarter's numbers haven't been that impressive. So asset quality is an issue, credit costs go up, growth is not coming about, they're not making any big dent in any market share. What's your view on the stock? Because if you look at rank underperformers, this is one stock that comes to your list.
I'll just give you one line, Nigel, that in credit cards, if you want to make money, you cannot sell credit cards at petrol pumps, at malls, at railway stations. If you do it this way, you invite a customer segment which is not very strong, and which is why your asset quality issues never end. So 2021 to 23, their sourcing strategy itself was, you go much lower down the pyramid. And which is why you see quarter after quarter losses come and management is clueless.
Okay, all right. So that's aside. But JM Financial, that's something that you've liked. What's it? What's happening out here? Does it have more legs?
Yeah, so it's a capital market play. And if you look at this stock, 2008, the price was same as it is today. So it's almost 16 years. The company went through a lot of pain in the NBFC space. They have come out of that pain. So I think good times for the company are just about starting. It will be a very interesting capital market play to track for the next 2 years, because it's like a long 7-8 year of pain which is coming to an end. And capital markets division is doing very well. So instead of a mutual fund stock or a broking stock, we prefer something like a JM Financial where, there is a lot more steam in the business.
And it's got valuation comfort as well, even after this big run. So that's something that you like.
Absolutely.
All right, let's wind this down then by turning our attention to the micro lenders. Companies like Credit Access, Arman, they have 70 to 90% in this space. And they're well placed. Do you like any of these two?
So see, microfinance is always cyclical. No matter what anyone tells you, there is a good cycle, there's a bad cycle. Right now, we are going through the deepest point of the bad cycle. Maybe in a quarter or two, from the deepest point, we'll start the upward journey. So if somebody is interested in playing cyclical stocks, I think this sector offers upsides. The best companies, the best managements are Credit Access and Arman in this space. But, we feel that microfinance, even in the upside, it will be a little slow because that over leveraging was just too much. So in this space, we like something else, which is Northern Arc.
But tell us more about this Northern Arc, because there was a pending large trade. It took place, got cleared out around 200 rupees. From there, that has been one of the biggest outperformers from the broader markets. So at around 260 ballpark, what's your view on this name?
Okay, so...
And what are the key triggers you'll be tracking on this one?
Perfect. So see, Northern Arc is a very unique company. They lend to 300 other NBFCs. That is their first business. Second business is they lend to small LAP, microfinance, just like, a lot of other companies, say SBFC or, 5-Star would do. So they have these two major businesses. One of the business, which is microfinance, had some trouble, and which is why the stock is trading at 1.1, 1.2 times book. I think the base business is so strong that once the microfinance down cycle is over and the up cycle starts, this will also re-rate quite significantly. So in Northern Arc, I see that there is a reasonable room, just like JM Financial or Fed Fina, there is a reasonable room for the business model to outperform in terms of earnings. So that is our business case in Northern Arc.
Northern Arc and JM Financial. But before we wind down, we had a couple of stocks on the screen, SBFC and 5-Star Business. They traded around 4 times approximately. What's your view on these two names, or are you going to give us an alternate?
See, I think both are into that very high lending space and they're growing fast. So this is an area which I try to become a little cautious, that high yield and fast growth, there's a chance of mistakes. Valuations are also very rich, so there is no margin of safety. So I think gold loan companies in this environment, investors are better off being in gold loan companies than in these companies. Maybe once the environment improves, we can do a shift trade. But
all right, Digant, it's been a pleasure having you on the show. Thanks a lot for joining in, explaining all of that to us. Just to rewind, India Shelter is something that you like. From the gold finance companies, Fed Fina, something that you like. And from the other stocks, Northern Arc, JM Financial, they could still look from here on. And that trade you spoke about, maybe it's time for Chola to make way for HDB Financial. It's been a pleasure having you on the show, Digant. We look forward to chatting up with you soon.
I'll just say one thing, that investors need to be patient. This whole cycle, it will take 2 or 3 quarters for the cycle to really turn around. And yeah, be long-term, track the businesses, not the stock price. And whatever we spoke is business analysis. That's it from my side.
Well,
thank you for having me.
Bang on, Digant. On that note, though, we'll wind up on this edition of Finding Alpha. Thanks a lot for joining in. We hope we managed to dissect the entire space for you. More news and updates coming up on the other side.
Hello and welcome to News Center. I'm Parikshit Tutra. With only 4 days to go before US's August 1st deadline to impose tariffs, trade talks between New Delhi and Washington are in a stalemate. Sources tell CNBC TV18 that there is no major breakthrough as US is seeking a more ambitious agreement with India. The United States wants zero duty access to the Indian markets like America's deals with Vietnam and Indonesia. The Trump administration is also pushing for India to commit to big ticket purchases and investments. Meanwhile, India is evaluating its options ahead of the deadline. The options include the imposition of equal reciprocal tariffs. Remember, US Commerce Secretary Howard Lutnick has said that Washington's August 1st deadline will not be extended. Both nations plan to agree on a bilateral trade agreement by October. A delegation from the US is expected to visit India in August for the 6th round of talks. To take this discussion ahead, I'm now joined by Jayant Dasgupta, former Indian ambassador to the WTO, and Sudhir Sekri, chairman of the Apparel Export Promotion Council. Also on the program with us, Ajay Sehai, Director General and CEO of the Federation of Indian Export Organizations. Gentlemen, thank you very much for joining us. Ambassador Dasgupta, to begin with you, do you think India now, in the absence of any kind of interim deal, will have to be ready, prepared for an eventuality where there may not just be 26% reciprocal tariffs, but plus a 10% additional BRICS tariff as well?
Of course, we are keeping our fingers crossed as to whether there would be an agreement before the 1st of August deadline. But failing that, India could expect something in the region of 20-25% perhaps as tariffs. Because Indonesia has got 19%, Vietnam 20%, Japan and Korea 25%. So I think that is, and of course the Europeans seem to have got 15%. Of course, the agreements, details of the agreements with Japan, EU, Indonesia, none of them have come out. And it is also not very clear whether the full written text is available at all with either side. So there is a lot of uncertainty, but I think the tariffs, if they are imposed by President Trump, will be perhaps, hopefully, in the region of 20% or so. Now, the other thing is that India is negotiating not only against this deadline of the 1st of August, but the first tranche, which is supposed to be ready by about October, and which will cover a very wide-ranging array of subjects on trade. So President Trump, while taking a decision, would definitely bear that in mind, that even if there is no agreement in the interim, the first tranche could be negotiated, and steps have been taken in that direction.
Right. So let's see how exporters and companies in India are preparing despite all this uncertainty. Mr. Sekri, to get you in, how is this impacting your businesses, your exports to the United States? In the eventuality there is a 25% or a 26% tariff, how is the business going to be impacted?
Well, you see, we have to see it in the context of what is going to happen with our competition. Our business today is definitely at a standstill because the buyers are not clear as to what the tariff is going to be. So they're holding back on orders. I'm talking about the US buyers. Our business Europe is also impacted because of the high tariffs that the US has imposed on China. A lot of Chinese manufacturers are now selling to Europe at very low prices. So that's where a lot of European orders are also moving to China. Now, coming back to the US context, yes, we definitely look forward to a very fair and equitable tariff for India. And what we have been given to understand by government sources is whatever best the government could offer has been offered to them, and we cannot do anything better than what we've done. So given this scenario, we are keeping our fingers crossed, like the ambassador just said. But we believe, based on sources, that it could be anything from 15 to 26%. Now, if it, as a worst case scenario, even if it's 26%, we are still better off than Bangladesh, which is at 35%. We are better off than China, which is at 30%. We are better off than Vietnam, because Vietnam is 20% plus 20% if it's transshipment. Well, Indonesia is a bit of a competition, so they are at 19%. So we stand to lose a little bit there. But my belief, it could be anything between 15 to 26, but closer to 15 than 26.
Okay. Let me go to Mr. Ajay Sahai Rao for a larger comprehensive picture of India's exports to the US. Are you seeing probably buyers holding up orders or cancelling orders in the run-up to the 1st of August deadline? Mr. Sahai, which sectors, according to you, are most impacted currently?
In fact, I'm not looking into any case where they are looking into cancellation of the orders. Orders are on hold, no doubt about it, but large inventory has already been built in the US. And in the given context, when I'm looking into a tariff in the range of 20%, I'm not expecting much hampering of exports. So probably the bottom lines of companies may be impacted. Even assuming the tariff on India comes to around 20%, we may be worse off with some of the countries. I'm pretty sure that buyers and sellers both will take a call on them and both will ensure that the supply line is intact. So there's not much challenge on the exports per se, but of course there are issues with concern with the profitability of the companies, because they also have to take a hit if some sharing is being done, assuming that the additional tariff on India comes to 10% and it is decided to be distributed between buyer, seller and consumer. An impact of 3 to 4% maybe on the profitability of the Indian companies.
Right. Let me go back to Sunil Sekri. Mr. Sekri, will the companies in the US, your clients in the US, be able to absorb the cost if the tariffs are between 20 to 26%? Will the exports continue as it is?
Well, you see, first of all, the point I'd like to make here is that, people need to wear clothes, so they will buy clothes. Only thing is that a person who is buying, say, maybe 4 shirts every season, he'll probably buy 2 shirts. So, see, there is going to be a slight decline in business. However, keeping in mind that our competitors are going to be hit with higher duties, our business from India may not be that much impacted. And like Mr. Sahai just said, I think people are just waiting for this 1st of August deadline. And once things are clear, whether it's going to be 26% or 20%, I think there is going to be a flow of orders, and we're going to have sufficient orders to take us through the spring-summer season, which ends somewhere, which is through October 25 to March 26.
Right. And Mr. Sahai, just one quick question. In case Donald Trump decides to impose a 26% reciprocal tariffs plus a 10% BRICS tariff, making it 36%, as some reports are speculating, could that probably hit trade badly? Anything beyond 26?
Definitely, if the tariff of 36% is imposed on India, may not be possible for the Indian exporter or the US importer to absorb it. And in that scenario, it may be impacted, but then we also have our options of retaliation also. As of now, we are only expecting a tariff not more than 26%. We are also looking into that 10% tariff will be applicable on all the countries. So only the differential of 16% has to be managed by the Indian exporters, and US importer will also be looking into that sooner or later. India will have a BTA in place, and that's why they would like to retain the supply chain.
All right. So clearly, both sides will work with a long-term scenario in mind. Ajay Sahai, Sudhir Sekri, Mr. Jayan Dasgupta, thank you very much for joining us on the program. We're taking a short break, but coming up, TCS has announced more than 12,000 job cuts in what is the biggest layoff in the software industry yet. A special discussion with R. Chandrasekhar, former president of NASSCOM, and Mohandas Pai, former HR head at Infosys and chairman, Aaron Capital, when we return. Welcome back. The big story we're tracking this evening. Tata Consultancy Services has said it will fire 2% of its total workforce, equating to roughly 12,000 employees over the course of the current financial year. This is Indian IT's biggest layoff exercise to date. The company had laid off more than 3,000 employees, equating to 1% of its total employee count. In FY15, shares of the firm tanked in trade in response to this development. The employee strength of IT majors have also remained largely stagnant in every fiscal since FY23. In fact, TCS and Wipro have seen a reduction in headcount while employee strength has improved. For Infosys, this has companies reduced hiring after stocking up on talent during COVID-19. Furthermore, growth has largely moderated after a pandemic-fueled surge, with constant currency revenue growth even falling quarter on quarter in the case of TCS and Wipro in the first quarter of this fiscal. We're now joined by R. Chandrasekhar, former president of NASSCOM, and Mohandas Pai, former head of human resources at Infosys, also currently the chairman of Aaron Capital. Thank you very much for joining us, gentlemen. Mohandas Pai, what do you think is fueling these layoffs now at TCS? And do you think it's going to have larger implications? This is a sign of things to come for the IT industry in India.
Look, I think the media is making too much of this thing. Please understand, whenever growth slows down, there's a concentration of people in the middle and the higher levels because the pyramid impact goes away. We're not hiring enough people at the bottom. People in the middle get promoted, they go up the ladder. And when the pyramid gets flatter and not at a particular angle, you have too many people in the middle and you have to downsize or right size. And that's what is happening. It's happening earlier too. Please remember that. It's happening earlier too. And the CEO of TCS has said it's got nothing to do with AI and other things. It's got to do with the fact that they got too many people at the middle and senior level, and they do not see them being useful because people at the bottom too are coming up to those positions, and those people are stagnated, are possibly not in a billing role, are possibly becoming managers who are pushing paper, and they have to right size. This is going to happen every time the growth slows down, and this is a normal event. Please remember, TCS has attrition of 12 to 13%. A 12 to 13% attrition on 66 lakh people is about 70 to 75,000 people. When 75,000 people leave every year and they hide to make it up to retain the numbers, and they say an additional 12,000 has to go, it doesn't make sense. I mean, it is a very small number. There's just right sizing.
Right.
I don't think you should read too much into it. It happens whenever growth slows down, and it's happened now.
Okay, Mr. Pai, one more question. If we look at global trends, almost 80,000 tech sector employees around the world have lost jobs across 169 companies in 2025. In 2024, 150,000 job losses took place across 551 tech firms. What's happening in India and what's happened to TCS? Do you feel it's in line with global trends? And number two, is it only because of overhiring, global uncertainties, low growth, AI, automation, or all of the above?
Look, there are 6 million people working in software in America. 6 million. How many are let go? 50,000, 60,000? Is 1%. 1% is a small number. And they've probably gone to other enterprises and most of them have got jobs. I don't think we should read too much into it because you don't look at the denominator. You're only looking at the numerator, not the denominator. In India, again, 6 million people are employed in the software service export industry. 7.5 million people are employed in the entire software industry with startups and the local industry too. And in that, even if you have 30, 40, 50,000 people being let go, some companies, others will pick them up. Maybe 10, 15,000 will have to retire. So I don't think it's a very big deal because these are normal things. You've not seen it happen. You've seen it happen earlier, once when the things slowed down too much for a number of years. You're seeing it now. And I think it's a very normal feature to right-size the pyramid, to right-size people who probably are not contributing. And I think it's okay.
Right. Now, let me go back to Mr. Chandrasekhar. Mr. Chandrasekhar, are we to say this is only because these employees or employees who are being laid off in the IT sector all across, is this because the employees are misaligned, there is a mismatch of skills, or has there been overhiring over the years? What is your view?
Parishit, different segments of the IT industry are actually growing differently at this particular point. The IT services and BPM segment has had some changes. It has been buffeted by some of the changes, including the advancements in technology. The GCC segment is still growing quite rapidly. And the startup segment in India is also showing growth. If you look from an overall industry perspective, therefore, you have to look at an aggregate of all of these things. But if you look at the IT services and the PPM segment, then as the name implies, they are not entirely the makers of their own destiny. A lot of it depends on what is happening in the businesses that they serve, the businesses across the world who are their clients. The advent of AI, no doubt, has been a big factor. And almost every sector of the global economy and society is getting impacted by that. Although the immediate cause for the TCS action is not the advent of AI, and I think Mr. Mohandas Pai has explained that aspect quite elaborately. But the fact is that despite all the hype about AI, businesses, and I'm talking now about client businesses, not the IT itself, businesses have been taking their time to actually figure out how to absorb AI, how to assimilate AI, how to adapt to the post-AI world, and do all of the things that are possible with AI. There's also the question of the level of reliability which AI has reached when you come to things like enterprise AI, or even to have whole processes, critical processes run by AI. But while that is the case, and those are the areas which will translate into business opportunities for the Indian industry, and over time those will be very big opportunities, I do believe. But in the short run, what they believe is that the IT industry is employing AI, or should be employing AI, and should be able to deliver a lot more with less. And that is translating into cost pressures on the companies to deliver more with less, to lower the costs. And companies, obviously, if they want to remain competitive, have to adapt. And the adaptation is being done in small doses. And I think that calibration arithmetic has been very well explained by Mr. Mohandas Pai. So I think that is what we are actually seeing, how the industry is dealing with this aspect. One other point which I want to make is that, the new kind of jobs which will be created over a medium term, when the businesses, the client businesses, start adapting and adopting AI more aggressively, will require very different skill sets. Pure vanilla tech skills are not going to cut it. And therefore, there is this question of what are the kind of skills that are going to be needed. And it's going to be a much more diverse set of skills, as well as a deeper...
Chandrasekhar?
Yes.
Mr. Chandrasekhar, that brings me to my next question. People who are losing their jobs right now, how should they upgrade, upskill themselves for the future?
Yes, I think that's a very good question. That is really the question which both employers and employees should be asking, and the country as a whole needs to address. And I do believe that a lot of this will require, as I said, diverse skills, because when you talk about AI being adopted by the client businesses, it's not just about technology adoption. Nobody is going to say, let me adopt AI so that, I can shout from the rooftops that I use AI. They are looking at how it impacts their business. What is the connection with the amount of money you spend on bringing in AI, and a perceived or a notional reduction in the kind of direct control that they have. So when you look at those return on investment numbers, it is still not that easy to predict or put a precise number on that return on investment. So I think the question is, people who are involved in helping their client businesses to adopt AI will have to develop the diverse skills required to explain and help them to figure out, to become a true tech partner in the sense, to help them to figure out how it's going to relate to their business, how it's going to make the business more efficient, and how it's going to translate at the end of the day into greater profitability and ROI for the company.
Right. Mr. Pai, coming to you, what is the larger question? You've said that what's happened in TCS is normal for a company to do restructuring, do some right sizing in the context of the economic environment, in terms of the financials. But what is going to be the question for both employers and employees in the days to come?
Well, let me first make a big statement. Look, Indian IT was a sample in a large universe for many years. Now they are the universe. They're the biggest players in the world in IT software services with $235 billion of exports. They got about 6 million people. It's a very, very large industry. So they will grow at best, or maybe if they beat the global growth, they'll be very high. If globally the market is growing 3-4%, if they grow 4-5%, that's fantastic, right? Please remember, when they grow offshore, revenues are offshore per person of 40% the revenue on site. When more work moves offshore, the revenue does not grow the same pace because the earning is not one-to-one between on-site to offshore. Many people miss that. Now, the key thing to see is how quickly will global enterprises imbibe AI? Because AI usage by global enterprises is not like you and I using AI. You and I can use Grok or whatever it is we use to ask questions, say, hey, we are all AI. Global enterprises have to look at how to use AI. They have to test it out. They have to make sure everything works. And they need people. And where are the people who are trained in AI? Is in India. Where are the data scientists for them? They are in India. They have the offshore company. They're not in America. I looked at a recent job posting in America. There are almost no job posting for software people. They're all for AI people. I mean, the same people who now call themselves AI can possibly apply because the nomenclature changed for many of them with a little bit of training. So the number has gone there. And look at the GCCs. GCCs are growing hugely. Why are they growing? Because the global enterprise have found that what they were doing in their home country of America, Europe, can be done better in India. They have more flexibility. So when after COVID, they shifted a lot of work offshore. They still have it under their control as against people to whom they outsource, like the big IT service companies from India. So these are tectonic shift that's happened because GCCs are hiring. That means the growth rate overall for spending has come down because of confusion about the use of AI, because of the tariffs confusion and high interest rates in America. So global growth has to stabilize. And once they stabilize, people will start using AI more. And when that happens, the offshore players and Indian IT will be the major beneficiaries because they're the ones who can work for the global enterprises to put AI into them. So I think right now we are in between two tectonic shifts. And also you must remember, using AI tools will increase productivity by 15 to 30%. So the last 2 years, productivity has gone up. Quantum of work done has gone up because a lot of the people, Indian IT, have been trained. They're not there in revenues, but the money that is released by projects being completed quickly, go back and for more projects and more work as and when the market starts improving. So we have to wait and see.
All right. Thank you very much, Mr. Pai and Mr. Chandrasekhar, for joining us with that very important perspective on the layoffs in the IT sector in the backdrop of what's happened at TCS. Let's see how things pan out in the weeks and months to come. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
India's software industry is a key pillar of the economy. It accounts for nearly 10% of the GDP. Now, Indian engineers are a mainstay even in Silicon Valley. From Sundar Pichai at Google to Satya Nadella at Microsoft, Indian engineers occupy corner offices at some of the world's biggest tech companies. But the software industry seems to be at a crossroads. After a pandemic-fueled bump, growth has largely moderated. Employee strength and salaries at top IT companies have remained stagnant over the last 3 years. In fact, some have seen a reduction in the headcount. There are new opportunities and challenges in the form of automation and, of course, now generative AI. Add to that, software service providers facing more competition, with multinational companies establishing their own global capability centers, or GCCs as they're called. IT companies need to transition to new technologies while also rethinking their business models. This is the Editor's Playbook. Each week, our team of editors will put the spotlight on the most compelling events across the world and try and decode what they mean for India. I'm Shireen Bhan. With me, our band of editors, Prashant Nair, Nimesh Shah, Reema Tendulkar, Surbhi Upadhyay, and Shriram Finance. Guys, thanks very much for joining us here on the program. For context, I want to go back to a conversation that I had in January of this year. And everyone was talking about a demand explosion. It was Infosys, Salil Parekh, Tech Mahindra, Mohit Joshi, Kriti at TCS. Everyone was talking about how they anticipated this year to be a much better year for Indian IT services because of what Trump would do with deregulation and the demand explosion that they were hoping it would unleash. But I had a conversation then with Frank D'Souza, the man who used to head Cognizant, and these were his words. He said, Indian IT companies are facing an existential crisis. Now, this is not the first time this has been said. I would imagine it's not the last time that this is going to be said either. So let's go across to our own in-house IT expert, Reema Tendulkar, to put this in context for us. Reema, to start with, is there a problem? What is the problem? And what are we talking about?
So let's, Shireen just put it in context, right? Look at the last 10 years, FY15 to FY25. And here I'm going to break it down in the last, in 3 periods, right? There is FY15 to FY20, which is pre-COVID, when IT companies were growing at 8, 10, even 12%, barring, say, a Wipro. Then you had the COVID boom. Okay, from a low base of FY21, FY22, 23, IT companies were growing at 15 to 20%. The drivers were digital transformation, there was the cloud migration, and then there were these very, high intensity, short duration projects to enable, say, a work from home or to realign the supply chain. So therefore, IT companies were booming, 15, 20% kind of a growth, perhaps even more. And then came, the after. So FY23, FY24, FY25, growth rates started tapering off, and we're talking about 2 to 4%. And this year is also going to be no different. Look at Infi. They're guiding for a 1 to 3% growth. So growth rates have literally fallen off the cliff in the last 3 years. Everyone was saying that, tech budgets are unutilized. So at some point, you're going to get that pent-up tech, boom, but that's not coming so far. So the worry now is that are the Indian IT companies in a structural slowdown? Gone are the days of an 8%, 10% kind of growth, but we could be in a low to mid-single digit kind of a growth rate over the medium term.
I mean, just look at the graphic that's coming
out. Structural slowdown. Yeah, go ahead, Shriram. I just wanted to address this issue. When Reema talks about a structural slowdown, it kind of also seems to reflect what Frank D'Souza was talking about. I mean, he used a more dire expression, an existential crisis. But is there a growth problem? Is there a business model problem? Is there a capability problem? I mean, that's what we're trying to understand here.
I think it's a mindset problem, to my mind. I mean, if you just go back a couple of months when Piyush Goyal was complaining about the lack of deep tech work, absence of deep tech work in India, a lot of people reacted, venture capitalists, startup founders, etc. Yeah. But to me, the silence of Infosys, TCS, Wipro was conspicuous. I mean, they should have been the first one to answer that question, because what does innovation require? Capital, talent. And if you have about 1 million engineers, techies working for you,
I think 10 million last count.
Exactly. I'm just saying, you can't, I mean, if each company has to put together 50 people and say that, do whatever you want. And we could have been on the forefront of innovation instead of just talking about it. I mean, I was just pointing towards the graphic that was just fired, right? One could argue that, their growth rates have fallen from 21% a couple of decades ago to now what's the number?
2, 4, 3.
Yeah, exactly, right? I mean, the last 5 years, CAGR is 8.1%. But I'm saying one could argue that it's a base effect. But this existential crisis, Shireen, that you spoke about, like you only said, it's not the first time that somebody has said this. In the last 4 decades, we've had 3 such existential crisis moments for Indian IT. One was after the global financial crisis when the whole world was moving from, to cloud and big data. Then you had the digital services around 2016, 2017. The cloud had taken shape. Now the SaaS had exploded all over the world. So Indian IT services had to respond to that. And then you had, now you have AI. 4 decades, 3 big shifts. And 2 lessons that are very clear to us, which is macro headwinds, whether it's political in terms of Trump presidency, Brexit, the whole movement against outsourcing that happened at the start of 2010s. After all of this is inevitable. You can't do anything to control it. What can you do? What can you control is the money that you spend on R&D. If you don't innovate, if you're not ahead of the curve in terms of what technologies are coming up, then you will constantly play catch up. And quite honestly, to be fair to them, they have caught up also very efficiently, right? I mean, they've managed to do that. But, you can't bet on that each time. They've made a lot of money for investors, but have they built a lasting company?
And that's an important point to bring up, because, again, I was having a conversation with someone who said, and his rebuttal or response to this existential crisis thing was that, look, the same thing was said when the digital or digitization wave took place. But today, you don't even differentiate when you talk about Indian IT company revenues. You don't differentiate between digital and the rest of the pie, so to speak. So they have made that transition. But on the innovation
the point, Shireen, my point is that
everybody on board. Then I want to bring everybody on board on that and get them to respond. Does the market reward the big bets on innovation that may not play up in the short term?
The market, I think.
Who wants to go, guys?
I mean, I have some data, which is, but it's not exactly answering your question, Shireen, that does the market reward continuous spending, R&D spending, you keep spending and then, something sort of clicks, right? I mean, I think that is your question. But in the US, right, and it's always been different. Indian IT services companies were always all structured
as a services
hundreds of thousands of people. TCS is what, Rima? 6 lakh employees, right?
Yeah,
plus. So it's like and it was always cost arbitrage. That was the work. It was never leading technologies and building products, etc. Maybe it'll change as time goes by. So US IT has always been about products and new technologies, etc. They've been customers for Indian IT services companies. So just take a look at this. Magnificent 7 companies in the US account for about 47% of R&D spend in the S&P 500, right? 47% of the R&D spending is out of S&P 500 is these 7 companies. And guess what? To the question, are they rewarded? These 7 companies are 34% of the market cap of the S&P 500. Now, is that a straightforward answer? Of course, there are so many other things which go into the mix. But I just thought the data was kind of very, very stark.
So I want to bring in the R&D figure here. In the last 6 years, we have spent they've spent on average 1% of the revenue. So if you take FY25 revenue, it's about 6 lakh crore for the top 5 companies. I'm not going beyond it. And 1% of that is 6,000 crore. If you look at the actual number, it's about 3,500 crores. That's what they spend on R&D. And on the other hand, the investors in India have rewarded them for being consistent paymasters. They have given 1 lakh crore, these 5 companies have given 1 lakh crore as share buyback, as payment back to the shareholders. And that's what they've been rewarded for. So in terms of wealth creation, it's important to differentiate between how is the wealth created. By building a sustainable business or by short-term gains or long-term gains. And I think on that we've been sort of slightly...
In the US, by the way, buybacks are a huge thing. I mean, actually, there have been studies which show that a majority of the gains in the US over the last 10 years, US stocks, has come through buybacks, not through...
that's a short-term gain.
That is, but I'm just saying as a method.
You've had activist investors, activist investors in the US pushing for buybacks, and you've had, not We haven't had activist investors, but the call for buybacks here has been pretty loud as well. But, the data points to that. But,
Shirin, if I can,
back
sorry.
to this innovation question, just one minute. I just want to get Rima to come in here on this innovation question because, this takes me back to the time that CVK came into HCL Tech, Rima. And I remember very vividly then, he was trying to sort of push this idea of innovation along with the bread and butter kind of infrastructure business. And at that point, there was a pushback from investors. There was a pushback from the market. So I wanted to understand from your point of view, because, you look at this quarter on quarter, how do the markets perceive this?
Just one more example, Shireen, you remember when Sikka was there at, Vishal Sikka was there at Infosys in 2015. OpenAI. He wanted to pledge $1 million in OpenAI and, we don't know, but I think the rumor is that the board shot it down.
OpenAI, by the way, the last valuation is $300 billion.
Yeah, so he wanted to invest. Yeah. So, it's been very hard. Going back to the
I was going to make that point. Sorry, go on, please.
No, just the mindset, right? That every time a company wants to get into products, because it's so different, the payback, etc., the investment, the kind of capabilities that you need, there has maybe been a pushback from, the board. So, just wanted to give that example.
So from a market point of view, I'll just add what the market thinks of and how they take it. In India, there is still not enough patience for investors as well. Yeah. You rightly pointed out what happened to Infosys, what happened to HCL Tech as well. And generally, it's a success which people like to follow, right? In India, we've not seen a big success in terms of R&D actually making big, whether it's a pharma, whether it's in IT. We haven't seen.
We have Glenmark. We have Glenmark now.
Now we have Glenmark.
Finally, Glenmark.
Exactly. So we just had. Exactly. No, I'm coming to that. Correct. I'm coming to that point.
But yeah, those are few.
Very few.
But it's an exception that points the route.
Glenmark is the first instance where you're seeing the fruits of 20 years of effort in R&D finally paying off. Yeah. Equally, if you look at Spark, the Sun Pharma Advanced Research, for 20 years they've been spending money on R&D and everything. Investors are frustrated and they've not made a single money on it, right? So even from investor point of view or from analyst point of view, there's a lot of pushback there is not much enough patience. I'll tell you a simple I'll give you today's example. Look at Infosys results. Street is happy that they've raised the lower end of the guidance from 0 to 1%. And
the stock is down.
The commentary is this is the best that Infosys reported among all the large cap IT companies, which is true. But
I just
happy.
I just want to make one point that, and I remember HCL Tech categorically for the use of this phrase, moving from run the business to change the business. I think they used this phrase at least a decade ago, if not earlier. But the real transition in terms of moving to change the business side of it, I think that's been missing, and that's where now there is serious disruption. Therefore, maybe the talk of existential issues because there's AI. If you don't change now.
I want to put that quote in context. Yeah. When HCL Tech used to speak about, run the business to change the business, they were talking on behalf of their clients. They were not talking for themselves. They were not changing their own business.
AI is now forcing their hand, as we speak. And I'll talk about this, about what some of the companies are doing.
Today's example, Coforge. Now they're not investing in some great R&D, but they are saying we're going to put money in to build a data center. Yeah. Stock is 8% CC growth, quarter on quarter. Strongest ever. Stock is down 8%.
No, but that's a different argument. No, data center could be a real estate company's business. It's not exactly hardcore software solutions business.
But I'm saying new things, right?
But no, again, that's not a real estate company. But anyway.
No. Data center is not a real estate business.
Exactly, not a real estate play.
In fact,
it's a pure data play.
This is another misconception.
Exactly.
This is another misconception that has, especially in India. And I remember this conversation that I had last month in the with Raju Vegasana of SIFI, because they're doing data centers, and he said this idea that data centers are a real estate play in India is just a complete misnomer, and we need to get away from that idea that it's in fact a real estate play, because it's nothing of the sort. But
Yeah.
Let's talk about the markets and how the markets are looking at this sector at this point in time.
So, Shireen, from a market point of view, barring few, mid-cap companies like what we spoke about, Coforge, Persistent, some of those high-growing companies are still, getting richly paid. They are almost at all-time highs, and actually investors are rewarding as well. But it's the problem is with the large-cap 5 IT names, right? I mean, I was just looking at the data of last 10 years. Rima spoke about, various periods from 2015 to 20, then COVID, then last 3-4 years. But if you look at if you look at the 10-year period of the large 5 IT names, the numbers will shock you in terms of revenue, top line, and operating margins. Wipro in the last 10 years has given a revenue CAGR of 3.3%. The profit CAGR for Wipro is just 1% in 10 years. That's the kind of number that this large cap IT companies have thrown. Of course, they don't collapse or they don't fall much because of the cushion of dividend and buyback that they keep announcing every year and a half. So across all 4-5 IT companies, everybody has reported single-digit revenue, EBITDA, and profit growth for the last 10 years in terms of CAGR. Who have done well? Again, as I said, the mid-cap IT companies have relatively outperformed in the last 10 years in terms of growth. Coforge stands out, L&T Mindtree stands out, Persistent stands out, and something like Tata Elxsi stands out. So at least these companies have reported double-digit revenue growth over the last 10 years period. Otherwise, it's been a very painful
one of the things
phase for this large cap IT names.
And guys, sorry, I just want, and if we can bring up that graphic that has Wipro on it as well, because that's a startling number. I didn't realize that it was just 1%.
3% revenue, 3% revenue, 2% EBITDA, and 1% profit growth in 10 years.
The last 3 years, no revenue growth.
In 10,
but it's kind of gone through. Wipro perhaps is the
lowest of the pack, the others, and they've had multiple CEO changes.
I think 3-4 CEOs in that period.
See, all these numbers includes change of CEOs, acquisitions, everything put together.
You didn't mention this in our CEO discussion.
This is the kind of...
That's why we said new hands coming in, need for fresh blood and all that.
We do have a new hand at Wipro.
Yes.
But I'm just going by the data there that Nimesh presented, and again it takes me back to the conversations that were happening a few years ago, where the question mark was on, will mid-cap IT survive?
Yeah.
What will happen to mid-cap IT? Mid-cap IT seems to have done fine, Rima.
So again, the pivot, what Surbhi and Rima were talking about, the mid-cap IT has been able to pivot very fastly, change with the environment, and do the right things.
I think there's also a matter of size, right?
Exactly.
It's a big matter of size, and even this
car around. It's very easy to move a trailer, turn a trailer, right?
With size and if with the money that all these guys have,
correct.
You can't give an excuse just because
I'm not giving an excuse. I'm saying it is a factor.
They can't pivot.
It's over-conservativeness. Maybe it's just that. It's just being very, very cautious and maybe
the base effect, like the growth rate in mid-cap IT looks better.
I think Prashant has a point. I think Prashant has a point there. You can't totally discount the base effect.
Yeah. No, of course. Like TCS is $30 billion in size, Infy is $20 billion, and these companies are $1 billion. Exactly, they won 1.5. Their aspiration for Coforge and Persistent is to get to $2 billion.
So my limited point is that yes, size, base effect does matter, but the fact that with this size, with the kind of might they have, the kind of cash they were sitting on,
correct.
None of them made an effort to pivot and go for an aggressive...
but had they invested in R&D with the huge cash balances, right? $5 billion plus for an Infy
and the human capital.
And the human capital, right? We've got the best homegrown engineering talent. But at that point, your buybacks would have come down, your dividends would have come down, and then you would have had...
That is what...
So it would have been a bit of a trade-off at that point.
It's like I want
to take back one point about what Rima said, right? It's a trade-off between share buybacks and investment in R&D. And Prashant also mentioned this, that there has been, and you also said, right, there has been outrage in the US for the amount of buybacks that were happening. But those buybacks were happening after a 12%, 15%, 20% spend on R&D. Yeah. They were not doing it at giving 1% for R&D and then doing buyback. It's a very small but a very significant difference.
And that's what the argument on size, which Prashant was also making. But again, look at the size of the Magnificent Seven, and they're growing. Look at Nvidia, and on that base.
Growth is 20 to 30%. There's very strong growth at that base.
Yeah,
which is what I'm saying. So the base argument beyond the point, does it really
that
hold?
growth has happened. Surabhi, that growth comes because we woke up to AI after ChatGPT. They've been building ChatGPT
That's precisely what I'm
and
saying.
all peers, right? So they
to
were
say
spending on
that
R&D.
TCS is a very large base and large revenue and large number
Correct.
of employees, so therefore we can't innovate and think on our feet.
No,
and move
actually,
fast
the
enough. I don't know if
argument
that
of
holds.
size was between Indian large cap IT companies and Indian mid cap companies, right? It was easier for mid cap companies to grow given the size. But Shireen, where
there is a risk also for mid cap companies if they pivot and if that thing doesn't work out.
If that particular technology,
blow up the entire company, right? So there is a risk as well with such small companies. Even from an investor point of view, if you invest in a large cap Infosys or TCS, you're safe.
Yeah.
Whereas you're looking for a very small niche company.
I think that safety...
that swing is very huge.
That safety moat that we talk about,
it just blows you up.
I don't think, that so a safety moat is shrinking by the year, right? Every year.
I personally feel, there has to be 4 or 5 big R&D success stories in India. And I'm telling you, then every investor, every company will start chasing and start putting money into
But
R&D.
it's chicken and egg, no?
It's just that
you have to put the money for that.
Success has to come.
but that's,
Unfortunately, it's not come in the last 20
Guys,
years.
should we talk salaries? I think.
AI is everywhere. But it's not on the top line, it's not on the bottom line, but it's there in terms of your job.
Rima and I, Shireen, were asking the TCS management, and I feel I've asked it twice or thrice now. So, you have 100 people to execute one project. You start using AI and you're executing for an American company, and you don't need 100 people now, you can do it with, say, 60 people, right?
Yeah.
You can go on for, say, a few quarters, you save on costs, etc. But at some point, the guy on the other side, your client is going to realize, right? You're doing a lot more, the same amount, with a lot less cost. And you've got to have to pass it on. So that is the pricing, the question, right? Is AI deflationary? It's going to be, in the context of our discussion, is AI deflationary for IT companies? And the answer has always been no, it is not. But it just...
And that's hard to argue because no matter which report you pick up, if you talk about the maximum productivity benefits, it's the BPO sector, obviously, where everything is getting automated. And then it's software development, number 2. So, productivity benefits, depending on whose projection you're reading, between 40 to 50, 60%.
Yeah.
And somewhere these benefits, clients will want a bang for their buck. So, I really agree with that argument.
The point is that we let people, our talented people, go to the US and build great products there. And here we kept complaining that how... we don't have all 90% of our engineers are not employable. Every IT CEO would have said this once, at least in the last 10 years. But pay the good guys and keep them there, na? So, Prashant, cue salaries.
This is very interesting data. I checked, by the way. This is out of memory in the year 2003, 2004. When I started working, you had an entry-level college graduate was getting paid about 25,000 rupees a month.
3.5 lakhs.
3 lakhs. Basically, it's about 25. Yeah, roughly that, right? Now, the entry level, I am told, is about 3.6, 3.7 odd lakhs, entry level out of college.
Yeah.
You adjust for 6% CPI inflation. Inflation adjusted in real terms, you can put the numbers in your head. You're basically looking at about it's actually over 70%.
Dismal.
Roughly 65 to 70% drop in real income over a 25-year period. Almost 25-year period.
I asked the same question to the Infosys CHRO at that time. I think it was 2019. So, and I was like 3.5 lakhs, and now we are 15 years, 20 years later, we're talking about the same number. What explains this? Oh, then same question, same answer, upskilling. We will train you, we'll make you better, and in 2 years your salary will be double.
Shriram, media ke liye bhi bol sakte hain.
Still a chip better. Let me not say anything.
AI upskilling.
Not much has changed.
Not much has changed. Exactly.
Ours is a very low skill job.
Which is why I was keeping quiet. Let me not get into it.
They may turn around and say, so why are you talking?
But I know, that'll be a whole other conversation. That'll be a whole other conversation.
I guess, folks, but Shireen, don't you think it's a real question? Because from employing thousands and millions of employees at very low salaries, the model seems to be shifting to lesser but far more upskilled people at higher salary points.
That is... Exactly. And I think that is something that, and that's a challenge not just for these companies, but that's a challenge for the larger economy as well. Because remember, this is a sector that's been an employment, that's been an employment generator. And now if you're talking about low code, no code environment and moving very quickly, that's not 5 years on, that's happening now.
Absolutely.
CEOs are almost bragging about the fact that, so much of our code is now being generated by AI, 30%, 40%, 50%. It's almost as if they're in a race with the other guy to say, maximum amount.
No, absolutely. In fact, I share that worry with Lata ma'am almost on a weekly basis. I mean, the 90s IT revolution that built the middle class of India. I mean, we're talking about a bigger change than perhaps in the coming years.
But there is one counterpoint to this. One counterpoint to this, which is that I think from the client's POV, like the people who are going to pay TCS and Infosys and HCL Techs, I think they'll be willing to pay a bigger amount. I think what they are asking is, yes, do it with fewer people, etc. There is no premium on that anymore. Just because you can do it, if you can give me a great product, a great solution. So everybody called the death of the SaaS products as a whole, right? Like outside in the world, everywhere else outside India, SaaS is dead according to them, according to many critics. Then what they are starting to ask is service as a software, like just flip it on its head. Add an AI layer to it. Add decision making to it.
This is an AI specialist who I met in the Valley, and he's the father of many things AI. And he said the machine will not have the ability to ask questions. It may have the ability to answer all kinds of questions, but it won't have the ability to ask questions. So perhaps that is what we're going to be. What is your question?
Richard Baldwin, Globotics Upheaval. It's the book where he says the only way to beat the machine is to be more human.
Guys, it's been fun chatting with you. Unfortunately, we are out of time on this one, not out of ideas. So we'll be back again with the editor's playbook from Nimesh, Prashant, Surbhi, Rima and Shriram. Thanks very much for joining us. We'll see you again next week. Till then, goodbye.
Welcome to Indianomics. I'm Lata Venkatesh. Today's Indianomics is on stable coins. Actually, why stable coins today? The total market cap of all cryptocurrencies as of this moment is $3.9 trillion. It has surpassed India's GDP, which economists peg at $3.86 trillion as of June 30th. Today's market cap of cryptocurrencies is a 50% growth from year-ago levels and a 10x growth since 2020. The reason for the recent spurt is the Genius Act in the US, which has legalized the issue of stable coins by private entities. Now, one may have many kinds of issuers and currencies like, say, Amazon money or Walmart money. Lesser-known crypto issuers and tech companies may also issue their own stable coins, and the market may value them at less than their face value of $1. Also, since stable coins can seamlessly buy cryptocurrencies, it's possible that illegal and ill-gotten gains may change hands via stable coins and cryptocurrencies. To understand how our lives may change, we have with us Professor Ishwar Prasad. He's Professor of Economics at Cornell University, and he has recently authored a book, The Future of Money, and therefore has dealt with cryptocurrencies in detail in that book. Professor Prasad, thank you very much indeed for your time, sir. So can you begin by first explaining how stablecoins differ from cryptocurrencies, and then we delve into the Genius Act?
Thank you for having me on your show, Lata. So this is indeed an important moment for the evolution of cryptocurrencies, which are becoming increasingly mainstream. Now, the key difference between stable coins and so-called decentralized cryptocurrencies like Bitcoin and Ethereum is that when you think about something like Bitcoin, there is nothing clear anchoring its value. And it's ended up having very volatile value. So while Bitcoin was originally created as a method of payments that would not require using a traditional commercial bank or a credit card provider, its very volatile value has meant that it's really not useful for payments. Stable coins, on the other hand, get their stable value by being pegged to a fiat currency like the US dollar, or conceivably someday something like the Indian rupee. And each unit of a stable coin is backed up by reserves of that fiat currency. So for instance, dollar-backed stable coins are backed up by reserves of US government securities and so on. So that stable value allows them to be used in payments. So what this means is that stable coins, while they're being used as payments, in a sense, get away from the philosophy of Bitcoin, which is to have everything be decentralized, including the issuance, the value, the governance, and so on. Stable coins are issued by a particular issuer who validates the transactions and so on. So they are more centralized, but they do seem to work at what cryptocurrencies were supposed to deliver, which is an alternative method of payments.
Fair point, sir. In fact, they're going to be regulated by the FDIC, by the perhaps even the US Fed and state banking regulators. So it's not quite like Bitcoin, which is kind of regulated by algorithms. But let me come to the Genius Act itself. It says that there will be state regulators for issuers who issue less than 10 billion stable coins, and those who issue more will be regulated by probably the FDIC or the OCC. Now, when do you think this regime will start? Are we still waiting for rules to be written?
That's right. The Genius Act was passed by the US Congress and was signed into effect by President Trump a few weeks ago. But the actual act will take effect either in January 2027 or 4 months after all the rules are written by the relevant agencies. Now, it's worth keeping in mind the context here, and the context is that this administration here in the United States is very favorable to crypto. So the Genius Act is one part of what I think will be a raft of crypto-friendly legislation that is passed by this administration. And certainly stablecoins are going to play a very important role in the world of decentralized finance, but also as an on-ramp and off-ramp between traditional finance, as epitomized by commercial banks, for instance, and decentralized finance, which is the world of cryptocurrencies. Now, the reality, Lata, is that stable coins have already gotten a lot of traction. The market capitalization of the two major stable coin issuers in the US, Tether and USD Coin, already exceeds $200 billion. And this legitimization of stable coins is certainly going to give a huge boost to not only these two stable coin issuers, but as you mentioned, other private stable coin issuers as well.
Yeah. Now, for Tether, which is already, widely used, to be accepted in the Genius Act, say, for instance, say Amazon wants its customers to pay via Tether. For that, there are still some steps, right? Because Tether will have to adhere to monthly disclosures of how much assets it has. The Genius Act has a lot of rules that stablecoin issuers will have to have transparency of their assets.
That's absolutely right. Now, the interesting thing is that while a stablecoin issuer like Tether has been somewhat open about its reserves, it's not been fully transparent. But nevertheless, the market does seem to take the issuers of Tether at faith because the value of Tether has remained pretty close to 1, except for a couple of episodes where it deviated a little bit from that value. There are other stablecoin issuers like Circle, which issues USD coin, the second largest stablecoin, which has traditionally been much more transparent about its reserve holdings. But certainly this act will bring uniformity to the sector. Any stablecoin issuer will have to be much more open and transparent and provide an auditing trail for the reserves they hold so that market participants and users can have much more faith that each unit of a stablecoin is in fact backed up by liquid, safe securities.
What is your sense, Professor? Do you think that, people will stop, or at least there will be less usage of credit cards and debit cards and people will move over to stable coins? Because there are multitude. There's already Tether and Circle. It is possible Amazon and Walmart don't use the existing coins but issue their own. There could be more people. What is your best guess as to what will be the regime? Will Visa and MasterCard lose their proponents?
So we're certainly entering a wild and interesting world of private payment mechanisms circulating in tandem with the traditional payment mechanisms like fiat currencies issued by central banks and also commercial bank deposits, which have been a very important payment mechanism. Now, it's worth thinking about why stable coins are getting so much traction. And I think this is where stable coins have really proved useful in terms of showing us how much more efficient payments can be, both domestically, within the world of decentralized finance, and especially in terms of cross-border payments, where there are enormous inefficiencies, very high costs, very slow processing speeds. So in my mind, the real legacy of stable coins, whatever happens to stable coins themselves, is showing us how much more efficient payments can be. Now, given that we have the legitimization of stable coins, certainly there are going to be incentives for private companies like Amazon, Walmart, perhaps even social media companies like Meta, which once upon a time did have a stable coin project that was killed by the US government, to go back to starting to issue their own stable coins. And there is logic to this because at one level, you want to think about private firms that have very large balance sheets, that are very large networks, adding on a payment mechanism on top of their existing networks. The difficulty, of course, is that we're going to have multiple payment mechanisms, and it's not entirely clear if all of these are going to be equally reliable. So it's a good thing from the point of view of consumers and businesses that the cost of payments, the frictions in payments, both domestic and international, are going to decline. But we could be in a period of some volatility when we have multiple payment mechanisms and some of them turn out to be less than ideal. And as you pointed out in the introduction, some of them could end up being ones that facilitate illicit activities, money laundering activities, and so on. So the big question is whether we are moving to a more stable regime or one that is in some ways efficient, but could also create a lot of instability.
What's your sense about cross-border, sir? I mean, I'm trying to look at the impact on India first, or countries like India. If we don't recognize stable coins, if we, stay quiet about it, mum about it, then obviously I cannot pay for an Amazon product with stable coins. In that case, do you think countries like us will be impacted in any way?
It is a potentially worrying time for central banks around the world. Even the European Central Bank has come out with a statement that it is worried that it could lose monetary policy autonomy if stable coins become much more prevalent, especially because it looks like the stable coins that the world desires are really dollar-backed stable coins. And given that a dollar-backed stable coin, whether issued by a company like Tether or a big company that has a global footprint like Amazon and so on, that could have much more trust from consumers and businesses around the world than local currencies. I don't think in India we face as much of a problem, but certainly there are concerns that these stable coins issued by US issuers in particular could start becoming very widely used around the world. Now, certainly regulations in a country like India can, to some extent, forestall this from happening. But the reality is that it's going to be very difficult to manage the use of stable coins by private parties, especially because the US financial system remains dominant, and for people to shift onto that financial system is going to become a lot easier thanks to the prevalence of stable coins. But I think the fundamental issue is whether this is going to catalyze every country to start innovating in terms of payments. India, in my view, is already very far ahead of most other countries, both advanced and emerging market countries, in terms of the efficiency of its payment systems, thanks to the UPI. So I think India has somewhat less to fear in terms of domestic payments being disrupted, but certainly cross-border payments are going to be disrupted.
Yes, it is. Cross-border is very expensive. I mean, I think if I have to remit $100, we spend almost 5% in terms of cost of, paying the banks on this side and that side. So clearly cross-border is very, very inefficient and very profitable for the banking system. But if the Indian government, or any, for that matter, say Indonesian or Philippine, any of the Asian governments advise or direct their citizens not to pay in stable coins, then do you think the system will be thwarted or impacted in any way? Do you expect them to come up with such rules?
I expect that many national governments and central banks will do their best to try to limit the proliferation of stablecoin usage within their own economies, even if it is largely for cross-border payments. But the unfortunate reality that many of these governments are going to face is that if there is such a wide gap in terms of the processing cost, the processing speed, the ability to track transactions and so on, and especially as stablecoins become more legitimized in Western financial systems, especially the US financial system, it's going to become much more difficult to control. My view has been that when you think about cryptocurrencies, especially stablecoins, they're going to substantially reduce the efficiency of capital controls, the ability of national governments or central banks to limit the usage of foreign currencies by their own citizens, and the ability to control both capital outflows and inflows. So I think a far better response by national governments is going to be to beef up their own domestic payment systems and to have their financial institutions start adopting some of these new technologies in order to make cross-border payments quicker, cheaper, much easier to track. That, I think, is the only realistic response that countries have, in addition to improving their own monetary and other policies so that their currencies don't get crowded out by these easily available private currencies from advanced economies.
Okay. The recent numbers from Chain Analysis, the company which looks at cryptocurrency adoption across the world, says that India has 97 million people who have some kind of dealings in cryptocurrencies. Do you think that there can be danger because of this, that even without the permission of the Indian government, there can be large numbers of people who will be handling stable coins and cryptocurrencies?
Now, certainly, if you think about what stable coins do, they provide a relatively easy way to transact within the world of decentralized finance, which is finance that takes place on decentralized blockchains that are not managed by a government or any particular financial institution, but are, as you put it, managed essentially by computer algorithms and the computing power of the community. Stable coins also provide an on-ramp and off-ramp between traditional financial institutions and the cryptocurrency world. So it's going to make it a lot easier for Western financial institutions, especially US financial institutions, to allow transactions that that involve stable coins. So if you think about an Indian citizen now who wants to move money into cryptocurrencies, there are going to be increasingly channels to do this without having to rely on traditional financial institutions, which are the ones that are regulated by the Indian government and the Reserve Bank of India. So it is going to become somewhat easier for private citizens to do what they want to do in terms of transacting in cryptocurrencies, and a lot harder for governments to regulate and control.
Okay. Well, I'll have to take a quick commercial break, sir. I'm coming back with more direct questions on, what it means to the world financial system in terms of advantages and disadvantages. Back in a minute. Welcome back to this Indianomics special on stable coins, which have now become legal thanks to the Genius Act in the United States. I mean, they were always legal, but now they're likely to become a mainstream currency, a mainstream way of paying one another. Aside from the dollar, you can pay through stable coins, so maybe Tether, maybe Circle, or maybe new coins to be issued by perhaps an Amazon or a Walmart. I've been speaking with Professor Ishwar Prasad of Cornell University, who has recently authored a book on the future of money. Professor Prasad, thank you very much for your time and thank you for your patience. Well, I want to know, when do you think it may become mainstream? Do we see it like in a year, in 2 years?
So at some level, Lata, the Genius Act and the attitude of the Trump administration have already made cryptocurrencies essentially go mainstream, because stable coins are now going to be more easy for traditional financial institutions like commercial banks to accept. We're going to end up having many more payment rails that involve stable coins. And even decentralized cryptocurrencies like Bitcoin are being legitimized by the US government, which talks about having a Bitcoin reserve, for instance. So that day of legitimization might already be here in some ways.
Okay. Well, actually, I even saw, I think it was JP Morgan saying that they are ready to give loans against crypto assets. Considering that, these are very volatile currencies. I mean, even stablecoin. Tether at one point was ruling at 0.6 to the dollar, and at one point was 1.2 to the dollar. Now, if you have so many people issuing currencies, is it not possible that not all of them will be viewed by the market as equally stable. Do you see a chance that one stable coin may be less than $1? I mean, people don't take it at face value.
So the interesting reality is that while there was some volatility in the value of Tether in its early days, if you look at the last few years, both Tether and USD coin have held pretty close to one. I mean, there were periods when the peg shifted by about 3 or 4% for a very brief period when there was a lot of turmoil in the cryptocurrency markets. But overall, market participants do seem to take at face value the notion that each of these units of stable coins is in fact backed up by adequate liquid reserves. But certainly as the number of stablecoin issuers increases, there will undoubtedly be some shady promoters that try to take advantage of the fact that they could make a quick buck. And there is some good money to be made because one of the key attributes of stablecoins, of course, is that they do not pay any interest. And the stablecoin issuers park the reserves in interest-bearing securities such as U.S. government bonds, which at the moment are paying, in the 4 to 5% range of interest. So it's a pretty good business model at these interest rates. And undoubtedly, there will be many more operators that try to make money off this. And that is going to lead to some volatility. And I suspect that there will be a shakeout coming in the stablecoin industry. And that could have some knock-on effects even in the traditional financial system.
There are some people, I think Barry Eichengreen wrote a piece saying that, we could have, he doesn't use the word layman, but we could have some kind of crisis like this because of illicit money getting exchanged. Do you foresee a possibility of a crisis for the global financial system or the US financial system because of stable coins?
Here is the big difficulty, in my view, about what is happening in the US. The cryptocurrencies industry is getting exactly what it wants, which is legitimization from the US government in the form of legislation and in the form of actual promotion of various types of cryptocurrencies by the US administration all the way to Trump himself. But at the same time, this is an administration that is backing off on practically all elements of regulation, especially regulation of the financial sector. So you might end up with a very toxic mix of legitimization of an entire part of the financial system, coupled with light touch regulation, which might mean that you don't really have the sort of regulation that you need, especially for a class of products that is still, being tested and tried in different market conditions. One could well imagine a scenario, for instance, where there is concern about a stablecoin issuer or multiple stablecoin issuers, and those issuers then have to redeem a significant part of their, in principle, liquid securities, such as US government bonds, and that at a time when the US government is running large deficits and has very large financing needs, could create a lot of turmoil in the US Treasury securities market, which in turn could spill over into other parts of the US financial system, because the US Treasury securities market is really the benchmark for the rest of the US financial system. And of course, that could very quickly spill over into the global financial system. At the moment, the capitalization of stable coins, for instance, is about $220, $230 billion. It's not large enough, but we are certainly